Financial Freedom Guide for Dummies by Jonathan. Preface. The journey to financial freedom is one that many dream of but few achieve. Why is that? Is it because financial freedom is only for the privileged few? Is it because it requires specialized knowledge that most don't have access to? Or is it simply because the path seems too complex, too risky, or too uncertain? In my experience studying wealth building strategies and interviewing countless millionaires and billionaires, I've discovered that financial freedom is attainable for anyone willing to learn the right principles and, most importantly, develop the right mindset. That's why I've created this guide, to demystify the journey to financial freedom and make it accessible to the everyday person. This isn't just another get-rich-quick scheme or a collection of complex financial jargon. Instead, this is a practical, straightforward guide designed to help you understand the fundamental principles of building wealth and achieving financial independence. Regardless of your starting point, remember, none of what I share in this guide constitutes financial advice. You must do your own research and make decisions based on your unique circumstances. What I offer here is education, the tools, strategies, and mindsets that have proven effective for countless successful individuals. Are you ready to begin your journey to financial freedom? Let's get started. Chapter 1. The Foundations of Financial Freedom. Understanding the journey. Building wealth is a slow process that takes time. Slow and steady wins the race. Patience is one of the most important parts of investing. It takes time to build your capital reserves. As we look at the principles behind building wealth, we will try to make it as simple as possible for you to understand. First off, let me introduce myself. I'm Jonathan, and I have been studying rich and successful millionaires, billionaires, and financially literate people, trying to pick apart what has made them successful and what has grown their wealth. I have uncovered various principles that I'm going to teach you to help you understand, in the most simplistic of ways, how we can do this as the everyday average Joe or someone who has average or even above average knowledge of finances. I do have to say none of this is financial advice. You must do your own research as I have done mine. Unfortunately, not everything will work for every person the same way. The reason why is that you are your own worst enemy. You could have all the knowledge in the world. You could even have good practice, but there is a lot of psychology to investing. The psychology of investing, let me explain. The average person tends to want to buy into the market when it is going up because it makes them feel good, and things are on an upward trajectory in the market. Doesn't matter which market, but what one must understand is that the best investors don't buy when the market is going up, they buy when it is significantly down. Such a simple concept: buy low, sell high. Buy cheap, sell expensive, to put it in other words. The problem is that when the market is going down, most people look at it like a falling knife. They don't want to try and catch it. Some people use technical analysis to try and determine when the market bottoms. Sometimes that can be a good indicator, other times not. A majority of people are afraid to buy a market that has crashed. That is exactly when I want to get in. The 3 pillars of successful investing. When looking at investing, I consider 3 key factors. 1. Position size concentration. How much money do I need to put in one position to make it worthwhile? This determines the allocation of your investment capital. 2. Risk assessment. What is the risk of the asset? How risky is it? How likely am I to see a return? This affects position sizing. Lower risk might mean larger positions, while higher risk requires smaller positions. 3. Time horizon. How long would I need to wait to see a return if things go correctly or go bad? This helps determine how much risk you're taking, how much you should be investing, and how long it might take before you see the return. Value investing. The art of finding hidden gems. Value investing is where things really get interesting. It involves locating assets early, getting in at low prices, buying in large concentrated positions, and waiting out large price increases. As a value investor, it could take time for the asset that you buy to multiply your money. Consider this example. An average Joe buys shares in a company that he thinks will go mainstream in maybe 5 years. In this scenario, we'd be looking at a publicly traded stock. So this person puts $1,000 in, hypothetically, buys $1,000 one shares, and waits patiently. The average Joe is convinced that the technology they have will change the very world itself. Within 5 years, because he found something that had inherent value, not just any company, but a company that was going to disrupt things, change things, and go mainstream, the stock grows. Over the course of that time, the company succeeded at what they set out to accomplish. Their technology revolutionized something. So hypothetically, that $1 share then became a $50 share. That would be a 50x return on investment. So that $1,000 would have become $50,000. Not bad. Beyond stocks, business as an investment, there's another example that represents a different way of investing, business. Say a similar situation, only a guy invests $10,000 into a small business. The business plays out over 1 year, earning back his $10,000, maybe a little bit extra to cover taxes. At that point, it is now a cash flow business, and as long as the business continues, it will generate the same or close to the same amount of cash flow, depending on a lot of factors including the economy and demand. At that point, he would have his initial investment returned to him from his $10,000. So he would have it to reinvest in something else as his business continues to replenish that year after year. Maybe he grows his business. Maybe within 3 years, he has scaled the business so that he has 3 food trucks that are earning $10,000 a year each, even in a bad year. So at this point, by year 3, he's earning $30,000 a year. It just all depends on the person. Not everybody has the drive to do business and to create cash flow through business. The good news is that cash flow can be created through investments as well. There is more than one way to do this, and we will go over many different ideas on this. Chapter 2. Understanding market structure. Bull markets versus bear markets. Market structure is important because the everyday average investor tends to look at it wrong and does it wrong. To put it plainly, there are bull markets where the markets go up parabolically, and there are bear markets where the markets go down parabolically. Ideally, people need to be buying in the bear market, holding out, and not selling until a bull market is achieved. This could take time, but that's where the patience comes in. Remember, getting rich quick is like trying to buy lottery tickets and win. It's not a very good strategy to buy lottery tickets and hope that you're going to win randomly because there's no strategy in it, it's just random. When it comes to value investing, you're picking things for very specific reasons that give those assets longevity, survivability, and growth potential. Because of this, it really depends on you. You will have to learn, and I will try to teach you how to change your thinking, how to try and reprogram your thinking, but in the end, training your mind to be a good investor mostly depends on you and your willingness to overcome yourself. My journey, learning from mistakes. Let me take a brief journey back to my early days of investing. When I first tried to invest, my mindset was totally wrong. I saw the market moving up and thought, look, this one's going up. I think I'm going to buy that one. Not too long after, it started going down, and I panicked, thinking, oh shoot, it's going down. Now I've got to sell it. I kid you not, I was very simplistic back then, not putting a lot of thought into it. As I went back and forth over a period of time, I realized that each time I traded, I paid a small portion in fees, and then I started realizing I was losing money. I wasn't making any money. Sad to say, I was doing terribly. I tried looking at charts, I didn't understand what people were talking about. It all seemed foreign to me. After enough time had gone by and I had made many mistakes, tried and failed, tried and succeeded, I learned what worked and what didn't work, and I learned a lot about myself as an investor. I realized that I was going about things all wrong. I would get panicked and feel worried and stressed when the markets were going down. I couldn't believe how stressful it was watching my money disappear as the value of my assets dropped. The pure euphoric excitement I would get when the market went up as my money multiplied was addictive. The language of technical analysis, I started to ponder all these things, and after extensive research and studying people who knew what they were talking about, I grew my knowledge base. I came to understand technical analysis as my second language, very fluent. I could read charts without a problem and draw patterns on the charts to determine the potential probability of outcomes happening in financial markets. I used that skill to my advantage to try and understand how the price would behave. Little would I know then, but would later come to understand, that the price action on the chart is a representation of people's psychological behavior with their money. As somebody is panic selling and the price of the market is moving down, certain patterns can form that determine how people are behaving with their money. These patterns can either be breakdown patterns or breakup patterns. Understanding chart patterns, some examples. A breakup pattern would be a falling wedge, which would have approximately a 68% chance to break to the upside. This is where price action forms a downwards channel that is bouncing up and down. What this demonstrates is that there is a high probability that, because of so much selling and then people buying back in, it creates up and down price movement. The people that are capitulating or selling, likely to a more long-term holder or just somebody that doesn't intend to sell until it rallies. As eventually all sellers are exhausted, there then becomes only buyers. Eventually, as prices start to recover again, unfortunately, the everyday average Joe thinks he's missing the train and jumps back in. That causes the price action to surge even higher as multiple sellers that have been exhausted then flip to buyers. This causes parabolic price action to the upside, which could likely lead to a big move higher, but eventually another sell-off as the long-term holders then take profits. This can repeat multiple times. It's all just a pattern playing out on a chart. The importance of understanding trends. Back to the basics. Technical analysis is for understanding charts, but even then, you need to understand trends. Trends can take time to form before they go parabolic. Once a trend goes parabolic, it will likely run out of steam not too long after big increases. Some things might be hard for you to understand, and some things take time to understand, but be patient, you're going to learn, and you're going to understand. Still, remember it all depends on you and on your motivation. I would like to motivate you, don't give up. I wanted to give up so many times, but you can't give up. If you don't get it the first time, try again. I remember when I lost my first $300, and it was all gone, it made me want to give up. Little did I know it was a drop in the bucket compared to what future losses would be. Even though I would go on to lose thousands of dollars, every mistake was an opportunity to learn and become better. My hope is to shortcut all the hard lessons I had to learn and what helped me over the course of my journey and put it into words for you to understand. From there, though, I would go on to make good money. As I said, though, it takes time and patience. I really want to emphasize that. With enough time, and I would hope you have time, you could totally change your life forever. Chapter 3. The right investment strategy. Finding value in the bear market. Going back to fundamentals, that's a very important word to understand. Understanding market structure. As a more educated investor, I learned that buying during the bear market is what makes you the best money. The problem is you can't just pick anything. That is where value investing comes in. From start to finish, the correct way, if we're talking about the beginning of making a good choice for investing, I would start by finding something of great value in the bear market. I would look at the price performance of the past of an asset. I would look into the asset as well as any companies or affiliated businesses with the asset. As we're living in a day and age where there are digital assets, even a protocol could be something I would want to look into. If it is a stock, I look into the company. If it is a protocol, there are still people behind it. So I would do all my research on any digital asset thoroughly to the max, looking into every facet of information I can get my hands on, including security audits. Due diligence. The foundation of smart investing. I want to determine whether that digital asset is worthwhile and if it has the potential to disrupt a current industry. Can it grow over time and have a network effect with people in terms of not just the technology that it has? I would look at token supply and tokenomics to determine what potential price outcomes could happen over the course of the time I would be investing in it. There are ways to do this through calculating market cap divided by the number of tokens that are available on the open market. The liquid token supply would be the total number of coins that anybody could sell at any given time. I would take that market cap and divide it by that to determine what the potential price could be if a project hit certain market cap thresholds. I would determine this based on what industry this digital asset disrupts, what percentage of market share it would capture from that said industry, say 1%, 2%, 0.5%. You look for the realistic outcomes, and you look for the not so probabilistic outcomes so you can understand the potential based on comparable growth with other assets that have already achieved that. To put it simply, you're trying to find that one thing that is going to outperform other things for many reasons, something with a high potential to make you a lot of money. That way, you can put very little in and still make a lot. It's one thing if someone invests hundreds of thousands of dollars and turns it into millions. It's another thing if a person invests a few $1,000s and turns it into millions. All these outcomes are not only probable but possible. The psychological challenge again, I must emphasize that you must determine your own outcomes. Will you have the psychological fortitude, the mental strength to hold on as you watch your investments lose value, or will it be too much for you to bear and you end up selling at a loss? Will you be able to hold on long enough for the value to come in and reap a harvest 100-fold, 200-fold, 300-fold of what you put in? All these outcomes, and probably one of the most important things of investing, is learning the proper psychology and practicing so that you do not make the everyday average Joe's mistake. Proper investing psychology. A practical example. One of your first lessons is an example of proper investing psychology. Let me break it down for you. We start off with the market going down at the beginning of the day. As a seasoned investor, I look at the market going down, and I'm happy. You might think, wait, how can you be happy the market's going down? I also forgot to mention the Fear and Greed Index, which is a measurement of sentiment, is also at a low of 20 extreme fear. You might then again ask yourself, if the sentiment is so negative and the market is going down, how can you be happy about that? One of the first rules of investing from my personal experiences, the psychology you need to have is that you look at a downwards fearful market as an opportunity. Other people are selling and capitulating, getting out of the market, leaving prices significantly discounted. When a majority of the selling is done, there's only one way that something can go, and that's up. Obviously, nothing goes in a straight line, and nothing goes straight up, and nothing goes straight down forever. There are always changes in trends along the way. When the market is fearful and lots of people are getting out of the market, prices are declining. Prices put in new lows or get close to previous lows or even all-time lows. Reframing market downturns as opportunities, I look at it as a discount. So when markets go down, you need to replace that feeling of, my investment is going down in price, if you have any current investments. You need to replace it with, well, the rest of the market is now cheaper to buy in. Think of it like the Black Friday shopping spree for investments. At maximum fear after a major price decline, there is a good chance of a rebound. So when I see this happening, regardless of my current amount of investments, I am always looking at it as an opportunity. The more fearful the market becomes, the more excited I am about buying. The majority is usually wrong and tends to be wrong more often than not. They call this contrarian trading. You are trading contrary to the majority. By the time the majority realizes that the market is recovering, you would very likely already have scooped up cheap assets. Thus, as the majority comes back in, prices get bid higher. As more and more people pile back in and prices recover, you find yourself in profit. The main idea is that you don't want markets going down to scare you. This is one of the first things you must master. You always want to be calm when you are investing. Think of investing like meditation, like you're meditating on an idea or on a scenery or on a beach. Think of it as a relaxing thing, something that makes you feel good when you do it. Regardless of how the market is behaving, you know that by taking the time to invest, you will greatly benefit down the road. A lot of mindset can really help with that. If you have a negative mindset, you're going to find yourself more on the struggling side. Developing mental strength. Human beings are 100% capable of controlling their mindset. Animals act out of instinct. Humans act out of logic most of the time if they're using the rational mind. If we are in a panic, our limbic system will take over, and our fight and flight response will happen. Imagine this and picture the feeling that it gives you to put things in perspective. Your life savings, let's say it's $100,000, you put that into an investment. It was a bad investment, and upon looking at your portfolio, $100,000 is gone. The investment you put your money in turned out to be a scam. I want you to picture that as if it is really happening to you and imagine how that makes you feel. It might give you a pit in your stomach. It might make you feel like you want to pass out. Could you imagine $100,000 in life savings just suddenly gone to zero, all that money gone? For most people, that would be a point of giving up. This is where you are going to have to develop your own personalized strong mindset. I will try and encourage you along the way. You got this, you can do it, but you have to set your mind to it. Everything is steps. You need to start somewhere, and you need to end somewhere. The idea is, regardless of where you start and where you end, you learn something along the way and put it into practice. The calm investor's mindset. Back to the mindset. For a good investing mindset, I'm always excited when markets go down. I'm relaxed and calm when markets go down. I also get excited as markets go down, as I see it as a discount. This is the start of building a portfolio and a position for me in the bear market. Over a period of time, be it months or years, depending on my time horizon for those investments to come to fruition, I would buy over a course of time, not all at once. Let me tell you why. They call this DCA, dollar cost averaging. It is a method of investing where people put money in over multiple weeks, multiple days, depending on the schedule that they set for themselves. This must be determined by each individual person based on their own capacity to have capital, aka money, to invest. Chapter 4. The three-part method for investing success. Position size concentration. This is where I would implement my method. Position size concentration. 1. How much money do I need to put in one position to make X amount of profit? To make it worthwhile. Risk assessment. The next one would be risk. 2. Determine how likely the investment is to succeed over the short term and the long term, the security of the investment. Look at the overall team or company behind the investment to determine legitimacy. Look exhaustively at every angle of the investment to determine if it is safe, low risk, medium risk, or high risk. If it is safe, I could feel better about putting a larger position into the investment. If the risk goes up, I would prefer to put less in that investment. Also, with risk comes the potential to affect the first part of the method. Number 1. Position size. Time horizon. Going on to number 3, we have a time horizon for investments. 3. When we think time horizon, we think, if I put money in during this bear market, how long would I have to wait for it to achieve the desired amount that I have determined from the first part of the method? Let me use a mock example so we can try and see what it might look like. Asset A is at 0.10 a token, and I want to make $100,000, and the all-time high of the asset in the last bull market or previous bull market was $10. So if I put $1,000 in at 0.10, I would get 10,000 tokens. This would be my asset. So by looking at multiple factors, including past performance, which doesn't always predict future price action, we can determine a realistic position size to make X amount of money. So at this point, if I put $1,000 in, I would be able to get my 10,000 token position with the hope that the all-time high could be achieved again or get close to it in the future. Security and due diligence. I would then go through every step of security examination that I could. I would look at the token, see if they have a website, look through the website, read all the information on it I could. I would try and determine security audits on the token to see if the code has been audited by a third party. Projects that don't have security audits tend to be scams. Any project that's willing to put forth $50,000 to $100,000 for a security audit is likely more legitimate, especially the more audits they have. They are more likely to be legitimate because it gets expensive, and they have to fork out a lot of money for security audits, which adds more validity as more parties review the code to determine that it is safe, that there's no single point of failure, that the code does not have major vulnerabilities that can be exploited by hackers. Security audits are very important for crypto-based assets. I would look into the team behind the project. If they are an anonymous team, I would not touch it. If I see real, verifiable people that I can look into, their track record, how long they have been in the industry, what their overall plan for the project is, what the likelihood of the project's survivability is, whether the project will have competition, how likely this project, due to its technology and fundamental value, which has to do with the technology that makes it work and makes it special and stand out against other things, is to succeed, I'm more confident in my investment. Does this project have a roadmap? I would see if there's any way to contact them, and if there is a way to contact them directly, that is a good sign. If there's no way to contact them, it's not something that I want to invest in. Upon determining that the asset is likely to make it and disrupt and take market share from another industry, I would feel more comfortable getting into that asset. Planning your exit strategy for the third part, I would start looking at the time horizon. I would determine how long it's going to take from the time I buy it in the bear market to the time we would hit a midway recovery into the next bull market, to the time it would peak likely in the next bull market. None of these times will be perfect, but we can try to hone in as best we can based on the data and technicals, basically using technical analysis and charting to determine major trend reversals and trend changes. By the time we determine all this, some of our overall idea of how things are going to go may or may not play out at the specific time we think. So we always would want to be prepared in the case that the asset we buy tops out sooner than we think. So one thing with time horizon is determining how you would also get out of the position. This is part of the psychology of investing the right way, retraining your brain. Essentially, some people will sell portions on the way up. Once they're past the halfway point of a major market recovery, on the first big move up, someone might sell 50% of their position and wait for the market to have another big move, then sell another 50%. Another strategy would be to address those ratios. So instead, maybe at the midway point, they sell 20% directly at the midway point of the recovery, then they wait for the first big move up and sell another 20%. Then they wait for another big move up and sell another 20%. Then, if the market starts reversing and starts falling back down, maybe they would still just sell another 20%, see if there's another recovery bounce, sell another 20%. There are lots of different ways you can do it, it just depends. The less you sell and the longer you hold a majority of your position, the more likely you make the higher end amount on your investment that you calculated earlier in the first part of the method. The importance of patience. This is where patience comes in. Patience is good. You have to be patient between the bear market when it's boring or prices are crashing all the time, or going sideways for an extended period of time. You have to be patient as you accumulate the position. You might not have the money to buy the position all at once. So you might have to take time in order to buy over the course of a period of time, like the DCA. By buying maybe once a week, if prices fall and you continue to buy lower, you lower your average buy-in price, hence what DCA is. Especially if you are buying larger amounts at lower prices, by the time the price recovers, you will have exponentially more. So maybe it takes you a few months to do this, maybe it takes you a year, maybe it takes you a couple of years. A bear market could last any length of time. The important part from the past example, and part of the psychology, is that you are getting in when everything is cheap to buy. And you're going to sell it when it is more expensive, making a profit. So it is way less important when you are buying and way more important when you are selling the asset. You really want to take time and do research thoroughly before you proceed with anything, doing your own due diligence. This is why if you're going to lose sleep over it, or you're going to struggle with sleeping, or you're going to be thinking about it every second, it is probably either your mindset is off, or it is a risky investment. Risk management through position sizing. If the investment is more risky, by lowering your position size, say it was a risky investment instead of $1,000. Maybe I only put 10% of that and put $100 in. With putting $100 in, I lower my risk by knowing that if I lose that $100, though it hurts, I can live with that, and that will keep me from losing sleep. That will also keep me from being stressed out or constantly focusing on it. When you become a successful investor, you don't need to look at your investments every second of every day as if you are worried that they're just suddenly going to grow legs and run away. When you are in the right mindset as an investor, you're calm, and you are relaxed, and you just live your life and let the value come to you. The island metaphor. Think of it like an island. You know big things are going to happen on this island, so you do everything you can to get there first. You get on the island, you set up shop, you live there, and try and start a business there, but nobody else is there yet. Though you're losing money having your business there first when nobody else is around, when nobody even knows about the island, when nobody even cares about the island, you wait it out. And eventually, the island becomes popular, everybody flocks to that island, maybe slow at first, then very rapidly. Inevitably, because you were there first, everybody buys stuff from your business, and your business grows and becomes the main business on the island. This is because you got in early, waited out the boring stage and the unprofitable stage, and waited for the real value to come. If you know something will do well based on your best guess, based on the data and the research you do, you are ready to weather the storms. Maybe while that business was on the island and nobody was around, a hurricane came through and nearly wiped everything out. By holding on through the storms, we can come out on the other side not only stronger than we were before but more profitable than we were before. That doesn't mean that things can't go wrong. That doesn't mean that failure can't ensue. You still have to take the time to do research and put effort behind finding quality, high-value assets that are undervalued by others and will have even greater value in the future. The idea is to get there early. Chapter 5. Navigating Market Psychology from Bear to Bull. Shifting your mindset as we come to the next stage past the midway point of the psychology. To summarize, you get excited when the market is going down and most people are selling. You accumulate a position during the bear market. You hold on however long it takes until you get to the bull market. Now, this is when the psychology needs to shift. There's still so much to learn. I don't want to overwhelm you, though, so let's take it in steps, always moving forward. As we come to the bull market, a lot of people are going to be experiencing euphoria. As the market is getting greedy and bullish, the fear and greed index is going to swing to greed and extreme greed, with a number anywhere from 51 to 100, where fear is anything from 49 to 1. So as the market is maybe somewhere around a 70 or even a 65, you should start feeling fearful and feeling like it's time to start getting out of positions now. I know this sounds weird. When other people get a rush when the market's going up, you don't want to give in to the euphoria. Avoiding the euphoria trap. If you get too excited when the market is going up, you might never sell. You'll feel so good holding those assets as they're going up. By the time that they fall, you will be justifying it. You will explain to yourself how you think things are going to turn around, and you will hold on as you lose everything. This is not a mistake you want to make. When others are fearful, you want to be greedy and buy up cheap assets. When others are greedy and feeling euphoric and good, you want to be fearful and feel uneasy and feel like getting out of the market. Now, that doesn't mean you get out all at once. Each person has to determine their own strategy, but I, for one, would probably scale out of a position a lot like DCA, dollar cost averaging in. I would want to do the same on the way out. I would determine this though by a percentage anywhere from 1% to 50%. It just depends on how big of a move happens during that time when the market is really moving. Some assets will move up more than others, so your asset might have not even popped yet while others have gone straight up in value. Staying alert in bull markets also, where you are more relaxed when the market is fearful. When the market is bullish and greedy and euphoric, you want to be paying more attention to the market. Before, you could relax a little bit and not pay attention all the time because you're in the boring stage. During a bull market phase, you want to be laser focused, checking your investments regularly, freeing up your schedule so that nothing is going to get in the way of you being aware. It would be terrible if you were out shopping for food, and within that 1 to 2 hour period that you were shopping, your asset quadrupled in value after already being up a lot. And you're sitting there shopping and you miss it. So during bull markets is when you want to be uneasy, when you want to be focused a lot, when you want to make sure that you're preparing to get out of your positions and secure your wealth. By now, I'm hoping that you're starting to see the psychology of it all. The way somebody does it wrong if they buy during the bull market and sell during the bear market. That is why I had to explain all that. That's why I say the majority is wrong, because the majority do this. So by knowing this, you already can give yourself an edge by just not doing what the majority does wrong. You don't buy high and sell low. You don't buy expensive and sell cheap. You buy when prices are down, and you sell when prices are up. It's really not that complicated, but most people will lack the mental fortitude in order to do it the correct way regardless. This is where it will take time, patience, and practice to retrain your thinking to play the market the right way. This is how I do it and have learned to do it from others that are successful. The list is too long. I have studied for a while now, and there's one thing I see repeatedly. The most successful people aren't being lucky. They're just being different from the majority. That doesn't mean that they're not smart, it just means that they have the proper investing psychology. Chapter 6. Building Wealth Over Time, the Compounding Journey. Now that I have taken the time to explain some of that, one thing we should talk about is building wealth. Like I might have mentioned earlier, building wealth takes time. One of the most simplest wealth building strategies is just successfully repeating what we just did in the previous chapters. In this chapter, what I want to focus on is building wealth over a longer period of time successfully, and there is more than one way to do this that the rich use, that the successful use. Let's just say you make $100,000 in the market in the example we were using previously. The first impulse you're going to have is to spend it all to celebrate your success. This is the wrong thing to do, unfortunately, and I don't want to be a downer. Building wealth can be hard. Sorry to state the obvious, but the way you do it successfully involves taking that $100,000 and reinvesting it in something that will grow it further, like another good investment. I'm not saying you would have to reinvest all of it. It's just the more of it you spend, the faster it will go, and the less you will have to multiply your money in the future. Making your money work for you. If you took the $100,000 and put it in a savings account, let's say it was earning 3% interest, that would be one way of growing it further. Not really the most ideal. Maybe through a slightly higher risk savings account, you could get something better like 12% or 16%. That's quite a bit better and a little bit more reasonable in terms of trying to grow it in the shortest amount of time. You could take part of that money and reinvest it in a business that eventually will pay the full amount of the money back. Then, upon making the $100,000 back or even part of it, if you use less to start the business, you will have a new asset in the form of that business that generates more cash for you in the future. So once you've made back your $100,000 off of a business, maybe it takes a year, maybe it takes 2 years, and your $100,000 has now made you another $100,000. Furthermore, now that business is a new asset of yours that is going to generate you another $100,000 in maybe 1 to 2 years again, so long as you can keep it maintained and running. If you can repeat this enough times, you will have so much cash flow you don't know what to do with it. Still, you have to start somewhere. Now, maybe the business side of things is not for everybody. If that is the case, the most likely wealth building strategy for somebody who doesn't want to put a lot of effort forward is through wise investing. Changing your mindset about building wealth. I want to break this mental chain of thought in your head. Building wealth is not hard. Get that out of your mind right now. Do not think that, or that will become your reality. If a man thinks a certain way, it is very likely going to affect the outcome of his future. For thoughts become emotions, and emotions can affect our habits and how we act in anything in life. So I want you to tell yourself, building wealth is easy, it just takes time. With enough time, anything can be possible, so hopefully, time is on your side. The younger you are, the more mistakes you can make and recover from those mistakes and learn from those mistakes. The older you get, the more set in your ways you become, and the harder it is to change. This is why we need more financial education at a younger age in order to help the youth be more financially literate. Like I said, we are our own worst enemy. Sometimes it is because of our own ignorance, we just don't know. Other times, it is self-sabotage. Just remember, you must learn yourself, know yourself. If you think something is going to trigger you, you're going to make the wrong decision. You either need to isolate the thing that might cause you to make the wrong decision or find a way to get past it so that it doesn't bother you whether it's there or not. The path to wealth is paved with consistency for the everyday average person, though building wealth can be easy with enough time, like I said. It's a matter of doing it over and over again successfully. It doesn't necessarily matter how much success you have, aka how much money you make off of any one investment. It's just a matter of repeating the process successfully over and over again. As you continue to reinvest and make money in the market, you can compound your profits over and over and over. Thus, even if you have some years where you make less and some years that you make more, because you're doing it successfully from bear market to bull market each time. As long as you are having even a little bit of success, you will grow your money over and over, thus building wealth. So the easy way would be just to reinvest your money following the method from earlier chapters, doing an in-depth analysis on everything that you are going to invest in. As long as you can pick some winners, Even if you have losers, your winners should outweigh your losses if you have followed the risk management part of the method correctly. The riskier the investment, the less I have in it, so the less I lose, but the potential to make money is still there. Sometimes those high-risk investments pay off very big and even outweigh the gains that you got in a safer investment. This is what they call diversity. You don't put all your investments in one basket. Though putting everything in one thing can pay off really big, it can also make you have a total loss of everything. So it is always good to be diverse, not to have too many investments, not to have too few. But over multiple market cycles, as long as you adhere to the psychology of not doing what the majority do, you will have more success than they do, and you will slowly grow your capital, aka your pile of money, over time, building wealth. It's such a simple concept, yet complex, to make money and grow it over time. The psychology of building wealth. Now to talk about the psychology of building wealth. Most people have the wrong wealth building psychology, so they are hindered from the beginning. Yes, there is psychology to building wealth. You must know thyself. You must know yourself very well because some things might trigger you and cause you to spend money. Other things might bother you slightly, and you don't do anything at first. As more things happen throughout the day, inevitably seeking comfort, you go blow some money on something to try and cheer yourself up. Every person is different, but we all have spending habits. Learning your own is important to building wealth successfully because you need to custom tailor your mindset to overcome your psychological shortcomings or inability to not spend money. To where you have control over your money so you're not wasting it on things you don't need or emotional buying or irrational buying or impulse buying. The habits of the successful and the wealthy are to feel uncomfortable about spending money and to feel comfortable and even good about saving money, growing your money, and investing your money. Normally, it is the opposite. People have that money burning a hole in their pocket. People normally feel really good about spending money, and it feels pleasurable even, and good and comfortable. You have to get that out of your head. You have to retrain your mind on that. That's part of the psychology of wealth building. You want to feel uncomfortable about spending money. You want it to be something that's not pleasurable. That way, you are less likely to impulse buy or buy something you don't need or just plain waste your money. Redirecting your spending impulses every time you think about buying something, and let's use an example, say, takeout food. Every time you think about blowing $20 on takeout food or $10 on a coffee, you have to think, oh, I really want to go buy that right now. But what I should do is invest that amount instead in one of my assets that I've done my own due diligence and research on. That's why so much depends on you and how fast you can change, how fast you can learn yourself. You have to recognize your own weaknesses and either overcome them or find a way around them so that they don't hinder you. In that scenario, every time you can successfully divert that impulse to go buy something into investing it instead, you are trying to take that positive good feeling you get from spending money on something that's going to make you feel better into spending that money on an investment that's going to make you feel better in the long run when it makes you more money. The $10 you put into an investment that could have bought you a coffee might buy you 100 coffees in the future or 1,000 coffees. The $20 you invest instead of buying takeout food maybe buys you 500 takeout meals in the future. This is all just probabilities and potential outcomes. A lot depends on yourself and also finding those high-quality assets to invest in the first place. There's no easy way to slice it. It's not easy finding the best things to invest in. But we're going to try and come to a place where we have the tools and the knowledge to decipher the potential of something. The journey is about continuous learning, like I said. Though, baby steps, we're going to go piece by piece, and as you continue reading, I hope you absorb the information. We need to get our thinking corrected or changed to a wealth-building thinking because that's the goal of this book, to teach you everything I have learned, including building wealth. With enough time and patience, you could go from nothing to millionaire, but that still depends on how well you do understanding everything, learning everything. There are never guarantees in life, only probabilities and potential outcomes. The idea is we just have to find more good probable outcomes than bad probable outcomes when it comes to investing. We have to get smart about managing our portfolio. You never want to feel like you've plateaued, like you've gotten there. You always want to be learning, you always want to grow your knowledge. By staying vigilant on learning about finances like I did and not ever giving up, just continuing to learn and grow your knowledge, you can succeed. Still, it takes effort on your part. You are the only one that will allow yourself to succeed in building your wealth. You're also the only person that can make yourself fail. You can't blame it on someone else. It is up to you to decide what you are going to do with your own money, and it is your own full responsibility how you handle it. Creating a plan and sticking to it, you have to have some confidence in yourself that you're going to do the right things. This is why it is important that you make a plan and you stick with it. That could look different for each person, but at some point, we will go over a mock plan in order to give you some sorts of ideas. By sticking with your plan, a plan that does not involve emotion, does not involve making mistakes, just involves following a set strategy, doing exactly what you plan on doing. Exactly when you plan on doing it, that way, you are less likely to get emotional and make a bad call and sell too early or sell too late. It may take some practice. The good news is practice makes perfect, and if you have time on your hands, there is plenty of time to practice with a paper account. A paper account is where you write everything down on paper, what you're investing in, how much you're investing in it. You watch it over multiple weeks and months, and you see the result of whether it went up or down. By doing it all on paper before you put any actual real money in, that will give you time to practice and determine whether you're on the right track. It'll also help you build confidence in your ability to invest successfully. It'll give you time to practice your psychological behaviors of investing. It'll also give you time to work out flaws in your strategies and plans for getting in and out of the market. You have to take this very seriously, as your very success depends on how seriously you take this. So give it a shot. Maybe even in between reading chapters of this book, now is a good time to start, any time is a good time. Building wealth, building habits anyways, back to wealth building, now that we understand that there is a psychology to it. We just need to retrain our brain to have wealth-building habits versus wealth-stealing habits. You do not want things draining your money. For some people, it's frivolous things. People go out and buy things they don't need. Some people buy collectibles, and I'm not judging. Maybe those collectibles will be worth something someday, but there are still better ways and faster ways of making money. So one of the things with wealth building that is very important is cash flow. This is what I am getting at. If more things are taking your money, you have negative cash flow. If fewer things are taking your money, you have positive cash flow. Cash flow is how much money you have beyond your bills. You always want to pay your expenses first, and your cash flow is what you have left over after all your expenses. Now, this is where people can free up cash flow. They stop buying their $10 coffees, they stop doing takeout food, doesn't have to be permanent, could be a few weeks in a row. A few months in a row. They quit buying things they don't need. Maybe they even cut back on how much they drive so they spend less on gas. There are many ways of generating extra cash flow just by not wasting your money. So it's important to learn your own spending habits so you can determine where you can make cuts to improve cash flow. The reason this is important is the more money you can free up, the more money you have for investing, the faster you will be able to get money into a quality investment. The faster you are going to generate your first chunk of money in order to start building your wealth. Learning from setbacks. This is why I say it is not hard to build wealth, it just takes time. Repeating the process successfully over and over and over. Even if you fail a few times or more along the way, eventually you can succeed. You will succeed if you keep at it. You just can't give up. Sometimes things are going to discourage you when you make mistakes. Don't let that make you give up. Again, you are your own worst enemy. Negative thoughts will drag you down if you let them because you have to choose. If someone went back and told me one thing when I was first investing, I would like it to be this. I know there's going to be ups and downs and difficult decisions and downright emotional times going through learning investing. Hang on, you will make it, but be patient. It's a learning process, and it takes time. A blade that is dull can still be sharpened and cut. After no time at all, you will have your first success, and you will feel great. Just don't let it go to your head. Stay focused and keep learning. It can be hard in the beginning, but the longer you spend time learning all these things, growing your knowledge, adapting your strategy, seeing what works for you and what doesn't work for you, you will inevitably find a way if you stick with it. That's why I stress patience. With enough time doing things right, you can grow wealthy easily. It just takes time if you want to do it easily. Accelerating your wealth building journey. If you want to build wealth faster, you have to put far more effort forward in terms of accelerating your strategy to do so. If I was trying to build wealth fast, I would be trying to start businesses that would pay me back over time, giving me my initial investment back and then becoming pure cash flow. Then, once they became pure cash flow, I would start investing part of that cash flow into either scaling the business or long-term investments like a bear market full of cheap assets to take compounded profits over multiple years and reinvest them at the right time to grow them further. I could make a lot of money really quickly, then give it a longer, sustained growth that way, in case the business at some point goes under or slows down. Money is inflated, so you never want to be just holding on to money because if you're just holding it, it's losing value. This is called inflation. The idea behind investing is that you want your investments to outpace inflation significantly so that you're actually growing your purchasing power versus losing it. That is another part of building wealth. You are going in reverse of inflation. You are outpacing inflation to where you gain purchasing power so that you can buy more with your money over your lifetime. By building wealth, you give yourself the optionality to live the best life that you can live, but that still depends on you. I can't stress this enough. It is so important you understand everything is up to you. What I offer you is purely financial education. If you don't understand it or do anything with the knowledge that you receive, you won't go anywhere because you choose to not go anywhere. The journey begins with a single step. I want you to be motivated. Don't wait till it gets hard in life like I did. Don't wait till you're struggling or backed in a corner to learn. There's going to be good times, there's going to be bad times, there's going to be times where it's hard to find money to invest, but you have to try. You have to start somewhere, and you have to repeatedly keep doing it over and over. When you start investing, it might feel weird at first. Once you get on a regular repertoire, it will just feel normal and a part of your life. In the long run, there are many ways to build wealth. To summarize, you need to know yourself very well so you don't hinder yourself from succeeding at building wealth. It's not just all numbers. Some people have won the lottery, but because they've had the wrong wealth building habits, the wrong market psychology, and just plain the wrong thinking. They blew all their money or lost it all and ended up becoming broke again and having to go back to work. Even selling all their expensive toys and possessions that they bought just to survive a little longer. True wealth comes from discipline. You don't get wealthy by lavishing luxury on yourself, by giving yourself everything. By buying up tons of luxury items and spending insane amounts of money on yourself. You get wealthy by making the tough calls, by managing your money successfully and carefully. You get wealthy by pinching pennies, even in the most difficult of times when it hurts to take that money and invest it after working weeks on end to get it. Even more so, it's harder week after week to keep investing that money while you watch it drop and you see your hard-earned money losing value in the short run. By the time it's all said and done and the market recovers, the value comes back. If you made the hard choices and the tough decisions and invested consistently, doing all the right things, not allowing your emotions or your environment even to hinder you from succeeding. Through perseverance, determination, and repetition, you can inevitably make it. You can create lasting wealth that will grow over time consistently so that you never have need of money again. And you can live modestly and reasonably and comfortably without having to struggle to have it. Success is a habit. It's all about making proper investing habits and psychology work for you and become your habit. It's about making success your habit. It's about making investing your habit. It's about making wealth building your habit. When it comes to building wealth, you have to look at yourself like a piece of clay. You just have to be molded the right way, and you can change and remold your mind and control your emotions so that you can succeed at building wealth. So that, for the most part, covers wealth building psychology and some of the strategies that someone might use to build wealth. It's really more of just repeating the process successfully. Creating a plan that works for you and sticking with it. Adjusting and adapting to the environment that you have to work with. For every person, it's going to be different because every person has different circumstances. Some people have good jobs, some people have no job. No matter where you are at in life, you have to start somewhere if you are going to build wealth. Everyone deserves financial freedom. It is my hope that you are reading this book now and that I can bestow my knowledge upon you to help you. Everybody has a fair chance. I know the world seems unfair, and it is at times. Unfortunately, most all of us are 100% responsible for ourselves. If we are not trying, we are not going to accomplish anything. If we take the time to journey into the unknown or further refine our skills and our knowledge in something we do know, we are better off than the person that tries not. So another tip about building wealth is you have to try. You cannot achieve if you do not try. Just know when you do try, you will have failure. The most important thing about failure is that we learn from it and not repeat it. Another principle of building wealth is learn from your failure. Failure is not the end, it is the lesson to be learned. Failure is something to help us grow and refine ourselves to be better. So when it gets challenging, don't give up, but start thinking. If there is a roadblock in your life, start thinking on how to overcome it. Know thyself. I am my enemy. Fear is a tool against me, and failure is my lesson. You can succeed, and you will succeed if you put your mind to it. Just don't give up. It takes time and effort. It's not all about the journey. Sometimes it's about the destination. Financial freedom means getting there is worth it, as I will have more freedom if I do things right. There is so much more we are going to be going over, so buckle up. It's time to grind on. Chapter 7. Understanding Fiat Currency and Inflation, the Hidden Tax on Your Wealth. In the next chapter, we are going to talk about creating income streams and what that looks like. For instance, if you are paid in a depreciating currency like fiat currency, dollars, euros, pounds, etc., what happens over any length of time is you get poorer. As fiat currencies historically do not last forever and do depreciate over time as more money is printed. For instance, let's use some small math. Let's say exactly $1 trillion exists. That's all the money that exists in all existence, hypothetically. This is to help you understand the concept of depreciating currency. So that $1 trillion basically is all the money in the economy, all the money that people own, divided up amongst people unevenly, of course. Because of the wealth gap and divide between different people's lifestyles. So let's say that the systems that control the fiat currencies says, let's double the money supply, it will be great. So the systems that exist double the money supply. This is what it looks like now. Maybe they give stimulus checks, giving 10% of that $1 trillion to everybody in the economy. And then they keep the other 90% for the system's programs. So hypothetically, that would be about $100 billion that goes towards stimulus checks towards all the people in this system. Since they're keeping 90% for their system's programs, though, that's not good for all the other people necessarily. Let's say hypothetically the programs of the system are government organizations that control various aspects of society, stuff like that. They basically just gave themselves a massive payday at the expense of everybody else in this small $1 trillion economy. Now that there is $2 trillion in this economy and only 10% of that was actually given to the people. Basically what happened is the fiat currency is now worth 50% less, so basically 50% inflation now that there is $2 trillion versus $1 trillion. The system that exists basically printed $1 trillion at the expense of the current $1 trillion being worth less by doubling the money supply. This is a simple example. An example, nonetheless. So the $1 trillion that was printed out of thin air steals from the value of the current existing $1 trillion. Who benefits from inflation? Let's go over this more extensively. Since 10% was given as stimulus to everybody evenly, that means $100 billion, or 10% of that trillion, went to the people. That does not evenly distribute the inflationary effect. At most, maybe it reduces the inflation by 5% for the people since they received a portion of the money. But now the system can do whatever it wants with the other 90%, effectively robbing everybody else to print that money. Since the everyday person received part of the stimulus, the 10% that went to the people, not everybody got 10%, it was spread out amongst everybody. To put this more plainly, let's use a different example of the same scenario to fully explain what I'm getting at. In this hypothetical scenario, 50% of the $1 trillion printed is distributed evenly to the economy, and only 50% is kept for the system that exists that does this. So instead of our previous example being 50% inflation since the money supply doubled, in this example, the money supply is also doubled. A $1 trillion economy has $1 trillion printed, thus doubling the money supply. In this example, though, 50% of that printed money is given to the citizens to compensate them for the money being printed. $500 billion is given as stimulus to the economy and the people in the economy evenly. Though the money supply doubled, because 50% of it went to compensating the citizens, the inflation ends up being 25%. Let's also use a third example where we reverse the example from the first example if that makes sense. Same scenario, $1 trillion economy, and $1 trillion is printed by the system that exists that has the power to do that. In this scenario, 10% of the printed money goes to, let's say, the governmental system that exists that controls the money printer. The other 90% of the $1 trillion, that's $900 billion, is given as stimulus to compensate those in the economy for printing the money. In this scenario, more of the money being printed is given to the people in the economy, less is given to the government. Effectively, what this means, though the money supply doubled, it didn't affect the people as badly because they received a majority of it. Think of it as the people in this $1 trillion economy were most compensated by the effects of the money printing. This created prosperity for those people because they were able to use that extra money on whatever they needed. So effectively, they had more money to compensate them for the change in the money supply, effectively creating only a 5% inflation rate for everybody, even though the money supply doubled. Because of just compensation to the people in the economy, it stole less value from their money that already exists in the economy. When money is printed, the people that receive the most of that printed money are the least affected by the change of the money supply. That's the takeaway. The people that receive the least amount of money when money is printed, changing the money supply, receiving little compensation. Those are the people that are most affected and have most of their purchasing power stolen from their fiat currency. Let's say there's no stimulus in an additional scenario. In this scenario, we're going to do things a little differently. It's a $1 trillion economy, and $10 trillion is printed. No money is given to the economy or to the people of the economy. Effectively, all of it goes to the system that exists, say a governmental system that controls the money printing. Effectively, this is a lot of inflation, reducing the purchasing power of the first $1 trillion in the economy by 90%. Do you see by my examples what I'm getting at? He who controls the money printer controls the inflation rate. We're here to talk about making income streams, though, but you have to understand fiat currency loses value over time. Preserving wealth through assets. So this is when we're going to talk about income streams through assets. It's good to understand, though, how inflation basically is the stealing of your purchasing power. Assets preserve purchasing power. An asset can be any number of things. Gold is a precious metal asset, just like silver. Stocks and bonds are financial assets. A savings account can be an asset, even if you're earning interest on a depreciating currency like fiat currency, dollars, euros, pounds. If you're earning an interest rate that pays more than the rate of inflation, usually that's not the case. Crypto digital assets are also assets, just in a digital format. Now, all sorts of assets can be used for generating interest, thus creating an income stream. For instance, let's just say hypothetically that you have $100,000 of gold. Let's say hypothetically this is before any future inflation happens. Maybe there is a way for you to earn an interest rate on the gold, let's say 10%. Let's also say that the gold at least keeps up with the rate of inflation to where it preserves your $100,000. So despite inflation going up over time, if you're earning a 10% steady return on that gold paid in gold, basically adding to your gold over time, you're effectively creating an income stream in an asset paid in an asset so that, over time that asset grows, preserving your wealth. Let me use an even clearer example that's easy to understand. The power of asset-denominated income. We're going to use a crypto example, as it will be most easy, ironically, to understand. I'm going to say this as simply and as plainly as I can. So let's say you have a crypto asset called Crypto A. You have $100,000 in Crypto A, the digital asset, and you put it into a decentralized finance platform to earn interest on it. Let's also hypothetically say that you are buying near the bottom of the market, so you're not worried about the downside. See previous chapters for information on that, as it's already been covered. So over time, you expect your $100,000 to become worth more in this speculative digital asset called Crypto A. Let's also say that though this project is speculative to some degree due to price fluctuations, despite all that, the project has very innovative technology that has the potential to change the world. It also can create value for the investors in the project as well as future investors that might become interested in the project. The project requires you to lock your money up for a multi-year period, let's say 2 years. I'm going somewhere with this, and it's going to be glorious when you realize what I'm telling you. So you lock your $100,000 that's in this asset called Crypto A, which is just an example name for this example. Anyways, you lock your money up for 2 years, and let's say the interest rate they pay you for that is 150% over 2 years. It is not normal for interest rates to be super consistent in crypto due to price fluctuations. However, for this example, to make it easier to understand, we're not going to have dynamic fluctuations for the interest rates. So now you have this crypto asset, which you expect to grow due to innovative technology. That creates growth upside for you in the overall value of the asset. One of the most important parts about this, though, is the interest you're paid is not paid in fiat. Your interest rate is paid in the very asset, crypto asset, that you have put into the smart contract to earn interest digitally. So basically, you're earning more of an appreciating asset. So as the asset becomes worth more, the interest that you're earning, like I said, stays consistently at 150%, right? The value of that interest payment that you receive is actually growing in value too. Comparing asset income to fiat income, so let's say, not related to this hypothetical example, if you were earning $10,000 a day in interest, and the asset you're earning goes up by 25%, the amount of interest you're earning in one day is now $12,500. So this is what I'm trying to get you to understand. When you are paid interest in an asset that goes up and down in price based on the fiat currency devaluation, there is the potential to make more money where most people traditionally work for fiat currency that loses value over time. So if you're working paycheck to paycheck, that's an income stream, but it's one that is paid out in fiat currency. Over time, even with getting paid more, you will still be poorer. If you are getting an income stream from a financial asset that is paid in that financial asset, over time, assets can grow in value based on the amount of fiat currency debasement. So let's go back to the example of the digital asset earning interest paid out in that digital asset. Your $100,000 of crypto asset grows over the 2-year period, let's say moderately. After 2 years, it's worth $150,000, a 50% increase in its value. Let's say that happened steadily over time during those 2 years. All the while, you were earning your fixed interest rate of 150% per year. I'm going to do some math to determine basically what the daily interest rate would be because it's nice to know. So basically, what this looks like is $100,000 by 150% equals $150,000. Sounds pretty great, right? Obviously, in real-life scenarios, interest rates fluctuate. For the sake of this example, proving a point about being paid in a financial asset, I had to do this example. So then you take that amount and divide it by 365 days, getting how much you would make daily, $410.95 a day of interest. Most digital platforms' interest payments can be collected at various times, say daily or weekly, maybe monthly or yearly. So let's say a couple months in, the asset's value of crypto asset goes up 10% and consistently stays up by that much. Now your daily amount that you're earning is 10% more because it's paid in an asset versus a depreciating fiat currency. So now you would be earning $452.05 a day, so effectively, you're earning 10% more. Though we are measuring things in dollars, the inflation rate is really the measurement of your purchasing power. The $100,000 you put to work in crypto asset is now worth $110,000, and your daily interest payment is worth $452.05. You're making way more money this way because you're gaining purchasing power at a time when the currency is likely being printed, devaluing the fiat currency, lowering your purchasing power. Using the method above, which is clearly just an example, earning in assets, a hedge against inflation, so at a time when the inflation rate is maybe 5%, hypothetically speaking, your asset not only preserved your purchasing power, it appreciated 5% against inflation. So your income is growing consistently against inflation. Also, though what you're earning daily, even though the interest rate is fixed at 150%, is higher still as the asset is worth 10% more. By the time the asset reaches being worth 50% more over the next year period, let's say, as we were saying previously, your $100,000 becomes $150. As crypto asset appreciates throughout the year. That is the 150% fixed interest rate per year, but your money is locked for 2 years like we were saying previously. Let's just say you spent all the interest you're earning, hypothetically speaking. A smart investor would reinvest the interest if possible. We'll cover that in a later chapter on compound interest. After 1 year, your $100,000 is now worth $150,000 from asset appreciation. Your daily interest payments also have increased by 50% since they are paid in the same asset that has appreciated by 50%, crypto asset. Your previous year's interest payments of $150,000, paid out daily throughout the year, are all gone because you spent it. Your financial assets are worth more, even though the interest rate is fixed at 150%. For the next year, ending your 2-year lockup, you're earning more because of the appreciation. So your daily interest payment is now worth this much, $616.43. This is because your asset is worth more. Since being paid in the same asset that is earning you money, it also has appreciated in value. If I was paid in gold and gold appreciated, my pay would be higher just because of that. If I was paid in dollars and they lose purchasing power over time, I'm consistently getting paid less unless my pay increases outpace inflation. So effectively, being paid through an income stream of an asset versus a fiat currency means that you benefit from inflation versus being hurt by it. Obviously, in real life, interest rates fluctuate on fluctuating assets. However, this also creates opportunity for interest rate spreads. That also will be covered in a future chapter. The power of interest rate spreads foreshadowing. A brief example of an interest rate spread is borrowing an asset for 2%, converting it to an asset that you can earn 20% on, and pocketing the difference. So long as you can borrow cheap and lend out for more. You basically do what a bank does to the everyday average person, being your own bank in a way. These are powerful concepts of decentralized finance, becoming your own bank, managing your own money effectively, earning the highest interest rate safely as you can, managing risk. Everything depends on you. Every person has to learn and decide for themselves what their risk tolerance is. Some people are too risky but still do well doing high risk, high reward investing. The opposite is true. Some people create multiple income streams through business or investing in financial assets that pay interest in order to gain more financial assets. Reinvesting into themselves or their business to grow their wealth more consistently over time, even if they make mistakes. Some people are low-risk, low-reward investors, managing the risk so tediously that they don't make a lot, but they consistently make money with very little risk of losing any. Regardless of which type of person you are, you must figure that out. You are your worst enemy or your best friend. The journey to financial freedom. It takes time to learn the concepts of building wealth. Giving up is not an option. Consistency is key. Over time, you will succeed. Everything depends on your commitment level, your resources, and how you use them and manage them wisely. You could have very little, be a high-risk, high-reward investor, manage it effectively, and become wealthy quickly. It's not the most likely scenario, but it is possible. Everything takes time, effort, consistency, and the willingness to learn. Make mistakes, letting failure teach you what not to do. Everyone is different. Not everything is going to work for the same person. Not everybody's going to have the same level of discipline with their finances. Are you looking at that coffee that they're making at Starbucks, and you just can't resist spending your money on it regularly? Could you cut that out of your life, knowing you could invest that money you're wasting at Starbucks into a financial asset that generates a return over time and grows over time? In some cases, it's as simple as living frugally, cutting stuff out of your life that effectively is a waste of your money. When you take this concept to heart, who knows? You might have an extra $100 a month you're just wasting on stuff that you could be investing every month, growing your wealth. We will cover many more concepts down the road in this book. The important takeaway from this chapter on digital assets generating an income stream through DeFi, decentralized finance. is to help you think about the difference between earning a living in an appreciating asset versus a depreciating asset. If you're only earning a fiat currency regularly, you're only going to get less wealthy over time. If you're earning an income stream through a financial asset that is paid in a financial asset, you likely will build wealth over time consistently as fiat currencies lose value. Chapter 8. Advanced Strategies, Leveraging Interest Rate Spreads. Understanding leverage. In this chapter, I'd like to explore a more advanced concept that can significantly accelerate your wealth building journey when used properly: leveraging interest rate spreads. Mr. J, an investor I've studied, explains it this way: ratio is 5 to 1, or basically 0. 20% borrowing. Collateral lending is 5 times what is borrowed. So if, say, you borrowed $1,000, you lend $5,000 as collateral, but the important part is what is borrowed is in a fixed-rate dollar loan. So say $5,000 of algo, a cryptocurrency, say if it was earning 10% interest earned as collateral, and you borrowed $1,000 for 20% interest owed. Basically, you swap borrowed dollars as USDC into algo and add to collateral. So it only really works if the market goes up over a bull run, but by doing that, it pushes it even more past 5 to 1 ratio. So think 1/5 of money owed at 20% and 5/5 plus extra converted USDC to algo at 10% times 5. As more than 5x the money earning less interest outweighs the total of borrowed money and interest owed. So you are getting more like 50% on algo to the 20% on borrowed USDC, basically getting the difference of 30% positive gain versus the borrow amount. So basically, if it makes sense, your collateral is so many multiples of what is borrowed. Since it also earns interest, it's like taking a long position that pays you interest, and as it goes up, total earned interest goes up as the total dollar value of assets grow. As USDC fixed-rate loan grows slowly, even at 20%, in a way to reverse it to make more sense for you, think the opposite is true too. So you can look at it backwards too. Think instead of multiplying percent on algo interest from 10% to 50%, think 20% divided by 5, which is 4%. For USDC loan amount, so it is like you're earning 10% on algo collateral to a realized net interest owed expense in comparison of 4%, so your net APY is 6% really. You can adjust ratio for higher return or less. Say you loan out 10 to 1, borrow rate could be 100% on USDC, but if lending rate on algo collateral is at least 11%, you're earning a real positive return as what you're lending out is 10 times as much as what's borrowed, plus borrowed amount conversion to algo added to collateral. So a stable 100% fixed rate USDC loan is really only 10% versus 11% on the majority of funds in the collateral account, earning positive interest. So net APY on loan/long position is 1%. This strategy, while complex, illustrates the power of understanding interest rate spreads and how they can be leveraged to accelerate wealth building. In the next chapters, we'll explore more strategies like this in detail, along with other powerful wealth building techniques. Let's continue our journey towards financial freedom. Financial Freedom Guide for Dummies, Part 2, Advanced Investment Strategies, Chapter 9. Mastering Technical Analysis, the language of charts. Now that we've covered the psychological aspects of investing and some fundamental strategies, it's time to develop your technical analysis skills further. Remember when I mentioned how charts tell a story about market psychology? Let's dive deeper into this language so you can become fluent in reading what the markets are really telling you. Technical analysis is essentially the study of historical price movements to predict future price action. While no method of prediction is perfect, becoming skilled at technical analysis gives you a tremendous edge in making informed investment decisions. Understanding candlestick patterns. Let's start with candlestick patterns, which originated in Japan centuries ago. A single candlestick shows you 4 key pieces of information: the opening price, the closing price, the highest price, and the lowest price during that time period. A green or white candle shows that the price closed higher than it opened, bullish, while a red or black candle shows that the price closed lower than it opened, bearish. The real body is the thick part of the candle, representing the range between opening and closing prices. The wicks, or shadows, are the thin lines extending from the body, showing the highest and lowest prices during that period. Some important candlestick patterns to recognize. 1. Doji, when the opening and closing prices are virtually the same, creating a cross-like appearance. This indicates indecision in the market and potentially a reversal. 2. Hammer, a bullish reversal pattern that forms during a downtrend. It has a small body at the top with a long lower shadow, suggesting that buyers are starting to overcome sellers. 3. Shooting star, the opposite of a hammer. It has a small body at the bottom with a long upper shadow, indicating that sellers are regaining control after prices peaked. 4. Engulfing patterns, when a larger candle completely engulfs the previous day's candle. A bullish engulfing pattern occurs in a downtrend when a green candle completely covers the previous red candle. A bearish engulfing pattern is the opposite. These patterns are signals, not guarantees. They're most reliable when confirmed by other indicators and market conditions. What makes them powerful is that they reflect the psychology of market participants: fear, greed, indecision, capitulation. Support and resistance levels. Next, let's talk about support and resistance levels, perhaps the most fundamental concept in technical analysis. Support is a price level where a downtrend is expected to pause due to a concentration of demand. As the price drops toward support and gets cheaper, buyers become more inclined to buy, and sellers become less willing to sell. This creates the support line. Resistance is the opposite, a price level where an uptrend is expected to pause temporarily due to a concentration of supply. As the price rises toward resistance, sellers become more inclined to sell, and buyers become less willing to buy. The more times a support or resistance level is tested without breaking, the stronger it becomes. However, when a support or resistance level is finally broken, the breakthrough is usually significant. A broken support level often becomes a new resistance level, and vice versa. Remember that story I told you about my early investing days? I used to panic and sell when prices dropped. What I didn't understand then was that often those drops were simply tests of support levels, not the beginning of catastrophic crashes. Trend lines, the roadmap of price movement. Trend lines are another essential tool. A trend line connects at least 2 price points on a chart, typically either peaks in a downtrend or valleys in an uptrend. These lines help visualize the direction of the market. To draw an uptrend line, connect at least 2 low points with a straight line. The second low must be higher than the first for it to be an uptrend. To draw a downtrend line, connect at least 2 high points with a straight line. The second high must be lower than the first. The longer a trend line has been in place and the more times it has been tested without breaking, the more significant it is. When a trend line is broken, it often signals a major change in market sentiment. Chart patterns. The big picture chart patterns form over longer periods and provide insights into potential large price movements. Here are some key patterns to recognize. 1. Head and shoulders, a bearish reversal pattern that looks like a head with 2 shoulders. It consists of 3 peaks, with the middle peak, the head, being the highest, and the 2 outer peaks, the shoulders, being lower and roughly equal in height. 2. Double top/bottom. A double top looks like the letter M, and signals a bearish reversal. A double bottom looks like the letter W and signals a bullish reversal. 3. Triangle patterns. These occur when prices converge with lower highs and higher lows. A symmetrical triangle represents indecision. An ascending triangle, flat top, rising bottom, usually breaks upward. A descending triangle, flat bottom, declining top, usually breaks downward. 4. Cup and handle. A bullish continuation pattern that looks like a teacup on the chart. The cup forms after a downtrend as the price rounds upward, and the handle forms as the price trades sideways or slightly downward, setting up for an upward breakout. 5. The falling wedge. This is the pattern I mentioned earlier that has about a 68% chance to break to the upside. It forms when price makes lower lows and lower highs, but the lows are falling faster than the highs, creating a narrowing channel that slopes downward. Volume. The force behind price movements. Never underestimate the importance of volume in technical analysis. Volume is the number of shares or contracts traded in a security or market during a given period. It's a measure of activity and interest. When analyzing volume, remember these principles. Volume should confirm the trend. In an uptrend, volume should increase as prices rise and decrease as prices fall. Volume often spikes at market tops and bottoms as emotion reaches extremes. A price movement with relatively high volume is more significant than a similar move with weak volume. Many amateur investors ignore volume, but it's often the key to confirming whether a price movement is legitimate or just a temporary fluctuation. Moving averages. Smoothing the noise. Moving averages smooth out price data to create a single flowing line, making it easier to identify the direction of the trend. The two most common types are: 1. Simple moving average, SMA, calculates the average price over a specific number of periods. 2. Exponential moving average, EMA, gives more weight to recent prices, making it more responsive to new information. Moving averages are often used to identify support and resistance levels and to confirm trend directions. When a shorter-term moving average, like the 50-day, crosses above a longer-term moving average, like the 200-day, it's called a golden cross and is considered bullish. The opposite, a death cross, is considered bearish. Oscillators. Measuring momentum. Oscillators help identify overbought or oversold conditions in the market. Here are 3 common ones. 1. Relative Strength Index, RSI, measures the speed and change of price movements on a scale from 0 to 100. Traditionally, an RSI above 70 indicates an overbought condition and a possible downward correction, while an RSI below 30 indicates an oversold condition and a possible upward correction. 2. Moving Average Convergence Divergence, MACD, shows the relationship between two moving averages of a security's price. A MACD crossing above its signal line is a bullish signal, while crossing below is bearish. 3. Stochastic Oscillator, compares a closing price to its price range over a given time period. The idea is that in an uptrend, prices tend to close near their highs, and in a downtrend, prices tend to close near their lows. Putting it all together, a technical analysis workflow. I know this is a lot to absorb, so here's a step-by-step process for analyzing a chart. 1. Identify the overall trend, uptrend, downtrend, or sideways, using longer-term moving averages. 2. Locate key support and resistance levels. 3. Look for significant chart patterns that may be forming. 4. Check volume to confirm the strength of price movements. 5. Use oscillators to identify potential reversal points. 6. Examine candlestick patterns for short-term trading signals. 7. Draw trend lines to visualize the path of least resistance. Remember, technical analysis is both an art and a science. It takes practice to develop your eye for patterns and to know which indicators to trust in different market conditions. Technical analysis in practice. A real example. Let me walk you through a real-world example of how I'd analyze a chart. Imagine we're looking at a Bitcoin chart during a bear market phase. The price has been declining for months, hitting a series of lower highs and lower lows. But recently, we notice it's starting to form a falling wedge pattern. Those lower highs and lower lows are converging. The RSI is showing readings below 30, indicating the asset might be oversold. Volume has been declining during this downtrend, suggesting selling pressure may be waning. And we notice a series of hammer candlesticks forming near a previous support level from 2 years ago. All these signals together, the falling wedge, oversold RSI, declining volume in a downtrend, hammer candlesticks at historical support, suggest a potential reversal might be coming. This would be an opportunity to start accumulating, not with all your capital at once, but gradually using dollar cost averaging. This is how technical analysis complements the psychological approach we discussed earlier. When everyone else is fearful and the chart is showing potential reversal signals, that's when the best opportunities often arise. The limitations of technical analysis. While technical analysis is powerful, it has limitations. It works best in markets with sufficient liquidity and trading volume. It also assumes that history tends to repeat itself, which isn't always the case, especially when unprecedented events occur. That's why I always combine technical analysis with fundamental analysis and an understanding of broader economic trends. The charts tell you what is happening and potentially what might happen next, but fundamental analysis tells you why it's happening. In the next chapter, we'll explore how to build a diversified investment portfolio that can withstand market turbulence while maximizing your returns. Chapter 10. Building a diversified investment portfolio, the foundation of financial security. We've talked about the psychology of investing and how to read the markets. But now we need to discuss exactly what to invest in. Building a properly diversified portfolio is critical to long-term success and financial stability. Remember when I mentioned that even high-risk investments can be part of a good strategy? That only works when they're balanced within a diversified portfolio. Diversification is essentially the investment world's version of "don't put all your eggs in one basket." But true diversification goes beyond just owning different stocks or different cryptocurrencies. It means owning different asset classes that respond differently to various economic conditions. Understanding asset classes. Let's break down the major asset classes and what role they play in a portfolio. 1. Stocks, equities, represent ownership in companies and offer growth potential and sometimes dividends. Stocks tend to perform well during periods of economic expansion and moderate inflation. 2. Bonds, fixed income, essentially loans to governments or corporations that pay interest. Bonds typically provide stability and income, performing better when interest rates are falling or during economic uncertainty. 3. Cash and cash equivalents, includes money market funds, CDs, and treasury bills. These provide liquidity and safety but usually low returns that may not keep pace with inflation. 4. Real estate, property investments, either direct ownership or through rights, real estate investment trusts. Real estate can provide both income and appreciation, often serving as an inflation hedge. 5. Commodities, physical goods like gold, silver, oil, and agricultural products. These often move independently of stocks and bonds and can perform well during inflationary periods. 6. Alternative investments, includes private equity, venture capital, hedge funds, cryptocurrencies, and collectibles. These can offer higher returns but typically with higher risk and less liquidity. The magic of correlation. The real power of diversification comes from understanding correlation. the degree to which different assets move in relation to each other. Assets with high positive correlation tend to move in the same direction at the same time. Assets with negative correlation tend to move in opposite directions. Assets with zero correlation move independently of each other. The goal is to combine assets with different correlations to smooth out your portfolio's performance. When one asset is down, another might be up, reducing overall volatility and potentially improving risk-adjusted returns. For example, historically, when stocks fall sharply during economic crises, high-quality government bonds often rise in value as investors seek safety and central banks cut interest rates. Gold has also traditionally performed well during times of financial stress or high inflation. Strategic asset allocation. Your personal asset allocation, how much of your portfolio you dedicate to each asset class, should be based on three main factors. 1. Your time horizon, how long until you need the money. Longer time horizons can accommodate more aggressive allocations. 2. Your risk tolerance, how well can you emotionally and financially handle market downturns? Be honest with yourself about this. 3. Your financial goals, are you saving for retirement, a house, education, or financial independence? Different goals might require different strategies. A traditional starting point is the 60/40 portfolio, 60% stocks and 40% bonds. This has historically provided a good balance of growth and stability. But this is just a starting point and may not be right for everyone. A younger investor with a high risk tolerance and a long time horizon might consider 80% stocks, 10% bonds, and 10% alternatives. An older investor nearing retirement might prefer 40% stocks, 50% bonds, and 10% cash. Modern portfolio theory. Finding the efficient frontier. One framework for thinking about diversification is modern portfolio theory, MPT, developed by Harry Markowitz in 1952. MPT suggests that for any given level of risk, there's an optimal asset allocation that maximizes expected returns. Similarly, for any given expected return, there's an allocation that minimizes risk. The efficient frontier represents the set of optimal portfolios that provide the highest expected return for a given level of risk. Portfolios below the frontier are suboptimal because they don't provide enough return for the level of risk taken. While MPT has its limitations, particularly its reliance on historical data, the core insight remains valuable. Diversification can potentially improve returns while reducing risk. Tactical asset allocation. Adjusting for market conditions while strategic asset allocation sets your long-term investment mix. Tactical asset allocation involves making shorter-term adjustments based on market conditions. Remember our discussions about market cycles? This is where that knowledge comes into play. During late-stage bull markets, when valuations are stretched and the fear and greed index is showing extreme greed, you might temporarily reduce your exposure to more speculative assets. Conversely, during bear markets when quality assets are available at discount prices, you might gradually increase your exposure to growth assets, always remembering to dollar cost average rather than invest all at once. Geographic diversification. The world is your oyster. Another dimension of diversification is geographic. Many investors suffer from home country bias, investing mostly in companies from their own country. But global diversification can reduce risk and capture growth opportunities in different economic cycles. Developed markets, like the US, Europe, and Japan, typically offer more stability, while emerging markets, like parts of Asia, Latin America, and Africa, often present higher growth potential but with greater volatility. Different regions also have different industry strengths. The US is strong in technology and services, Europe in luxury goods and pharmaceuticals, Japan in robotics and electronics, and emerging markets often in natural resources and manufacturing. Diversification within asset classes. Beyond diversifying across asset classes, it's important to diversify within each asset class. Within stocks, diversify across different sectors, technology, healthcare, financial, consumer, etc. Market capitalizations, large, mid, small, investment styles, growth versus value, and geographies. Within bonds, diversify across different issuers, government, municipal, corporate, credit qualities, investment grade versus high yield, and durations, short-term, intermediate, long-term. Within real estate, diversify across different property types, residential, commercial, industrial, and regions. Within cryptocurrencies, if you venture into this space, diversify across different types, store of value coins, utility tokens, platform tokens. Rather than concentrating in just one digital asset. The case for index funds and ETFs. For most investors, especially beginners, index funds and exchange-traded funds, ETFs, offer an excellent way to achieve diversification with low costs and minimal effort. An index fund simply tracks a market index, like the S&P 500 for large U.S. companies or the MSCI World for global stocks. By owning an index fund, you instantly gain exposure to hundreds or thousands of companies in a single investment. ETFs are similar but trade on exchanges like stocks, offering greater flexibility. There are ETFs for almost every asset class, sector, strategy, and region imaginable. The beauty of index investing is that it removes the need to pick individual winners, which is notoriously difficult even for professionals. Instead, you're essentially saying, I believe this entire segment of the market will grow over time. Portfolio rebalancing. Maintaining your target allocation. Once you've established your asset allocation, market movements will naturally cause it to drift over time. Rebalancing involves periodically adjusting your portfolio back to your target allocation. For example, if your target is 60% stocks and 40% bonds, but after a strong bull market in stocks your portfolio has shifted to 70% stocks and 30% bonds. Rebalancing would involve selling some stocks and buying more bonds. Rebalancing serves two purposes. It keeps your risk level consistent with your plan, and it enforces a buy low, sell high discipline. You're systematically taking profits from assets that have performed well and reinvesting in assets that have lagged. Most financial advisors recommend rebalancing either on a schedule, annually or semi-annually, or when your allocation drifts more than a certain percentage from your targets, say 5% or more. Sample portfolio models. Let me give you some concrete examples of diversified portfolios for different types of investors. Conservative portfolio, lower risk, income focused. 30% large cap stocks, 10% international stocks, 40% investment grade bonds, 10% high yield bonds, 5% real estate, 5% gold. This portfolio prioritizes capital preservation and income. Suitable for someone near or in retirement. Moderate portfolio, balanced risk and return. 35% large cap stocks, 15% small/mid cap stocks, 15% international stocks, 25% investment grade bonds, 5% real estate, 3% gold, 2%. Cryptocurrencies. This balanced approach suits someone with a medium-term horizon. 7 to 15 years. Aggressive portfolio, higher risk, growth-focused. 40% large cap stocks, 20% small/mid cap stocks, 20% international stocks, 10% investment grade bonds, 5% real estate, 5% cryptocurrencies. This growth-oriented portfolio is designed for younger investors with a long time horizon. 15+ years and high risk tolerance. A word on concentration versus diversification. While diversification reduces risk, it also limits the potential for outsized returns. As the saying goes, diversification is protection against ignorance. Some of the world's most successful investors, like Warren Buffett, have made their fortunes through concentrated positions in businesses they deeply understand. However, this approach requires exceptional insight, discipline, and often access to information or opportunities that most retail investors don't have. For most people, a well-diversified portfolio with perhaps a few carefully chosen concentrated positions, what I call core and explore, offers the best balance of reasonable growth potential and downside protection. The evolution of your portfolio shouldn't remain static throughout your life. As your circumstances change, so should your investment strategy. Typically, investors should become more conservative as they approach their goal, especially retirement. This principle is captured in the common guideline that the percentage of bonds in your portfolio should roughly equal your age, though this is just a rule of thumb, not a rigid formula. However, even in retirement, maintaining some exposure to growth assets is important to counter inflation and longevity risk, the risk of outliving your money. In the next chapter, we'll explore how to adjust your asset allocation based on market conditions to maximize returns while managing risk. Chapter 11. Mastering Asset Allocation Across Market Cycles. Surfing the economic waves. In previous chapters, we discussed the psychology of market cycles and how to build a diversified portfolio. Now, let's combine these concepts to develop a dynamic asset allocation strategy that adapts to changing market conditions. Think of the economy as an ocean with regular tides and occasional storms. Different boats, asset classes, respond differently to these conditions. By understanding which vessels work best in each environment, you can navigate more safely and efficiently toward your financial destination. The 4 phases of the economic cycle. Economic cycles typically move through 4 phases, each with different implications for various asset classes. 1. Early expansion, recovery. The economy begins growing again after a recession. Interest rates are low, business activity is picking up, and consumer confidence is improving. 2. Mid-cycle, full expansion. The economy is hitting its stride with strong growth, improving employment, and rising corporate profits. Central banks may begin raising interest rates to prevent overheating. 3. Late cycle, slowdown. The economy is still growing but at a decelerating rate. Inflation often increases, interest rates are typically higher, and there are signs of excess in certain sectors. 4. Recession, contraction, economic activity declines, unemployment rises, corporate profits fall, and central banks usually cut interest rates to stimulate growth. Asset performance across the cycle. Different assets tend to perform better or worse depending on where we are in the economic cycle. Early expansion. Small cap stocks often outperform cyclical sectors like consumer discretionary, industrials, and basic materials typically do well. High-yield bonds can see strong returns. Commodities may begin to recover mid-cycle. Large-cap stocks usually perform well. Technology and financial sectors often outperform. Real estate typically appreciates. Most equity categories generally deliver solid returns late cycle. Defensive sectors like utilities, healthcare, and consumer staples tend to outperform. Inflation-protected securities become more attractive. Commodities, especially precious metals, often do well. Value stocks may outperform growth stocks. Recession. Government bonds typically outperform. Cash becomes more valuable for preserving capital. Defensive sectors usually decline less than the broader market. Gold often serves as a safe haven. Reading the signs. Economic indicators. To adjust your asset allocation effectively, you need to recognize where we are in the cycle. Here are key indicators to monitor. 1. Yield curve, the difference between long-term and short-term interest rates. An inverted yield curve, when short-term rates exceed long-term rates, has historically preceded recessions. 2. Leading economic indicators, metrics that tend to shift before the broader economy, such as building permits, weekly jobless claims, and manufacturing orders. 3. Unemployment rate, particularly the trend and rate of change, not just the absolute level. 4. Corporate profit margins tend to peak before the economy enters a recession. 5. Inflation rates, particularly core inflation, excluding food and energy, and wage inflation. 6. Credit spreads, the difference in yield between corporate bonds and government bonds of similar maturity. Widening spreads often signal increasing economic stress. Remember what I said about the psychology of investing. Most investors react to these indicators after they've already fully manifested. The savvy investor looks for early signs of change and positions accordingly. Tactical asset allocation in practice. Here's how you might adjust your asset allocation based on where you believe we are in the economic cycle. Early expansion strategy. Overweight small and mid-cap stocks, increase allocation to emerging markets, add high-yield bonds, reduce cash positions, begin building positions in commodities. Mid-cycle strategy. Maintain a balanced approach close to your strategic allocation. Ensure broad diversification across sectors. Consider adding real estate investments. Maintain normal cash reserves. Late cycle strategy. Shift toward larger, higher quality companies, increase allocation to defensive sectors, add inflation-protected securities, consider reducing overall equity exposure, increase precious metals allocation. Recession strategy. Increase high-quality government bonds, raise cash levels for future opportunities, focus on companies with strong balance sheets and stable earnings, consider defensive alternative strategies. Prepare your shopping list for when markets bottom. The investor's calendar. Seasonal patterns. Beyond economic cycles, there are also seasonal patterns that can inform your asset allocation. January effect. Small cap stocks have historically outperformed in January. Sell in May and go away. Markets have historically performed better from November through April than from May through October. September slump. September has historically been the worst month for stocks. Santa Claus rally. The last 5 trading days of December and the first 2 of January have historically shown strong performance. While these patterns don't hold every year, they represent tendencies that can inform marginal adjustments to your allocation. Case study. Navigating the 2020 COVID crash and recovery. Let me walk you through how an investor might have adjusted their asset allocation during the 2020 COVID crash and subsequent recovery. Pre-crash, late cycle, January 2020. Signs of a late cycle economy were present. A prudent investor might have already reduced equity exposure slightly, increased allocation to quality bonds, maintained some defensive positions. Crash period. March 2020. As markets plummeted, the investor recognizes this as an exogenous shock, not a typical cycle end. After the initial drop, begins systematically deploying cash reserves, focuses on quality companies with strong balance sheets, adds to positions in sectors likely to benefit from lockdowns, technology, e-commerce. Early recovery. April to December 2020. Recognizes the massive fiscal and monetary stimulus as fuel for asset prices, increases equity allocation, particularly in technology and digital economy companies, maintains some commodity exposure as inflation hedge, begins looking for reopening plays for future rotation. Later recovery, 2021. Rotates partially from growth to value as recovery broadens, increases international exposure, reduces duration in bond holdings as interest rates begin to rise, maintains inflation hedges due to Supply chain issues and stimulus. This example illustrates how combining cycle awareness with tactical allocation adjustments can help navigate even unprecedented market environments. Balancing tactical and strategic approaches. While tactical asset allocation can enhance returns, it's important to maintain a balance with your long-term strategic allocation. Here are some guidelines. 1. Set boundaries. Decide in advance how far you'll deviate from your strategic allocation. For example, if your strategic equity allocation is 60%, you might allow it to range from 50 to 70% based on tactical considerations. 2. Implement gradually. Make incremental changes rather than dramatic shifts. This reduces the impact of timing errors. 3. Focus on asset classes, not individual securities. Tactical allocation works best at the asset class level. Picking individual winners consistently is much more difficult. 4. Document your reasoning. Write down why you're making each tactical shift. This creates accountability and helps you learn from both successes and mistakes. 5. Maintain core holdings. Consider keeping 70 to 80% of your portfolio aligned with your strategic allocation and using only 20 to 30% for tactical adjustments. The tax implications of tactical allocation. One challenge with tactical asset allocation is that frequent adjustments can trigger tax consequences in taxable accounts. Some strategies to mitigate this include making tactical shifts primarily within tax-advantaged accounts like IRAs and 401(k)s, using ETFs rather than mutual funds for greater tax efficiency, considering tax loss harvesting to offset gains from tactical reallocations, using new contributions to adjust your allocation. Rather than selling existing positions. The role of cash in tactical allocation. Cash deserves special mention in a tactical allocation strategy. Beyond providing safety and liquidity, cash serves as dry powder to deploy when opportunities arise. During late cycle and recessionary periods, increasing your cash allocation can both protect capital and position you to take advantage of depressed prices. The key is having the discipline to actually deploy that cash when others are fearful, as we discussed in our psychology chapters. Remember Warren Buffett's advice: be fearful when others are greedy, and greedy when others are fearful. Cash gives you the means to act on this wisdom. In the next chapter, we'll explore specific strategies for cryptocurrency investing, an emerging asset class with unique characteristics and opportunities. Chapter 12: Cryptocurrency Strategies for Wealth Building. Understanding the digital frontier. Cryptocurrencies represent one of the most revolutionary and volatile asset classes to emerge in decades. While they carry significant risks, they also offer tremendous potential for wealth creation when approached with the right strategy and mindset. In this chapter, we'll explore how to incorporate cryptocurrencies into your investment portfolio responsibly while taking advantage of some of the unique opportunities they present. Remember that this space moves incredibly quickly, so always do your own research before implementing any strategy. Bitcoin, digital gold and portfolio diversifier. Bitcoin was the first cryptocurrency and remains the largest by market capitalization. Often called digital gold, Bitcoin shares some characteristics with the precious metal: limited supply, only 21 million Bitcoin will ever exist. Not controlled by any government or central bank. Store of value properties, potential hedge against currency devaluation. Bitcoin's primary use case has evolved to become a store of value and potential inflation hedge rather than a day-to-day payment system. Its price appreciation since creation has been remarkable, despite experiencing multiple 80% plus drawdowns along the way. For most investors, Bitcoin represents the safest entry point into cryptocurrencies. Its longevity, network security, brand recognition, and institutional adoption make it less speculative than most other digital assets. A common approach is to allocate a small percentage of your portfolio to Bitcoin, perhaps 1 to 5% depending on your risk tolerance and conviction. This provides enough exposure to meaningfully impact your returns if Bitcoin continues its growth trajectory, while limiting downside risk to your overall financial position. Ethereum and smart contract platforms beyond Bitcoin lies Ethereum, the second largest cryptocurrency by market cap. While Bitcoin focuses primarily on being digital money, Ethereum created a platform for decentralized applications using smart contracts, self-executing contracts with the terms directly written into code. Ethereum enables decentralized finance, DeFi, applications, non-fungible tokens, NFTs, decentralized autonomous organizations, DAOs, and many other use cases. Investing in Ethereum is essentially betting on the growth of this entire ecosystem. Other smart contract platforms like Solana, Avalanche, and Polkadot compete with Ethereum, each with different technical approaches and trade-offs. When investing in smart contract platforms, consider developer activity and adoption, transaction costs and speeds, security history and audits, roadmap and technological improvements, token economics and value capture. DeFi. Decentralized finance opportunities. Decentralized finance, or DeFi, refers to financial services built on blockchain technology that operate without centralized intermediaries like banks. This includes lending platforms, exchanges, insurance products, and more. DeFi presents unique opportunities for generating yield on crypto assets, often at rates far exceeding traditional finance. However, with higher returns come higher risks, including smart contract vulnerabilities, liquidation risks in lending platforms, impermanent loss in liquidity provision, regulatory uncertainty, protocol governance risks for those willing to accept these risks. Here are some DeFi strategies to consider. Staking. Many cryptocurrencies use proof-of-stake consensus mechanisms where token holders can stake their assets to help secure the network and earn rewards. This is relatively lower risk compared to other DeFi activities, often yielding 4 to 12% annually depending on the blockchain. Yield farming. This involves providing liquidity to decentralized exchanges or lending platforms to earn rewards in the form of interest and / or governance tokens. While yields can be extraordinarily high, sometimes advertised at 100% plus APY, they typically come with corresponding risks and may not be sustainable. Liquidity provision. By providing liquidity to decentralized exchanges, you earn a share of trading fees. This strategy works best in sideways markets with high trading volume but carries impermanent loss risk if asset prices move significantly in one direction. Navigating bull and bear markets in cryptocurrency markets tend to move in extreme cycles, with bull markets seeing parabolic gains and bear markets experiencing devastating drawdowns. Successfully navigating these cycles is crucial for long-term success. Bear market strategies. Dollar cost average into quality projects with strong fundamentals. Earn yield on your holdings through staking or lending. Focus on accumulation rather than price action. Research projects thoroughly while sentiment is negative. Maintain cash reserves to capitalize on potential further drops. Bull market strategies. Take profits gradually as prices rise dramatically. Move some gains to stablecoins or fiat. Shift from more speculative projects to established ones. Be increasingly skeptical as euphoria builds. Remember the fear and greed principle we discussed earlier. The challenge with crypto bull markets is knowing when to sell. One approach is to establish price targets or market cap milestones in advance, then commit to taking some profits when those are reached. For example, you might decide to sell 10% of your holdings when Bitcoin reaches $100,000, another 20% at $150,000, and so on. Having this plan before prices skyrocket helps counter the greed that inevitably sets in during parabolic moves. Security and risk management in cryptocurrency. The saying, "Not your keys, not your coins," emphasizes the importance of security in cryptocurrency investing. Here are essential security practices. 1. Hardware wallets. For significant holdings, use cold storage devices like Ledger or Trezor that keep your private keys offline. 2. Seed phrase security. Store your recovery phrase, typically 12 or 24 words, in a secure, offline location, never digitally. 3. Exchange selection. If using exchanges, choose reputable platforms with strong security track records and proof of reserves. 4. Two-factor authentication. Always use 2FA, preferably not SMS-based, for exchange accounts and wallets. 5. Transaction verification. Double-check addresses before sending crypto transactions. They cannot be reversed. 6. Diversification across storage methods. Consider using multiple storage solutions rather than keeping everything in one place. Beyond security, general risk management principles apply even more strongly in crypto due to its volatility. Only invest what you can afford to lose. Diversify across multiple projects. Consider your portfolio allocation to crypto as a whole. Be especially wary of projects promising guaranteed returns. Avoid taking on excessive leverage. Building a balanced crypto portfolio. A balanced cryptocurrency portfolio might include 1. Large cap assets, 50 to 70%, Bitcoin, Ethereum, and other established projects with multi-year track records and broad adoption. 2. Mid-cap assets, 20 to 30%, projects with significant adoption and unique value propositions in specialized areas of the ecosystem. 3. Small cap assets, 0 to 20%, higher risk, higher reward projects with promising technology but less established adoption. Only for those with higher risk tolerance. 4. Stablecoins, 10 to 20%, cryptocurrencies pegged to fiat currencies, providing stability and optionality to deploy during market corrections. This allocation would change based on market conditions, more heavily weighted towards stablecoins during late-stage bull markets or when valuations appear stretched, and more weighted toward growth assets during bear markets or early recovery phases. Fundamental analysis in cryptocurrency. While cryptocurrency remains a largely speculative market, fundamental analysis can help identify projects with staying power. Consider these factors. 1. Network effects and adoption metrics, active addresses, transaction volume, total value locked, developer activity. 2. Token economics, supply schedule, inflation rate, token utility, value accrual mechanisms. 3. Team and development activity, experience of core team, GitHub commits, roadmap progress. 4. Market size and problem solved. Is the project addressing a real need with a large potential market? 5. Competitive advantage. What makes this project better than alternatives or potential future competitors? 6. Regulatory considerations. How vulnerable is the project to regulatory changes? Remember that in nascent markets like cryptocurrency, narratives often drive prices in the short term, but fundamentals tend to matter more over the long run. Getting started in cryptocurrency. If you're new to cryptocurrency, here's a step-by-step approach to getting started. 1. Education first. Spend time learning about blockchain technology, Bitcoin, and the overall ecosystem before investing. 2. Start small. Begin with a small amount you can afford to lose entirely. 3. Focus on blue chips. Make your first purchases Bitcoin and Ethereum rather than more speculative assets. 4. Use established exchanges. Begin with well-known, regulated exchanges with good security practices. 5. Learn about wallets, understand the difference between custodial and non-custodial solutions. 6. Practice transactions. Send small amounts between wallets to understand how transactions work. 7. Gradually expand knowledge. As you become more comfortable, explore other aspects of the ecosystem like DeFi. The future of cryptocurrency investing. The cryptocurrency space continues to evolve rapidly. Areas to watch include institutional adoption, banks, hedge funds, and corporations entering the space, regulatory developments, how governments and regulators approach digital assets, Layer 2 scaling solutions, technologies that improve blockchain scalability and efficiency, central bank digital currencies, CBDCs, government-issued digital currencies and their impact on the ecosystem, Web3 and the metaverse, the next evolution of the internet with integrated digital ownership, tokenization of real-world assets, bringing traditional assets like real estate onto the blockchain. In the next chapter, we'll discuss another powerful wealth-building tool, real estate investing. Chapter 13. Real estate as a wealth-building tool. The timeless asset real estate has been a cornerstone of wealth creation for centuries. Unlike many other investments, real estate combines multiple wealth-building components: potential appreciation, income generation, tax advantages, and leverage opportunities. In this chapter, we'll explore various approaches to real estate investing and how to incorporate this asset class into your wealth-building strategy. Why real estate works for building wealth. Real estate offers several unique advantages as an investment. 1. Tangible value. Unlike stocks or digital assets, real estate is a physical asset with intrinsic utility. People always need places to live and work. 2. Income generation. Rental properties can provide steady cash flow, unlike many other appreciating assets. 3. Leverage. Real estate allows you to control a large asset with a relatively small initial investment, down payment. 4. Tax benefits. From mortgage interest deductions to depreciation, real estate offers numerous tax advantages. 5. Inflation hedge. Real estate has historically kept pace with or exceeded inflation rates over the long term. 6. Forced appreciation. Unlike other assets, you can actively increase a property's value through improvements and management. 7. Multiple exit strategies. Properties can be sold, rented, subdivided, repurposed, or passed to heirs. Getting started. Different approaches to real estate investing. There's no single, right way to invest in real estate. Here are several approaches, ranging from passive to active. REITs, real estate investment trusts, publicly traded companies that own and operate income-producing real estate. REITs allow you to invest in real estate without buying physical property, similar to how stock investing works. Real estate crowdfunding, platforms that allow you to invest in specific real estate projects with relatively small amounts of capital, often starting at $1,000, $10,000. Rental properties, purchasing residential or commercial properties to rent out for monthly income. This is what most people think of when considering real estate investing. Fix and flip, buying distressed properties, renovating them, and selling at a profit. This requires more expertise and active involvement. Wholesaling, finding discounted properties and assigning the purchase contract to another buyer for a fee. This requires no capital but demands hustle and market knowledge. Land development, purchasing raw land to develop or hold for future appreciation. This is generally more speculative and longer term. Commercial real estate, investing in office buildings, retail spaces, industrial properties, or multi-family dwellings, apartments. Often requires more capital but can offer stronger returns. The approach you choose should align with your financial situation, time availability, expertise, and temperament. Many successful real estate investors start small and scale up over time. Understanding real estate economics. To invest successfully in real estate, you need to understand the key factors that drive property values and rental rates. Supply and demand. The fundamental economic principle applies strongly to real estate. Areas with growing populations and limited housing supply tend to see increasing property values. Location. The three most important factors in real estate have always been location, location, location. Proximity to jobs, amenities, good schools, and transportation drives value. Interest rates. Lower rates typically increase buying power and property values, while higher rates do the opposite. Economic trends. Local job growth, industry diversity, and income levels strongly influence real estate markets. Demographics. Population trends, age distribution, and household formation rates impact housing demand. Development regulations. Zoning laws, building codes, and development restrictions affect housing supply and pricing. Infrastructure. Planned improvements in transportation, utilities, and public facilities can significantly impact property values. Running the numbers. Key financial metrics. Real estate investment decisions should be driven by careful analysis, not emotion. Here are the key metrics to evaluate. 1. Cash-on-cash return, annual cash flow divided by your total cash invested. This measures the yield on your invested capital. 2. Cap rate, capitalization rate, net operating income divided by property value. This helps compare properties independent of financing. 3. Gross rent multiplier, GRM, property price divided by annual gross rental income. A quick screening tool for rental properties. 4. Cash flow, the money remaining after all expenses and mortgage payments. Positive cash flow provides both income and a safety margin. 5. Net operating income, NOI, gross income minus operating expenses, excluding mortgage payments. This reveals a property's intrinsic earning power. 6. Internal rate of return, IRR, the annualized return accounting for all cash flows, including purchase, rental income, and eventual sale. 7. 1% rule, a quick screening tool suggesting that monthly rent should be at least 1% of the purchase price for a potential rental property. Let's look at a simplified example of analyzing a potential rental property. Property, 3-bedroom single-family home. Purchase price, $200,000 down payment, 20%, $40. 000 closing costs, $5,000 renovation costs, $10,000 total investment, $55,000 monthly figures, rental income, $2,000 mortgage payment, $960 property taxes, $200 insurance, $100 maintenance, 1% of value annually, $167 property management, 10% of rent. $200 vacancy allowance, 5% of rent, $100 total monthly expenses, $1, 727 monthly cash flow, $273 key metrics, annual cash flow, $3. 276 cash on cash return, 6%, $3, 276 $55,000, cap rate, 5. 2%, $2012, $200 plus $100 plus $167 plus $200 plus $100, 12, $200,000, GRM, 8. 3, $200,000, 2012. This property passes the 1% rule. Monthly rent is 1% of purchase price and generates positive cash flow, making it potentially worth considering. Financing strategies for real estate. One of real estate's most powerful features is the ability to use leverage, borrowed money, to control valuable assets. Here are common financing approaches: conventional mortgages, traditional bank loans requiring 20 to 25% down payment for investment properties. These typically offer the best interest rates. FHA loans, government-backed loans with lower down payment requirements, 3.5%, but only available for owner-occupied properties, though multi-units allow you to rent out the other units. VA loans, available to veterans with no down payment required, but also for owner-occupied properties only. Seller financing, the property seller acts as the lender, often with more flexible terms than conventional financing. Private money, loans from individuals rather than institutions, typically at higher interest rates but with more flexibility. Hard money, short-term, asset-based loans with higher interest rates, commonly used for fix and flip projects. Home equity loans/lines, using equity in your primary residence to finance investment properties. Portfolio loans, loans that lenders keep on their own books rather than selling to secondary markets, allowing for more flexible qualification criteria. Creative financing, strategies like lease options, subject to deals, or assuming existing mortgages. The right financing approach depends on your credit profile, available capital, investment strategy, and risk tolerance. Remember that while leverage amplifies returns, it also amplifies risks. Building a real estate portfolio as you progress in your real estate investing journey, consider these strategies for building a sustainable portfolio. 1. Start small, begin with properties you can comfortably afford and manage. A single-family home or small multi-family property is often ideal for beginners. 2. Reinvest profits, use cash flow and appreciation from early properties to fund expansion rather than increasing your lifestyle spending. 3. Diversify within real estate, spread risk by investing in different property types, locations, and price points. 4. Scale strategically. As your portfolio grows, systems and teams become essential. Consider property managers, maintenance crews, and eventually asset managers. 5. Refinance to recapture equity. When properties appreciate, consider cash-out refinancing to fund additional purchases while maintaining cash flow. 6. Value-add opportunities. Look for properties where relatively simple improvements can significantly increase value or rental income. 7. 1031 exchanges. Use these tax-deferred exchanges to sell properties and reinvest in larger or more profitable ones without immediate tax consequences. Common real estate investing mistakes to avoid. Like any investment, real estate comes with potential pitfalls. Here are common mistakes to avoid. 1. Inadequate research, failing to thoroughly understand the local market, rental demand, and neighborhood trends. 2. Underestimating expenses, overlooking costs like maintenance, vacancies, capital expenditures, and property management. 3. Emotional decisions, buying because you love a property rather than because the numbers work. 4. Overleveraging, taking on too much debt, leaving yourself vulnerable to market downturns or vacancies. 5. Deferred maintenance, neglecting repairs to save money, which usually leads to bigger expenses and tenant problems later. 6. Poor tenant screening, accepting questionable tenants out of desperation to fill vacancies. 7. Inadequate insurance, not having the right coverage for potential disasters or liability issues. 8. Ignoring exit strategies, failing to consider how you'll eventually dispose of the property or adapt if market conditions change. 9. DIY everything, trying to handle all aspects of property management yourself, even when your time would be better spent elsewhere. 10. Analysis paralysis, researching endlessly without taking action. Perfect information is impossible. At some point, you must make decisions with the best available data. Real estate in different market conditions. Real estate strategies should adapt to changing market conditions, just like other investments, in rising markets. Focus on appreciation potential. Consider higher leverage to maximize returns. Look for emerging neighborhoods with growth indicators. Be cautious of overpaying in hot markets. Consider selling fully appreciated properties to redeploy capital in flat markets. Emphasize cash flow over appreciation. Look for value-add opportunities to manufacture equity. Focus on expense reduction to improve returns. Consider offering lease options to capture additional income. Implement rent increases where justified by market conditions in declining markets. Be extremely selective with purchases. Demand significant discounts to account for continued depreciation. Ensure very strong cash flow to weather potential vacancies. Consider different property types that might better hold value. Maintain higher cash reserves for unexpected issues. Remember, real estate markets are highly localized. One city might be booming while another is declining. This creates opportunities for the informed investor who can identify trends before they become obvious to everyone. REITs and real estate stocks. Passive real estate exposure for those who want real estate exposure without directly owning property. Publicly traded real estate investment vehicles offer an attractive alternative. Equity REITs own and operate income-producing real estate in sectors like residential, office, retail, industrial, healthcare, and more. Mortgage REITs provide financing for real estate by purchasing or originating mortgages and mortgage-backed securities. Hybrid REITs combine strategies of both equity and mortgage REITs. Real estate operating companies, publicly traded companies in real estate development, management, or services. The advantages of these investments include liquidity, can be bought and sold quickly. Professional management, diversification across many properties, low minimum investment, no direct management responsibilities, regular dividend income. REITs must distribute 90% of taxable income, however, they lack some benefits of direct ownership. Less control over investment decisions, no ability to use leverage as effectively, potentially lower overall returns, correlation with broader stock market movements, no ability to force appreciation through improvements for many investors. A combination approach works well, using REITs for diversification and ease while also owning some direct real estate for higher returns and tax benefits. Real estate in your overall financial strategy. How should real estate fit into your broader wealth building plan? Consider these guidelines. 1. Balance with other investments. While real estate is powerful, maintain diversification across asset classes based on your goals and risk tolerance. 2. Consider your time horizon. Real estate typically works best as a medium to long-term investment, 5+ years, due to high transaction costs and the power of compounding appreciation. 3. Match strategy to life stage. Younger investors might focus on higher growth, higher effort strategies, while those near retirement might prioritize stable cash flow with minimal management requirements. 4. Use real estate for tax planning, leverage depreciation, mortgage interest deductions, 1031 exchanges, and other tax benefits strategically. 5. Plan for liquidity needs. Unlike stocks, real estate cannot be quickly converted to cash without significant discounting. Maintain other liquid investments for emergencies and opportunities. In the next chapter, we'll explore another essential aspect of successful investing: understanding and interpreting financial information to make better decisions. Chapter 14. Financial Literacy. Understanding the numbers, the language of money. Financial literacy is the foundation upon which all successful wealth-building strategies rest. Without understanding how to read and interpret financial information, you'll be making decisions in the dark. This chapter will equip you with the essential knowledge to understand financial statements, market metrics, and performance indicators. Personal financial statements. Let's start with your own financial picture. There are two fundamental personal financial statements everyone should maintain. Net worth statement, balance sheet. This statement shows what you own, assets, minus what you owe. Liabilities, giving you your net worth. It's a snapshot of your financial position at a specific point in time. Assets typically include cash and bank accounts, investment accounts, retirement accounts, real estate equity, vehicles, personal property of significant value. Liabilities typically include mortgage debt, auto loans, student loans, credit card debt, personal loans, other obligations. Your net worth is simply assets minus liabilities. Tracking this number over time gives you a clear picture of whether you're building or eroding wealth. Cash flow statement, income statement. This tracks your income and expenses over a period, typically monthly. It shows where your money comes from and where it goes. Income sources typically include salary and wages, business income, investment income, dividends, interest, capital gains, rental income. Side hustles or gig work. Expenses typically include housing, mortgage/rent, utilities, maintenance, transportation, food, insurance, debt payments, discretionary spending, taxes. The difference between income and expenses is your cash flow. Positive cash flow means you're living within your means and have money to save and invest. Negative cash flow means you're spending more than you earn, often by increasing debt. Understanding business financial statements. Whether you're evaluating stocks or analyzing a potential business purchase, understanding basic business financial statements is crucial. Income statement, profit and loss. This shows a company's revenues, expenses, and profits over a specific period. Key components include revenue, top line, the total money earned from sales before any expenses, cost of goods sold, COGS. Direct costs associated with producing goods/services, gross profit, revenue minus COGS, operating expenses, costs of running the business, salaries, rent, marketing, etc. Operating income, gross profit minus operating expenses, interest, taxes, and other items, net income, bottom line. The final profit after all expenses. Important metrics derived from the income statement include gross margin equals gross profit revenue, operating margin equals operating income revenue, net profit margin equals net income revenue. Balance sheet, like your personal net worth statement. A business balance sheet shows assets, liabilities, and the resulting equity at a specific point in time. It follows the fundamental accounting equation. Assets equals liabilities plus equity. Assets include current assets, cash, inventory, accounts receivable, long-term assets, property, equipment, investments, intangible assets, patents, trademarks, goodwill. Liabilities include current liabilities, accounts payable, short-term debt, long-term liabilities, loans, bonds, leases. Equity represents the owner's stake in the business, including paid-in capital, money invested by shareholders, retained earnings, accumulated profits. Key metrics from the balance sheet include current ratio equals current assets, current liabilities, debt to equity ratio equals total debt, shareholders' equity, return on equity, ROE, equals net income, shareholders' equity. Cash flow statement. This tracks the actual cash moving in and out of a business, categorized into 1. Operating activities, cash generated from core business operations. 2. Investing activities, cash used for / provided by investments in assets. 3. Financing activities, cash from debt, equity issuance, dividends, etc. The cash flow statement explains why a company's cash position changed during the period and is critical for assessing financial health. A business can show profits on the income statement but still face cash flow problems. Key investment metrics and ratios when evaluating investments, particularly stocks. These metrics help inform your decisions. Price to earnings, P/E. Ratio, the stock price divided by earnings per share, indicating how much investors are willing to pay for each dollar of earnings. Lower P/E ratios may indicate better value, but context matters. Price to book, P/B. Ratio, the stock price divided by book value per share, assets minus liabilities per share. Lower P/B ratios might indicate undervaluation, especially for asset-heavy businesses. Price to sales, P/S, ratio, the stock price divided by revenue per share. Useful for comparing companies that aren't yet profitable. Dividend yield, annual dividends per share divided by the stock price, showing the percentage return from dividends alone. Return on investment, ROI, the gain or loss on an investment relative to its cost, expressed as a percentage. Return on assets, ROA, net income divided by total assets, measuring how efficiently a company uses its assets to generate profits. Debt to EBITDA ratio, total debt divided by earnings before interest, taxes, depreciation, and amortization, indicating debt load relative to operating performance. Free cash flow, FCF, operating cash flow minus capital expenditures, showing how much cash a business generates after maintaining/expanding its asset base. Reading economic indicators beyond company-specific metrics. Broad economic indicators help you understand the environment in which you're investing. Gross domestic product, GDP. The total value of goods and services produced within a country's borders, usually measured quarterly and annually. GDP growth typically correlates with corporate earnings growth. Unemployment rate, the percentage of the labor force without jobs but actively seeking employment. Lower is generally better for the economy, but extremely low unemployment can lead to wage inflation. Consumer Price Index, CPI, measures changes in the price level of a basket of consumer goods and services, the most common gauge of inflation. Producer Price Index, PPI, measures average changes in selling prices received by domestic producers, often a leading indicator for CPI. Housing starts, the number of new residential construction projects beginning in a given period, a leading indicator of economic health. Consumer confidence, survey-based measure of optimism about the economy, which tends to influence consumer spending patterns. Purchasing Managers Index, PMI, survey-based measure of manufacturing or service sector activity. Readings above 50 indicate expansion, below 50 indicate contraction. Federal funds rate, the interest rate at which banks lend to each other overnight, controlled by the Federal Reserve and influencing all other interest rates in the economy. Yield curve, the relationship between bond yields and their time to maturity. An inverted yield curve, short-term rates higher than long-term, has historically preceded recessions. Understanding risk metrics. Assessing risk is just as important as evaluating potential returns. Key risk metrics include standard deviation, measures the dispersion of returns around the average, indicating volatility. Higher standard deviation means greater volatility. Beta measures a stock's volatility relative to the market. A beta of 1 means the stock moves with the market. Higher than 1 means greater volatility. Less than 1 means lower volatility. Sharpe ratio, returns in excess of the risk-free rate divided by standard deviation, measuring risk-adjusted returns. Higher is better. Maximum drawdown, the largest percentage drop from peak to trough during a specific period, showing worst-case historical losses. Value at risk, VAR, an estimate of the potential loss in value of an asset or portfolio over a defined period for a given confidence interval. The art of financial interpretation. Understanding the numbers is only half the battle. Interpreting what they mean in context is what separates average investors from exceptional ones. Consider these principles. 1. Trends matter more than single data points. Look at metrics over time rather than in isolation. The direction and rate of change often tell a more important story than absolute values. 2. Context is critical. Numbers mean different things in different industries, market conditions, and economic environments. A P/E ratio of 20 might be expensive for a mature utility but cheap for a growing technology company. 3. Qualitative factors matter too. Financial metrics tell only part of the story. Management quality, competitive positioning, industry disruption, and other qualitative factors can be equally important. 4. Be aware of financial engineering. Companies can manipulate earnings through accounting choices, one-time charges, and other techniques. Focus on cash flow trends, which are harder to manipulate. 5. Compare like with like. When comparing companies, ensure you're making valid comparisons between businesses in similar situations. 6. Understand the limitations. All financial metrics have limitations and can be misleading in certain contexts. Using multiple metrics provides a more complete picture. Building your financial intelligence. Developing financial literacy is an ongoing journey, not a destination. Here are strategies to continuously improve your financial intelligence. 1. Read annual reports. These contain a wealth of information beyond the numbers, including management's perspective on business conditions and future plans. 2. Study investor presentations. These often present key metrics and strategies in a more accessible format than formal financial statements. 3. Follow economic news. Developing an understanding of broader economic trends provides context for investment decisions. 4. Take advantage of educational resources. Many brokerages offer free educational materials on financial analysis. Websites like Khan Academy and Coursera also offer excellent courses. 5. Practice analysis. Start analyzing companies in which you're already invested or interested. The more you practice, the more intuitive financial analysis becomes. 6. Join investment clubs or communities. Discussing financial concepts with others accelerates learning and exposes you to different perspectives. 7. Follow financial experts. Many successful investors share their analytical approaches through books, articles, or social media. In the next part of our guide, we'll explore how to create and optimize multiple income streams, a critical strategy for accelerating your path to financial freedom. Financial Freedom Guide for Dummies, Part 3, Income Stream Creation and Wealth Acceleration, Chapter 15. The Power of Multiple Income Streams Beyond the Paycheck in Our Journey Toward Financial Freedom. We've covered investing psychology, market cycles, diversification, and specific asset classes. Now it's time to address a fundamental truth. True financial freedom rarely comes from a single source of income. The wealthy understand that relying on one income stream, typically a job, creates vulnerability and limits wealth-building potential. Instead, they build multiple income streams that work together to create financial stability and accelerated wealth growth. Why multiple income streams matter? There are several compelling reasons to develop multiple income streams. 1. Risk mitigation. If one income source disappears, like losing a job, you have others to sustain you. 2. Wealth acceleration. Additional income can be invested, creating a powerful compounding effect. 3. Tax efficiency. Different income sources may receive different tax treatment, allowing for optimization. 4. Lifestyle flexibility. Some income streams can be location independent, freeing you to live and work anywhere. 5. Retirement security. Multiple income streams reduce reliance on traditional retirement accounts. 6. Opportunity expansion. Each new income stream often reveals additional opportunities not previously visible. 7. Personal fulfillment. Diverse income sources can allow you to pursue different interests and skills. The 7 types of income streams. Income streams generally fall into 7 categories. 1. Earned income. Money from working, salary, wages, commissions, tips. 2. Business income. Profits from a business you own or participate in. 3. Interest income. Money from lending, savings accounts, bonds, loans. 4. Dividend income. Distributions from company ownership, stocks, mutual funds. 5. Rental income. Money from leasing property or assets. 6. Capital gains. Profits from selling assets at a higher price than purchased. 7. Royalty/licensing income. Payments for using your intellectual property. Most people start with earned income and gradually build other streams. The path to financial freedom involves shifting from predominantly earned income, trading time for money, to predominantly passive income, money working for you. Active versus passive income. Finding the right balance. Income streams exist on a spectrum from completely active, requiring your direct, ongoing involvement, to completely passive, requiring little to no ongoing effort. Understanding this spectrum helps you build a balanced portfolio of income sources. Fully active income. Traditional job or employment, self-employment in service businesses, consulting or freelancing. Active trading. Semi-active income. Running a business with employees, real estate with property management, content creation with established audience, network marketing with a developed team. Semi-passive income. Investment properties with property managers, established online businesses with systems, dividend stock portfolios, membership sites with automated content. Mostly passive income. Index fund investments, bonds and fixed income investments, royalties from books, music, patents, silent business partnerships. The goal isn't necessarily to have only passive income, but rather to build a mix that meets your financial needs while aligning with your skills, interests, and lifestyle preferences. Starting where you are. Building your first additional income stream. No matter your current situation, you can begin building additional income streams. The key is to start small, leverage existing skills or assets, and reinvest early profits to grow. If you're employed full-time, consider these relatively low time commitment options. 1. Dividend investing. Start building a portfolio of quality dividend-paying stocks or funds. 2. Rental property. A single rental unit can be managed with minimal time commitment, especially with professional management. 3. Side hustle based on existing skills. Use your professional skills to consult or freelance on evenings or weekends. 4. Content creation. Write, create videos, or podcast about topics where you have expertise. 5. Peer-to-peer lending. Platforms allow you to lend money to individuals or businesses for interest returns. 6. Affiliate marketing. Recommend products or services you already use and earn commissions. 7. Print on demand or drop shipping. Create designs or curate products that others manufacture and ship for you. The key is picking something aligned with your strengths, interests, and schedule constraints. Start small, learn the fundamentals, and scale gradually. Case study. Sarah's income stream journey. Let me share a real-world example of how building multiple income streams can transform your financial life. Sarah started as a marketing manager earning $75,000 annually. After reading about multiple income streams, she decided to start building additional sources. Year 1. Sarah invested $10,000 in dividend stocks yielding 3%, $300/year. and started a marketing blog sharing her expertise, which generated $200/month from advertising and affiliate links by year-end. Year 2, she reinvested all dividend income, added $15,000 from her salary to her dividend portfolio, now generating $1,050/year. Grew her blog income to $500/month, and created a digital marketing course that generated $5,000 in sales. Year 3, Sarah's dividend income grew to $1,800/year. Her blog generated $1,000/month, course sales reached $15,000 annually. And she saved enough for a down payment on a small rental property that produced $300/month in positive cash flow after all expenses. Year 5, with her growing side income, Sarah negotiated a 4-day workweek at her job, reducing her salary to $65,000 but giving her more time. Her income streams now included salary, $65,000/year, dividends, $4,500/year, blog and affiliate income, $24,000/year, course sales, $40,000/year, rental property, $5,400/year. Her total income had grown to nearly $139,000, almost double her original salary, with significantly more freedom and security. More importantly, several of these income streams would continue even if she stopped working actively. The snowball effect of multiple income streams. When you build multiple income streams, a fascinating acceleration happens. 1. Cross-collateralization. Income from one stream can fund the growth of another. 2. Skill transfer. What you learn building one income stream often helps with others. 3. Network expansion. Each venture introduces you to new people who can help with other income streams. 4. Opportunity recognition. Your awareness of opportunities increases as you gain experience with different income models. 5. Risk tolerance growth. Success with initial streams often increases comfort with pursuing larger opportunities. The result is that building multiple income streams becomes easier over time, not harder. The first additional stream is usually the most difficult. Each subsequent one typically comes more quickly. Strategic income stream development. As you develop multiple income streams, consider these strategic principles. 1. Complementary skills. Choose income streams that leverage similar skills or knowledge to maximize efficiency. 2. Counter-cyclical sources. Select income streams that don't all suffer during the same economic conditions. 3. Scalability potential. Prioritize streams that can grow substantially without proportional increases in your time. 4. Automation possibilities. Look for opportunities to systematize and automate aspects of each income stream. 5. Reinvestment planning. Decide in advance how much of each income stream will be reinvested versus spent. 6. Exit strategies. Consider how you might eventually sell or transition away from each income stream if desired. 7. Tax efficiency. Structure different income streams to maximize tax advantages, consulting your tax professional. Time management for multiple income streams. One of the biggest challenges with multiple income streams is managing your time effectively. These strategies can help. 1. Batching similar tasks. Group similar activities across different income streams to improve efficiency. 2. Time blocking. Dedicate specific time periods to specific income streams rather than constantly switching. 3. Automation and outsourcing. Use technology and team members to handle repetitive tasks. 4. Regular review and pruning. Periodically evaluate all income streams and cut those with poor return on time invested. 5. Focus on highest ROI activities. Within each income stream, identify the 20% of activities that produce 80% of results. 6. Seasonal focusing. Some income streams may require more attention at certain times of year. Plan accordingly. 7. Single tasking. Give full attention to one income stream at a time rather than multitasking ineffectively. Remember, the goal isn't necessarily to have as many income streams as possible, but rather to have the right mix that maximizes your financial results while fitting your lifestyle. In the next chapter, we'll explore how to build and scale business ventures, one of the most powerful income streams for building significant wealth. Chapter 16. Business Ownership and Scaling Strategies. The entrepreneurial advantage throughout history. Business ownership has created more millionaires and billionaires than any other wealth-building strategy. While not everyone needs to become an entrepreneur to achieve financial freedom, understanding business principles gives you powerful options for accelerating your journey. In this chapter, we'll explore both traditional and modern business models, strategies for starting with minimal risk, and approaches to scaling once you've found success. Understanding business models. A business model is simply how a company creates value, delivers it to customers, and captures some of that value as profit. Let's examine some proven models. Product-based businesses, physical product manufacturing or sourcing, software or digital products, information products, courses, books, etc. Service-based businesses, professional services, consulting, legal, accounting, creative services, design, writing, production, personal services, coaching, training, advising. Hybrid businesses, software as a service, SaaS. Product with ongoing service, productized services, standardized services sold like products, freemium models, free basic version with paid premium options. Marketplace businesses, connecting buyers and sellers, taking a percentage of transactions, adding value through curation. Verification, or guarantees. Subscription businesses, recurring revenue for ongoing access, content subscriptions, product subscriptions, monthly boxes, replenishment, service subscriptions. Maintenance, support, access, advertising/attention businesses, creating content that attracts an audience, monetizing that attention through advertising. Examples include media companies, blogs, YouTube channels. The business model you choose should align with your skills, resources, interests, and risk tolerance. Many successful entrepreneurs have tested multiple models before finding their ideal match. Starting small. The minimum viable business. One of the biggest mistakes aspiring entrepreneurs make is trying to build a perfect, full-featured business from day one. This approach typically leads to overwhelm, excessive risk, and failure. Instead, consider the concept of a minimum viable business, MVB, the smallest version of your business idea that can generate revenue and prove your concept. This approach allows you to 1. Test market demand before significant investment. 2. Generate early revenue that can fund further development. 3. Gather real customer feedback to guide improvements. 4. Develop business skills with manageable complexity. 5. Maintain income security by starting part-time if necessary. Examples of MVBs include a consultant taking on one client in their spare time, a drop shipping store with just 5 to 10 carefully selected products, a software creator offering a limited feature set to early adopters, a content creator publishing on free platforms before building a dedicated site, a service provider offering just their core service before expanding. The MVB approach reduces risk while still allowing you to learn and grow. Many of today's largest companies started as tiny operations focused on doing one thing well. The side hustle to business bridge. If you're currently employed, a side hustle can be the perfect bridge to business ownership. This approach allows you to 1. Develop business skills while maintaining financial security. 2. Test your idea without betting your livelihood. 3. Build a customer base before going full-time. 4. Accumulate startup capital from side hustle profits. 5. Discover if you enjoy the actual work of the business. Keys to side hustle success include clear boundaries, separate time for your job, side hustle, and personal life, ethical considerations, ensure no conflicts with your employment, focus, choose one promising idea rather than multiple ventures, systems, create efficient processes from the beginning, growth mindset, treat it as a real business, not just a hobby. Many side hustles naturally reveal whether they have the potential to become full-time businesses based on their growth trajectory and your enjoyment of the work. Business acquisition. Buying instead of building. Building a business from scratch isn't the only path to business ownership. Acquiring an existing business can offer significant advantages. 1. Immediate cash flow from established operations. 2. Existing customer base instead of starting from zero. 3. Proven business model with demonstrated viability. 4. Systems and processes already in place. 5. Trained staff who know the business. 6. Potential seller financing that reduces capital requirements. Small business acquisitions are often more accessible than most people realize. Sources for finding businesses include business brokers, online marketplaces like BizBuySell or Empire Flippers, direct outreach to business owners in your areas of interest, networking with accountants, attorneys, and bankers who know when owners are considering selling, industry associations and chambers of commerce. Even with modest savings, you might be able to acquire a business through SBA loans with 10 to 20% down payment, seller financing where the owner accepts payments over time, earn-outs where a portion of the purchase price depends on future performance, partnership arrangements where you bring skills the business needs. Digital business models. For the modern era, the internet has created extraordinary opportunities for building businesses with low startup costs, location independence, and unlimited scaling potential. Consider these digital business models: e-commerce, drop shipping, selling products shipped directly from suppliers, private label, your brand on manufactured products, digital products, courses, templates, software, art, handmade products sold through online platforms, content creation, blogging with affiliate marketing, advertising, or premium content, YouTube channels monetized through ads, sponsorships, or complementary products, podcasting with sponsorships or supporting products/services, social media influence monetized through brand deals or product promotion. Digital services. Freelancing on platforms like Upwork or Fiverr, agency services for businesses. Marketing, design, development, consulting delivered via video conferencing, coaching or teaching through online platforms. Software and apps, SaaS, software as a service, with recurring subscription revenue. Mobile applications with purchase, subscription, or freemium models, WordPress plugins, themes, or digital tools for specific markets, API services that other businesses can integrate with their systems. Membership and community, subscription communities around specific interests or goals. Paid newsletters with specialized information, online courses with community components, professional networks with exclusive benefits. These digital models often require less capital, allow for location independence, and can scale more efficiently than traditional brick-and-mortar businesses. The Business Growth Matrix. 4 ways to scale. Once you've established a viable business, there are 4 primary dimensions for scaling. 1. More customers, expanding your customer base through marketing, referrals, and new channels. 2. Higher transaction value, increasing the average amount each customer spends per purchase through upselling, cross-selling, or premium offerings. 3. Greater purchase frequency, encouraging customers to buy more often through subscriptions, loyalty programs, or regular engagement. 4. New revenue streams, adding complementary products or services that appeal to your existing customer base. The most effective growth strategies typically involve working on all four dimensions simultaneously. For example, marketing brings in new customers. Dimension 1. Sales training helps team members increase average order value. Dimension 2. A loyalty program increases purchase frequency. Dimension 3. Market research identifies new products your customers want. Dimension 4. As you plan your growth strategy, consider which dimension currently represents your biggest opportunity with the least effort or investment. Leverage points in business scaling. Certain strategic leverage points can dramatically accelerate business growth. Team building. Hiring for key positions that multiply your effectiveness. Building systems that allow others to replicate your results. Creating a culture that attracts and retains top talent. Strategic partnerships, joint ventures with complementary businesses, affiliate relationships that expand marketing reach, licensing arrangements that extend your brand, distribution partnerships that access new markets, technology and automation, customer relationship management systems, marketing automation tools, production or fulfillment automation, administrative process automation, intellectual property development, patents that protect unique innovations, trademarks that strengthen brand value, copyrights that protect creative assets, systems and processes that can be franchised or licensed. Financial engineering, strategic use of debt to fund growth, restructuring for tax efficiency, implementing financial systems that improve cash flow, performance-based compensation structures. The right leverage points for your business depend on your industry, business model, growth stage, and personal strengths. Common business scaling pitfalls to avoid. As businesses grow, they often encounter predictable challenges. Being aware of these potential pitfalls can help you navigate them successfully. 1. Premature scaling, adding costs, staff, office space, inventory, before revenue justifies them. 2. Cash flow crises, growing without sufficient working capital to support increased operations. 3. Quality decline, expanding too quickly to maintain the standards that made the business successful. 4. Culture dilution, losing the core values and environment as the team expands. 5. Founder bottlenecks, failing to delegate effectively, causing the owner to become the limitation to growth. 6. Market misreading, assuming larger markets have the same needs and characteristics as your core market. 7. Systems failure, continuing to use processes designed for a smaller operation. 8. Competitive blindness, attracting competitive responses as you become more visible in your market. The best protection against these pitfalls is awareness, planning, mentorship from those who've navigated similar growth, and building a strong team with complementary skills. Exit strategies. The ultimate business leverage. Many entrepreneurs never consider their exit strategy until they're ready to leave their business. This is a mistake that can cost millions in unrealized value. Consider potential exit paths from the beginning. Strategic sale, selling to a larger company in your industry that can leverage your assets, customer base, technology, team, etc. Financial buyer, selling to a private equity firm or individual investor interested in cash flow and growth potential. Management buyout, selling to your existing management team, often with financial backing from investors. Family succession, transferring ownership to family members, either through gifting or sale. Initial public offering, IPO, taking your company public by selling shares on a stock exchange, typically only for larger businesses. Acqui-hire, being acquired primarily for your team's talent and expertise. Earn-out, gradually transitioning ownership based on the business meeting future performance targets. The exit you choose impacts virtually every aspect of how you build your business. For example, if you're building for a strategic sale, you might focus on developing proprietary technology or securing market share in a niche that larger companies want to enter. If you're building for family succession, you might prioritize sustainable processes and conservative growth. Business as a wealth multiplication tool. Even if you never intend to build a large company, business ownership offers unique wealth-building advantages. 1. Tax efficiency. Legitimate business expenses reduce taxable income in ways unavailable to employees. 2. Asset creation. Building a business creates an asset you can eventually sell, unlike a job. 3. Retirement vehicle. Business structures like Solo 401(k) allow for larger retirement contributions than traditional employee plans. 4. Control. You determine your income growth rather than waiting for raises or promotions. 5. Complementary investment. Business profits can fund other investments like real estate or stocks. 6. Life integration. You can structure a business around your lifestyle preferences rather than adapting to an employer's requirements. These advantages make business ownership worth considering even for those who don't identify as natural entrepreneurs. A small, manageable business can significantly accelerate your path to financial freedom compared to relying solely on employment income. In the next chapter, we'll explore passive income generation techniques that can create ongoing revenue with minimal daily involvement. Chapter 17. Passive income generation techniques. Freedom through passive income. We've discussed the importance of multiple income streams and the power of business ownership. Now let's focus specifically on passive income, money that flows to you with minimal ongoing effort once the initial work is complete. Truly passive income is the holy grail of financial freedom because it breaks the direct connection between your time and your earning potential. While few income sources are 100% passive, most require some monitoring and maintenance. The goal is to minimize the ongoing time requirement while maximizing the return. Understanding the passive income spectrum. Different passive income sources require varying levels of upfront work and ongoing maintenance. Understanding this spectrum helps you choose strategies that match your resources and goals. High initial effort, low ongoing effort. Writing a book or creating a course, developing a mobile app, building a website with evergreen content, creating a patent or other intellectual property. Moderate initial effort. Minimal ongoing effort. Dividend stock portfolio, bond ladder, rental properties with property management, creating a YouTube channel with evergreen content. Low initial effort. Some ongoing management, peer-to-peer lending, high-yield savings or money market accounts, REITs, real estate investment trusts, investing in established index funds. High initial capital. Very low effort, annuities, fixed or variable, certificates of deposit, CDs, treasury securities, corporate bonds. Most people benefit from building a mix of these approaches, starting with those that match their current resources, time, money, skills, and gradually expanding. Real estate passive income strategies. We covered real estate in depth earlier, but let's focus specifically on making real estate income more passive. Turnkey rental properties. Properties already renovated and tenanted typically come with property management in place. Higher initial cost but immediate cash flow, less potential for forced appreciation. Real estate syndications. Pooling money with other investors for larger properties. Professional management handles all operations. Quarterly distributions without landlord responsibilities. Typically requires accredited investor status. Real estate investment trusts. REITs. Publicly traded companies that own income-producing real estate. No direct property management responsibilities. Highly liquid compared to direct ownership. Lower returns but also lower risk and effort. Triple net leases. Commercial properties where tenant handles all maintenance, insurance, and taxes. Very hands-off after initial lease setup. longer lease terms, often 10+ years. Lower returns but extremely passive short-term rental automation, Airbnb or VRBO properties with automated booking and communication systems, professional cleaning services, keyless entry systems, local management for emergencies, higher returns than long-term rentals with proper systems. The key to making real estate truly passive is proper systems and team building. While this may reduce your net return slightly, the time freedom gained is often worth the cost. Digital passive income opportunities. The internet has created unprecedented opportunities for building passive income streams with minimal startup capital. Information products, online courses, e-books, templates and printables, membership sites with automated content delivery. These products require significant upfront effort to create but can sell for years with minimal updates. The key to success is creating evergreen content that solves persistent problems for a specific audience. Content platforms, YouTube videos, ad revenue and sponsorships, blogs with affiliate marketing or advertising, podcasts with sponsorship deals, social media channels with product placements. Content platforms typically require consistent publication at first. But as your library grows, older content continues generating revenue, creating increasingly passive income. Software and apps, mobile applications, WordPress plugins or themes, SaaS, software as a service. Products, digital tools and utilities. Software can generate highly passive income after development, especially with subscription models that provide recurring revenue. While updates and support are necessary, they typically require less time than the initial development. Digital royalties, stock photography, music licensing, voiceover work, digital art and design elements. Creating assets that can be licensed repeatedly creates classic passive income. Platforms like Shutterstock, Audio Jungle, and Creative Market handle marketing and transactions, allowing creators to upload work and collect royalties. Investment-based passive income. Traditional investments remain among the most reliable sources of passive income. Dividend investing, focusing on companies with strong dividend histories, dividend aristocrats, companies that have increased dividends for 25+ consecutive years. Dividend ETFs for instant diversification, dividend reinvestment plans, DRIPs, for compounding. Bond ladders, purchasing bonds with staggered maturity dates, provides regular, predictable income, reduces interest rate risk compared to buying all long-term or all short-term bonds, can be created with corporate, municipal, or government bonds. Preferred stocks, hybrid securities with characteristics of both stocks and bonds, higher dividend yields than common stocks, less price volatility than common stocks, less upside potential but more reliable income. Covered call strategy, owning stocks and selling call options against them, generates income from option premiums, reduces potential upside but enhances current income. Works best in sideways or slightly rising markets. Peer-to-peer lending, lending money to individuals or businesses through platforms, higher interest rates than traditional fixed income investments. Diversification across many loans reduces risk. Increasingly automated platforms handle servicing and collections. The beauty of investment-based passive income is that most platforms now offer automation features that make managing these investments minimally time-consuming. Building systems for passive business income. Even traditional businesses can become sources of passive income with the right systems and team. The three elements of a passive business. 1. Documented systems, step-by-step processes for every aspect of the business that anyone can follow. 2. Reliable team, employees or contractors who can execute the systems without your daily involvement. 3. Performance monitoring, metrics and reporting that allow you to spot issues without micromanaging. Examples of businesses that can be systematized for passive income include Service businesses, marketing agencies with project managers and specialists, bookkeeping firms with trained staff and quality control systems, cleaning companies with team leaders and scheduling. Software retail and e-commerce, stores with managers and sales staff, e-commerce operations with fulfillment services, drop shipping businesses with automated ordering professional practices. Medical, dental, or veterinary practices with associates, law firms with partners and associates, accounting practices with trained professionals. The key is creating a business that can run without your daily involvement. This typically means hiring for leadership roles and creating robust systems that maintain quality and performance. Case study: building a passive income portfolio. Let's look at how someone might build a diversified passive income portfolio over time. Michael's passive income journey. Starting point: full-time job earning $80,000/year, $50,000 in savings. Goal: create $5,000/month in passive income within 7 years. Year 1 to 2. Invested $30,000 in dividend stocks yielding 3.5%, $1.050/year. Created an online course about his professional specialty, $500/month after platform fees, saved additional $40,000 from his salary. Year 3 to 4. Purchased a rental property with $40,000 down payment, $400/month cash flow after all expenses. Expanded course offerings and added affiliate marketing to his growing audience, $1,500/month. Invested another $30,000 in dividend stocks, total now yielding $2,450/year. Built a YouTube channel sharing his expertise, $300/month from ads. Year 5 to 6. Purchased a second rental property, $450/month cash flow. Created a membership site for his audience, $2,000/month. Dividend portfolio now yielding $3,600/year. YouTube channel growing, $800/month. Developed a small software tool for his industry, $1,000/month in subscriptions. Year 7. Total monthly passive income, dividend stocks, $375/month. Rental properties, $850/month. Online courses, $1,500/month. YouTube channel, $1,200/month. Membership site, $2,000/month. Software product, $1,500/month. Total, $7,425/month, exceeding his original goal. This example illustrates how combining multiple passive income streams can create significant results over time. Michael's approach leveraged both financial investments and his personal knowledge/skills to build diverse income sources. Protecting and growing passive income. Once you've established passive income streams, protecting and optimizing them becomes the priority. Protection strategies. 1. Diversification. Ensure no single stream represents more than 25 to 30% of your passive income. 2. Legal structures. Use appropriate business entities, LLCs, corporations to protect assets. 3. Insurance. Maintain proper coverage for all physical assets and liability risks. 4. Intellectual property protection. Secure trademarks, copyrights, or patents for your creations. 5. Digital backup systems. Protect digital assets with robust backup and security measures. Growth strategies. 1. Reinvestment. Use a portion of passive income to grow existing streams or develop new ones. 2. Strategic partnerships. Find complementary businesses or individuals to expand reach. 3. Automation improvement. Continuously refine systems to reduce necessary involvement. 4. Market expansion. Adapt successful models to new markets or demographics. 5. Acquisition. Purchase complementary assets or businesses to integrate with existing streams. The ultimate goal is creating what I call income perpetuation machines, passive income sources that not only sustain themselves but grow automatically over time. The psychological challenges of passive income. Building passive income presents unique psychological challenges. 1. Delayed gratification. Most passive income requires significant upfront work or capital before the passive phase begins. 2. Trust issues. Delegating to others or systems can be difficult for those used to controlling everything. 3. Identity shifts. Moving from doing everything yourself to managing systems requires changing how you see your role. 4. Revenue fluctuations. Passive income often varies month to month, requiring emotional resilience. 5. Imposter syndrome. Earning while not actively working can trigger feelings of not deserving the income. To overcome these challenges, focus on the value you've created that continues benefiting others. Develop trust gradually by delegating small responsibilities first. Create identity around being a system builder rather than a doer. Maintain adequate reserves to smooth out income fluctuations. Remember that front-loading work or investment is a legitimate approach to earning. In the next chapter, we'll explore tax optimization strategies to keep more of what you earn, accelerating your path to financial freedom. Chapter 18. Tax optimization strategies. The smart wealth builder's approach to taxes. Taxes represent one of the largest expenses most people will face throughout their lifetime. While we all have a civic duty to pay our legal tax obligations, there's no requirement to pay more than the law requires. As Judge Learned Hand famously stated, anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. In this chapter, we'll explore legal, ethical strategies to minimize your tax burden and keep more of what you earn to build wealth faster. Understanding tax efficiency versus tax avoidance. Before diving into strategies, it's important to clarify terms. Tax evasion, illegal activities to escape tax obligations, misrepresenting income, hiding assets, etc. This is both illegal and unethical. Tax avoidance, legal methods of arranging your affairs to minimize taxes owed. This is both legal and ethical when done properly. Tax efficiency, structuring your income, investments, and financial decisions to minimize tax impact while achieving your financial goals. Our focus is exclusively on legal tax efficiency strategies that align with both the letter and spirit of tax laws. Income tax reduction strategies. Let's start with approaches to reduce taxes on your earned and business income. Retirement account contributions, traditional 401(k) or IRA contributions reduce current taxable income. Self-employed options like SEP IRAs, simple IRAs, or solo 401(k) often allow higher contribution limits. Health savings accounts, HSAs, offer triple tax advantages for those with qualifying health plans. Business structure optimization, choosing between sole proprietorship, partnership, LLC, S corporation, or C corporation based on tax implications. S corporation strategy for self-employed to potentially reduce self-employment taxes. Qualified business income, QBI, deduction for pass-through entities. Income timing strategies, deferring income to future tax years when appropriate, accelerating deductible expenses into current tax years, timing capital gains and losses for optimal tax treatment. Tax credits versus deductions, prioritizing tax credits. Dollar for dollar reduction in taxes, over deductions, reduction in taxable income. Common valuable credits include child tax credit, education credits, earned income credit, and various business credits. Strategic charitable giving to maximize deduction benefits. Income shifting, family employment in a business must be legitimate and reasonable. Gifting income-producing assets to family members in lower tax brackets, subject to gift tax rules. Establishing legitimate family partnerships or LLCs. Remember that tax laws change frequently, so these strategies require regular review with a qualified tax professional familiar with your specific situation. Investment tax efficiency. How you structure your investments can dramatically impact your after-tax returns. Asset location optimization, placing tax-inefficient investments, bonds, REITs, high turnover funds in tax-advantaged accounts, holding tax-efficient investments, index funds, growth stocks in taxable accounts, coordinating across all accounts for overall portfolio tax efficiency. Tax loss harvesting, strategically selling investments at a loss to offset capital gains, maintaining market exposure by reinvesting in similar but not identical investments, systematizing this process for ongoing tax benefits. Tax-efficient fund selection, choosing ETFs over mutual funds for taxable accounts, generally more tax-efficient. Selecting funds with low turnover to minimize capital gains distributions, considering tax-managed funds specifically designed to minimize tax impact. Tax-advantaged income sources, municipal bonds for tax-free interest income, qualified dividends taxed at lower rates than ordinary income, growth stocks that appreciate with minimal dividends for tax deferral. Retirement account withdrawal strategies, Roth conversion ladders during low-income years, strategic ordering of withdrawals from different account types, required minimum distribution. RMD, planning real estate tax advantages. Real estate offers some of the most powerful tax benefits available. Depreciation, deducting the theoretical wearing out of property over time, component depreciation, cost segregation. To accelerate deductions, depreciation recapture planning for eventual sale. 1031 exchanges, deferring capital gains taxes when selling investment property by purchasing like-kind replacement property, building real estate portfolios while deferring taxes potentially for decades, estate planning with stepped-up basis to eliminate deferred gains. Real estate professional status, qualifying to deduct rental property losses against other income, strategies to meet material participation requirements, documentation requirements to support the classification. Home office deduction, deducting home expenses when regularly and exclusively using space for business, simplified versus regular method calculations, record-keeping requirements to sustain the deduction. Short-term rental strategies, potential Section 199A QBI deduction applicability, material participation to avoid passive activity loss limitations, mixed personal/rental use optimization. Business owner tax strategies. Business owners have unique opportunities for tax efficiency. Retirement plan options, individual 401(k) plans allowing up to $58,000 plus in annual contributions, as of 2021. Defined benefit plans for even larger retirement contributions. Cash balance plans combining defined benefit and defined contribution features fringe benefits, health insurance premium deductions, health reimbursement arrangements, HRAs, educational assistance programs, dependent care assistance, qualified transportation benefits. Home office and vehicle deductions. Home office as a legitimate business expense, vehicle expense. Tracking and documentation, business travel, meals, and entertainment deductions. Entity structuring, multiple entity strategies for different aspects of business. Holding companies for assets with operating companies, family limited partnerships for wealth transfer. Accountable plans, reimbursing employees, including yourself, for business expenses, creating documented plans that meet IRS requirements, turning personal expenses into business deductions when legitimate. Estate and wealth transfer tax strategies. Preserving wealth across generations requires careful planning. Lifetime gifting, Annual exclusion gifts, $15,000 per recipient per year tax-free as of 2021. Lifetime exemption utilization strategies, direct payments for medical and educational expenses, unlimited gifts, trusts, irrevocable life insurance trusts, ILITs. To exclude insurance proceeds from estate, grantor retained annuity trusts, GRATs, for appreciating assets, charitable remainder trusts, CRTs. For income and charitable goals, dynasty trusts for multi-generational wealth transfer, family limited partnerships, FLPs. And LLCs, discounted gifting through fractional interest transfers, maintaining control while transferring economic value, liability protection and succession planning benefits. Charitable strategies, donor-advised funds for timing charitable deductions, charitable lead trusts for income to charity with remainder to family, qualified charitable distributions from IRAs for those over 70 and a half, life insurance strategies, providing liquidity for estate taxes, wealth replacement when gifting to charity, tax-advantaged investment growth within policies, state and local tax considerations. Beyond federal taxes, state and local taxes can significantly impact your bottom line. Residency planning, establishing domicile in lower tax states, understanding statutory residency tests, documentation requirements for changing residency, state-specific investment strategies. In-state municipal bonds for double tax exemption, 529 college savings plan, state tax deduction opportunities, state-specific credits and incentives, business location strategies, choosing business-friendly jurisdictions, understanding nexus rules for multi-state operations, entity selection based on state tax treatment differences, remote work opportunities, tax implications of working remotely from different states, convenience of employer rules in certain states, potential for eliminating state income taxes through location flexibility, working with tax professionals. Effective tax planning requires professional guidance. Here's how to maximize that relationship. 1. Proactive versus reactive planning. Meet with your tax professional at least quarterly, not just at tax time. 2. Education focus. Choose professionals who educate you about strategies, not just prepare returns. 3. Team approach. Ensure your tax professional coordinates with your financial advisor, attorney, and insurance professionals. 4. Specialist selection. Different tax situations require different expertise, real estate, business, international, etc. 5. Value pricing. The best tax professionals don't charge by the hour but by the value they provide. 6. Documentation systems. Develop organized methods for tracking deductions and substantiating claims. 7. Risk assessment. Understand the difference between black and white areas of tax law versus gray areas. The right tax professional doesn't just save you money on preparation fees, they should save you multiples of their cost in reduced taxes through proper planning. Maintaining tax audit readiness. Even with legitimate tax strategies, audit risk exists. Stay prepared by 1. Documentation systems, maintaining organized records for all deductions and credits. 2. Consistency, ensuring your financial records match what's reported on returns. 3. Reasonableness tests, avoiding extreme positions that trigger scrutiny. 4. Separate accounts, keeping business and personal finances clearly separated. 5. Written explanations, documenting unusual transactions or positions. 6. Professional guidance, following qualified advice rather than aggressive internet strategies. 7. Disclosure forms, using appropriate disclosure when taking positions that might be questioned. Remember, the goal isn't just to reduce taxes but to do so in a way that lets you sleep at night, knowing you've complied with all legal requirements while not paying more than necessary. In the next chapter, we'll explore how to create an investment compounding machine. a system that accelerates wealth building through the power of compound returns. Chapter 19. Creating an investment compounding machine. The eighth wonder of the world. Albert Einstein reportedly called compound interest the eighth wonder of the world, saying, "He who understands it, earns it. He who doesn't, pays it." In this chapter, we'll explore how to harness the extraordinary power of compounding to accelerate your journey to financial freedom. Compounding occurs when your investment returns themselves generate additional returns. This creates a snowball effect that starts slow but becomes increasingly powerful over time. The key ingredients for successful compounding are: 1. Initial capital, the seed money that starts the process. 2. Rate of return, the percentage growth of your investment. 3. Time, the duration over which compounding occurs. 4. Frequency, how often returns are compounded. 5. Additions, new capital added to the compounding machine. Let's explore how to optimize each of these elements to create your own wealth-generating compounding machine. Understanding the mathematics of compounding. Before diving into strategies, it's worth appreciating the mathematical power of compounding. If you invest $10,000, earning 10% annually with returns reinvested, your investment grows as follows. After 10 years, $25, $937. After 20 years, $67, $275. After 30 years, $174. $494. After 40 years, $452, $593. Notice how the growth accelerates with time. In the first decade, your money grows by about $16,000. In the fourth decade alone, it grows by about $278,000. This acceleration is the essence of compounding power. The rule of 72 provides a quick way to estimate how long it takes money to double. Simply divide 72 by your annual return percentage. At 10% returns, money doubles approximately every 7.2 years. Optimizing your compounding machine. Let's explore strategies to maximize each component of the compounding process. 1. Maximize initial capital. The larger your starting amount, the more powerful the compounding effect. Strategies to increase initial capital include: expense optimization, reducing unnecessary spending to free up investment capital; income acceleration, temporarily increasing work hours or adding side income; asset reallocation, moving money from non-growing assets into compounding vehicles; windfalls, strategically investing; tax refunds, bonuses, or inheritance. Even small increases in initial capital can have dramatic effects over long time periods. An additional $5,000 at the beginning, compounded at 10% for 30 years, results in an additional $87,247. 2. Optimize rate of return. The return rate dramatically affects long-term results. Increasing your annual return from 7% to 10% on a $10,000 investment over 30 years results in an additional $86,000. Strategies to potentially increase returns include: asset allocation optimization, finding the right mix of stocks, bonds, real estate, and alternatives; investment selection, choosing investments with lower fees and higher historical returns; tax efficiency, structuring investments to minimize tax drag; risk management, taking appropriate risks for your time horizon; market cycle awareness, adjusting allocation based on valuation levels. Remember that higher returns typically come with higher risk or volatility. The goal is finding the optimal return for your risk tolerance and time horizon. 3. Maximize time in the market. Time is perhaps the most powerful element of compounding. Starting early creates dramatic advantages. Person A invests $5,000 annually from age 25 to 35, 10 years, then never adds another dollar. Person B invests $5,000 annually from age 35 to 65, 30 years. At age 65, assuming 8% returns, Person A has about $615,000 while Person B has about $612,000. With just 10 years of contributions, Person A ends up with slightly more than Person B's 30 years of contributions due to the extra decade of compounding. Strategies to maximize time include starting as early as possible. Even with small amounts, keeping money invested during market downturns, extending your investment horizon when possible, using tax-advantaged accounts to defer taxes and extend compounding. 4. Increase compounding frequency. The more frequently compounding occurs, the better the results. While you can't control how often the market compounds returns, you can reinvest dividends and interest immediately. Choose investments that distribute income more frequently. Select platforms that compound interest daily rather than monthly or quarterly. Implement systematic rebalancing to capture gains strategically. 5. Systematic additions. Regular contributions supercharge your compounding machine by adding new capital that itself begins compounding. For example, $10,000 invested at 10% for 30 years grows to $174,494. But $10,000 plus $500 monthly additions at the same rate grows to $118,293, more than 6 times as much. Strategies for optimizing additions include automating regular contributions to ensure consistency, implementing a pay-yourself-first approach where investments happen before discretionary spending, creating a contribution escalation plan where you increase your additions annually, using windfalls and unexpected income for one-time additional contributions. The compounding machine portfolio architecture. Creating an effective compounding machine requires thoughtful portfolio design. Consider this tiered approach. Tier 1, Foundation, 50 to 60% of portfolio. Broad-based index funds with low fees, dividend aristocrats with dividend reinvestment plans, blue-chip growth stocks for long-term appreciation, core real estate holdings. This foundation provides reliable, steady growth with lower volatility and minimal maintenance requirements. Tier 2, Growth accelerators, 20 to 30% of portfolio. Small cap and mid-cap growth stocks, emerging market investments, value stocks for potential mean reversion, strategic real estate with value-add potential. This tier potentially increases your overall return rate while being diversified enough to manage risk. Tier 3, opportunistic investments, 10 to 20% of portfolio. Focused positions in high-conviction investments, alternative investments like private equity or venture capital, tactical positions based on market cycles, specialized real estate niches. This component provides potential for outsized returns that can significantly accelerate your compounding machine, but with higher risk. Tier 4, next generation opportunities, 0 to 10% of portfolio. Early stage technologies or trends, disruptive business models, select cryptocurrencies or digital assets, frontier markets. This small allocation explores emerging opportunities that could become major growth drivers in the future. The precise allocation between these tiers depends on your age, risk tolerance, time horizon, and financial goals. Protecting your compounding machine. The power of compounding works in reverse too. Losses require disproportionately larger gains to recover. A 20% loss requires a 25% gain to break even. A 50% loss requires a 100% gain to recover. Strategies to protect your compounding machine include 1. Diversification across and within asset classes, reducing the impact of any single investment failure. 2. Strategic cash reserves, maintaining liquidity to avoid forced selling during downturns. 3. Hedging strategies, using options, inverse ETFs, or other tools to partially protect against significant declines. 4. Valuation awareness, becoming more conservative when markets reach extreme valuations. 5. Regular risk assessment, periodically stress testing your portfolio against various scenarios. 6. Insurance integration, using appropriate insurance products to protect against catastrophic risks. 7. Security measures, protecting against fraud, theft, and cybersecurity threats. Remember, avoiding major losses is often more important for long-term compounding success than capturing every possible gain. Case study: Jennifer's compounding machine. Let's examine how one investor created a successful compounding machine. Jennifer's background: started at age 30 with $25,000 in savings, earning $70,000 annually with 3% average raises. Goal: financial independence by age 50. Her compounding machine strategy: initial actions: reduced expenses to create $1,500 monthly investment capacity, position $25,000 initial capital across index funds, dividend stocks, and a rental property down payment, established automatic investment systems for all incoming cash flow. Portfolio structure: 50% in low-cost index funds, U.S., international, small cap. Value: 25% in dividend growth stocks with DRIP programs, 20% in rental real estate with cash flow reinvestment, 5% in opportunistic investments based on market conditions. Compounding accelerators: automated dividend reinvestment, quarterly rebalancing to capture gains systematically, rental income directed to mortgage paydown and new investments, annual tax refunds added as lump sum contributions, side hustle income directed entirely to investments, results after 20 years. Index fund portfolio: $680,000 dividend stock portfolio, $410,000 real estate equity, $520,000 opportunistic investments, $190,000 total, $1,800. With this compounding machine producing approximately $95,000 in annual passive income, Jennifer achieved her goal of financial independence by age 50. Without relying on exceptionally high-risk investments or unrealistic return assumptions. Behavioral aspects of successful compounding: the biggest threats to your compounding machine aren't market-related but behavioral. 1. Impatience, abandoning the strategy before compounding gains momentum. 2. Interrupting compounding, withdrawing money for non-essential purchases. 3. Performance chasing, switching strategies based on recent outperformance. 4. Panic selling, exiting during market downturns, breaking the compounding chain. 5. Overconfidence, taking excessive risks after periods of strong returns. 6. Lifestyle inflation, increasing spending instead of investment contributions as income grows. 7. Complexity bias, believing complicated strategies are necessarily better than simple ones. Strategies to overcome these behavioral challenges include written investment policy, documenting your strategy and commitment to compounding, automation, removing human emotion from regular investing decisions, visualization, regularly reviewing compounding projections to maintain motivation, accountability partners, sharing goals with someone who will keep you committed, media diet, limiting exposure to financial news that encourages reaction, review schedule, predetermining when you'll assess and potentially adjust strategy, satisfaction budgeting, allocating a small portion of gains for immediate enjoyment. Compounding beyond financial assets: the principles of compounding apply beyond just financial investments. Knowledge compounding, learning foundational concepts that support further learning, building expertise that creates exponentially more opportunities, developing mental models that improve all decision-making. Network compounding, building relationships that introduce you to additional connections, creating value for others who then reciprocate over time, developing reputation that attracts opportunities without effort. Skill compounding, mastering complementary skills that multiply your effectiveness, developing expertise that compounds in value as industries evolve, building systems that generate increasing returns on your time, health compounding, making decisions today that create expanded capabilities tomorrow, avoiding health debts that compound negatively over time, building habits that produce exponential long-term benefits. The most successful individuals apply compounding principles across all these dimensions, creating synergistic effects that accelerate progress toward their goals. In our final chapter, we'll integrate everything we've covered into a comprehensive implementation plan to achieve true financial freedom. Chapter 20: Achieving True Financial Freedom Beyond the Numbers. What freedom really means. Throughout this guide, we've explored numerous strategies for building wealth, from investment psychology to passive income, from tax efficiency to the power of compounding. But financial freedom isn't ultimately about account balances or net worth milestones. It's about what those resources enable in your life. In this final chapter, we'll define what true financial freedom means, explore the stages of the journey, and create an integrated implementation plan to make your vision of freedom a reality. Defining your personal financial freedom. Financial freedom means different things to different people. For some, it's the ability to never work again. For others, it's the freedom to work only on projects they love, regardless of pay. For still others, it's simply the elimination of financial stress and worry. To define your personal vision of financial freedom, consider these questions. 1. If money were no concern, how would you spend your days? 2. What activities or experiences bring you the greatest fulfillment? 3. What current obligations or activities would you eliminate if you could? 4. What impact do you want to have on your family, community, or the world? 5. How much security do you need to feel truly free? 6. What role, if any, would work play in your ideal life? 7. Where and how would you live if finances weren't a constraint? Your answers will help you define what financial freedom specifically means for you, a crucial step before determining how much money you actually need. The 5 stages of financial freedom. Financial freedom isn't binary but exists along a spectrum. Understanding these stages helps you track progress and celebrate milestones. Stage 1: Financial stability. No high-interest consumer debt, adequate emergency fund, 3 to 6 months of expenses. Income reliably covers necessary expenses, basic insurance protections in place. This stage eliminates the constant stress of financial emergencies and creates the foundation for growth. Stage 2: Financial security, long-term debt, mortgage, student loans under control with clear payoff strategies, retirement accounts established and growing, multiple income streams beginning to develop, ability to withstand job loss or other disruptions without crisis. At this stage, you have breathing room and options if things go wrong. Stage 3: Financial independence. Investment income covers basic living expenses, work becomes optional rather than mandatory, full insurance coverage protecting assets and income, freedom to make major life changes. Career, location, without financial constraint. This is what many people think of as financial freedom, the ability to live without requiring employment income. Stage 4: Financial abundance. Investment income significantly exceeds expenses, ability to fund major purchases or experiences without planning, capacity for meaningful philanthropic impact, complete lifestyle flexibility and choice. At this stage, money becomes a tool for maximizing life experience and impact rather than a constraint. Stage 5: Financial legacy. Assets sufficient to support multiple generations, established structures for meaningful wealth transfer, philanthropic vehicles creating lasting impact, financial wisdom successfully transmitted to heirs or beneficiaries. This ultimate stage extends your financial impact beyond your own lifetime. Most people progress through these stages sequentially, though some may skip stages through inheritance, business success, or other circumstances. Each stage builds on the previous one and requires different strategies and focus. Calculating your financial freedom number. While true freedom is about more than a specific dollar amount, having a target helps guide your strategy. Here's a process for calculating your basic financial freedom number. 1. Determine your ideal annual expenses in today's dollars. Don't just use your current budget, adjust for how you'd truly like to live. 2. Add a buffer for unexpected expenses and opportunities, typically 20 to 50% above your base expenses. 3. Calculate the investment principal needed using the safe withdrawal rate approach. The traditional safe withdrawal rate is 4%, based on the Trinity study, though some financial planners now recommend 3 to 3.5% for longer retirements. Formula: annual expenses withdrawal rate equals principal needed. Example: $80,000. 04 equals $2 million. 4. Adjust for income sources that will continue regardless of work, Social Security, pensions, royalties, etc. 5. Consider inflation impacts based on your time horizon. 6. Add specific large future expenses, children's education, travel dreams, etc. This calculation gives you a starting target. But remember that financial freedom is ultimately about cash flow rather than a specific net worth number. Creating your integrated freedom plan. With your definition of freedom and target number established, it's time to create an integrated plan that brings together everything we've covered in this guide. 1. Cash flow optimization. Expense management to maximize savings rate, income maximization through career advancement, side hustles, or business, systematic saving and investment of the difference, debt elimination or strategic leverage, depending on your situation. 2. Strategic asset allocation. Core portfolio aligned with your risk tolerance and time horizon, proper diversification across and within asset classes, regular rebalancing to maintain target allocations, tax-efficient investment placement. 3. Income stream development. Identifying your initial 2 to 3 additional income streams based on skills, interests, and resources, sequential development timeline with specific milestones, reinvestment strategy for income stream profits, passive income growth projections. 4. Tax efficiency system. Optimal account structures, traditional versus Roth, taxable versus tax-advantaged, entity strategies if applicable, business structures, holding companies. Deduction maximization systems, strategic tax planning calendar with professional review. 5. Wealth protection framework, appropriate insurance coverage, life, disability, liability, property, legal structures to protect assets, trusts, LLCs, family limited partnerships. Estate planning documents, digital security protocols. 6. Growth acceleration mechanisms, compounding optimization through reinvestment, strategic use of leverage when appropriate, skill and knowledge development plan, network building for opportunity expansion. 7. Lifestyle integration strategy, alignment of financial decisions with personal values, balance between current enjoyment and future security, health and relationship investment plan, time freedom, milestones and celebrations. 8. Implementation timeline. 30-day immediate action items, 90-day establishment phase, 1-year milestone targets, 3-year and 5-year vision with specific metrics, decade-long freedom projection. This integrated approach ensures you're addressing all aspects of financial freedom simultaneously, creating synergistic effects that accelerate your progress. The critical role of habits and systems. Developing financial freedom isn't about occasional bold moves but rather about consistent habits supported by effective systems. Key habits for financial freedom. 1. Automatic investing, regular, systematic investment regardless of market conditions. 2. Continuous learning, ongoing education about financial concepts and opportunities. 3. Expense consciousness, awareness of spending without obsessive frugality. 4. Income expansion, regular exploration of ways to increase earning capacity. 5. Relationship cultivation, building and maintaining a network of like-minded individuals. 6. Health prioritization, maintaining physical and mental well-being as foundational assets. 7. Gratitude practice, appreciating progress and current abundance regardless of future goals. Essential systems for financial freedom. 1. Financial dashboard, a consolidated view of all accounts, assets, and progress metrics. 2. Investment policy statement, written guidelines for investment decisions regardless of market emotions. 3. Income stream management system, tools for monitoring and optimizing multiple revenue sources. 4. Tax planning calendar, scheduled reviews and actions to minimize tax burden. 5. Opportunity filter, framework for evaluating new investments or business ventures. 6. Financial education system, regular information sources and learning practices. 7. Life balance scorecard, tracking fulfillment across health, relationships, purpose, and finance. The combination of consistent habits and supportive systems creates inevitable progress toward your freedom goals, even during challenging periods. Navigating common freedom journey obstacles. Several predictable challenges arise on the path to financial freedom. Anticipating these obstacles allows you to prepare effective responses. The middle stage plateau, symptom. Progress seems to slow after initial success. Solution. Focus on compounding metrics rather than absolute numbers. Celebrate percentage growth rather than dollar amounts. Lifestyle inflation pressure. Symptom. As income increases, so does the temptation to increase spending. Solution. Create automatic systems that direct income increases primarily to investments before lifestyle upgrades. Motivation fluctuation. Symptom. Enthusiasm for financial discipline wanes over time. Solution. Connect financial goals to deeper values and life vision. Build community with others on similar journeys. Opportunity overwhelm. Symptom. Too many potential investments or income streams create paralysis. Solution. Develop a structured opportunity evaluation system with clear criteria for action. Relationship misalignment. Symptom. Partners or family members have different financial values or goals. Solution. Regular financial communication with focus on shared values and compromises that respect different perspectives. Fear-based decisions. Symptom. Market volatility or economic uncertainty triggers emotional reactions. Solution. Pre-committed decision rules and investment policies that guide actions regardless of emotions. Achievement identity crisis. Symptom. Nearing financial goals triggers questions about purpose and identity. Solution. Develop non-financial aspects of identity and purpose throughout the journey. Not just at the end. By anticipating these challenges, you can develop specific strategies to overcome them before they derail your progress. Beyond financial freedom, impact and legacy. As you progress toward financial freedom, consider how your resources can create meaning and impact beyond your own life. Family impact, financial education for children and grandchildren, strategic inheritance planning for multi-generational benefit, family experiences and traditions that money enables but don't revolve around consumption. Community impact, strategic philanthropy aligned with your values, direct investment in local businesses and economies, mentorship and knowledge sharing with others. Beginning their journey. Broader impact, sustainable and ethical investment selection, support for systemic change aligned with your values, creation of entities, businesses, foundations, funds with specific impact missions. Personal legacy, documentation of financial wisdom and lessons learned, creation of structures that extend your values beyond your lifetime, development of purpose-driven missions funded by your financial success. True financial freedom ultimately enables impact beyond yourself, creating meaning that transcends account balances or material possessions. Your freedom journey begins now. We've covered extensive ground in this guide, from the psychology of investing to the mathematics of compounding, from real estate strategies to business development, from tax optimization to passive income creation. But information without action creates no results. Your journey to financial freedom begins with your very next decision after closing this book. I encourage you to 1. Take time to define your personal vision of financial freedom. 2. Calculate your freedom number based on that vision. 3. Assess your current position on the 5 stages of freedom. 4. Identify the 3 most important strategies from this guide for your specific situation. 5. Create 30-day, 90-day, and 1-year action plans. 6. Implement your first action step within 24 hours. 7. Connect with others on similar journeys for support and accountability. Remember that financial freedom is not just about money, it's about creating a life of meaning, choice, and impact. The strategies in this guide are simply tools to help you build that life. You have everything you need to begin. The journey of 1,000 miles begins with a single step. Take that step today. Final thoughts: the paradox of freedom. As we conclude, I'd like to share a final insight that many discover on their journey to financial freedom. The process of building wealth often creates its own reward. Many who achieve financial freedom find that the discipline, skills, relationships, and wisdom developed along the way become as valuable as the financial resources themselves. The person you become through the journey is ultimately the greatest asset you'll build. Financial freedom isn't an endpoint but a continuing evolution of your relationship with resources, time, and purpose. Even after achieving your financial goals, you'll likely find new mountains to climb and new ways to grow. Embrace this journey not just for the destination but for the daily opportunity to develop mastery over your resources rather than allowing them to master you. That is the ultimate financial freedom. I wish you wisdom, perseverance, and joy as you build your own path to financial freedom. It's been my privilege to share this journey with you. Financial Freedom Guide for Dummies, Part 4, Risk Management and Implementation. Chapter 21. Creating your personalized investment plan, the blueprint for financial success. We've covered numerous strategies and concepts throughout this guide. But without a structured plan that integrates these ideas into your specific situation, even the best knowledge remains theoretical. In this chapter, we'll develop a framework for creating your personalized investment plan, the blueprint that will guide your journey to financial freedom. Why most financial plans fail. Before creating your plan, it's important to understand why many financial plans fail to produce results. 1. Complexity overload. Plans with too many moving parts become impossible to implement consistently. 2. Unrealistic expectations. Projections based on overly optimistic returns or savings rates that can't be maintained. 3. Insufficient flexibility. Rigid plans that don't adapt to changing life circumstances or market conditions. 4. Disconnection from values. Plans focused purely on numbers without connection to personal values and goals. 5. Lack of implementation systems. Beautiful plans without practical execution mechanisms. 6. All or nothing thinking. Plans that require perfect execution rather than accommodating human reality. 7. Insufficient monitoring. No regular review process to assess progress and make adjustments. The plan we'll develop together avoids these pitfalls by focusing on simplicity, flexibility, values alignment, and systematic implementation. The 5 elements of an effective investment plan. An effective investment plan consists of 5 key elements. 1. Personal financial vision, your definition of financial success based on your values and aspirations. 2. Current financial assessment, an honest evaluation of your starting point across all financial dimensions. 3. Strategy selection, the specific approaches from this guide most aligned with your situation and goals. 4. Implementation system, the practical mechanisms for executing your strategies consistently. 5. Review and adaptation framework, the process for monitoring progress and making necessary adjustments. Let's explore each element in detail. Element 1. Personal financial vision. Your financial vision is the foundation of your plan. It answers the fundamental question, why am I doing this? To develop your financial vision, consider core values. What matters most to you in life? What does money represent to you? Security, freedom, impact, status, etc. What trade-offs are you willing to make, or not make, to achieve financial goals? Life vision. What does your ideal life look like 5, 10, 20 years from now? What activities do you want more time for? Where do you want to live, and in what kind of environment? What relationships do you want to nurture? Impact goals. What difference do you want to make for your family? How do you want to contribute to your community or causes you care about? What legacy do you want to leave? Financial milestones. What specific financial achievements would represent success to you? By when do you want to reach various levels of financial freedom? What material possessions or experiences are truly important to you? Document your answers to these questions in a personal financial vision statement that captures the essence of what you're working toward. This vision becomes your compass, keeping you oriented toward what truly matters when making financial decisions. Element 2. Current financial assessment. Before plotting a course to your destination, you need to know your starting point. A thorough current assessment includes net worth statement, all assets with current market values, all liabilities with balances, interest rates, and terms, resulting net worth calculation, cash flow analysis, income from all sources, fixed and variable expenses, resulting savings rate and discretionary spending, risk profile assessment, investment risk tolerance, emotional capacity for volatility, risk capacity, financial ability to withstand setbacks, current insurance coverage and gaps, income stream inventory, current active income sources, existing passive or semi-passive income, potential future income sources based on skills and assets, tax situation review, current effective tax rates, tax-advantaged account utilization, potential tax optimization opportunities, time and energy assessment, available time for financial management and learning, interest level in various investment approaches, skills and knowledge relevant to different strategies. This assessment provides the realistic starting point from which your journey begins. Be completely honest, plans built on inaccurate foundations inevitably fail. Element 3. Strategy selection. With your vision and current assessment completed, you can now select the specific strategies that best bridge the gap between your current reality and desired future. This guide has presented numerous approaches across multiple domains: investment strategies, asset allocation models, value investing approaches, market cycle positioning, passive indexing methods, income development strategies, business development, real estate investing, digital product creation, dividend and interest income, tax optimization strategies, account structure optimization, entity strategies, deduction maximization, timing approaches, risk management strategies, insurance solutions, diversification methods, hedging approaches, emergency preparations. Rather than trying to implement everything simultaneously, select the 3 to 5 strategies that 1. Will have the greatest impact on your specific situation. 2. Align with your skills, interests, and available time. 3. Work synergistically rather than competing for resources. 4. Create the shortest path between your current reality and vision. For example, a high-income professional with limited time might prioritize automated investment in low-cost index funds, maximizing tax-advantaged retirement accounts, adding one rental property per year with professional management, building a dividend portfolio for passive income, while a self-employed person with more time flexibility might choose business systems development to reduce active involvement, real estate acquisition with value-add components, digital product creation leveraging professional expertise, tax optimization through business entity structuring. Document your selected strategies with specific implementation parameters for each. Element 4. Implementation system. Even the best strategies fail without systematic implementation. Your implementation system translates intentions into actions through automation, automatic investment transfers on paydays, scheduled portfolio rebalancing, systematic dividend reinvestment, regular financial review, calendar appointments, decision rules, predetermined guidelines for buying and selling investments, clear criteria for evaluating new opportunities, specific thresholds for emergency fund usage, rules for adjusting savings rates as income changes. Documentation, investment policy statement with specific allocation targets, written procedures for regular financial activities, checklists for periodic financial maintenance, reference sheets for account information and processes. Environment design, physical organization of financial documents, digital systems for tracking accounts and investments, communication systems for financial partners or advisors, workspace arrangement that facilitates financial management. The key principle is designing your environment and systems to make the right financial behaviors easier than the wrong ones. Willpower is a finite resource. Effective systems reduce the need for it. Element 5. Review and adaptation framework. Financial plans are never set and forget documents. They require regular review and adaptation to remain effective. Your framework should include regular review schedule, daily, 5 minutes, quick check of transactions and balances, weekly, 30 minutes, cash flow management and short-term planning, monthly, 1 to 2 hours, budget review, investment performance, progress metrics, quarterly, 2 to 3 hours, portfolio rebalancing, goal progress, strategy assessment, annual, 1 day, comprehensive financial review, tax planning. Major adjustments. Key performance indicators, net worth growth rate, savings rate percentage, passive income as percentage of expenses, investment returns versus benchmarks, progress toward specific financial milestones. Adaptation triggers, specific conditions that would warrant strategy changes, market valuation thresholds for allocation adjustments, life events requiring plan modifications, performance shortfalls requiring intervention. Continuous learning plan, regular sources for financial education, skills to develop that support your strategies. Network development for knowledge sharing, professional advice. Utilization criteria. This framework ensures your plan remains relevant and effective as both your life and the broader economic environment evolve. Bringing it all together, your one-page financial plan. While your complete investment plan may span many pages with specific details, create a one-page summary that captures the essence. This financial dashboard should include 1. Your personal financial vision statement, 2 to 3 sentences. 2. Your current financial position snapshot, key metrics only. 3. Your primary financial goal with timeline. 4. Your 3 to 5 core implementation strategies. 5. Your next 3 specific action steps. 6. Your review schedule and key performance indicators. This one-page summary serves as a daily reminder and quick reference that keeps you focused on what matters most. Case study. The Johnsons' investment plan. Let's examine how one family created their personalized investment plan. The Johnsons' situation. dual income couple, combined $140. 000/year, 2 children, ages 8 and 10, $30,000 in student loan debt, 5% interest, $250,000 mortgage, 2% interest, 25 years remaining, $120,000 in retirement accounts, $25,000 in taxable investments, $15,000 emergency fund. Goal: financial independence by age 55. 17 years away, their financial vision. We want the freedom to choose how we spend our time without financial constraints, the ability to help our children with college expenses, and the means to travel extensively in our later years while maintaining health and purpose. Their selected strategies: 1. Maximize tax-advantaged accounts, 401(k), S, IRAs, HSA. 2. Build a dividend growth stock portfolio in taxable accounts. 3. Add one rental property every 3 years. 4. Develop a small e-commerce business leveraging existing skills. 5. Optimize tax efficiency through strategic account placement. Their implementation system: 401(k). Contributions automatically withheld from paychecks, monthly investment transfers scheduled for day after paydays, quarterly portfolio rebalancing calendar reminders, annual meeting with tax professional and financial planner, bi-weekly financial date night to review progress and discuss strategies. Their review framework: daily, check account balances via aggregator app; weekly, review upcoming expenses and cash flow; monthly, track net worth growth and savings rate; quarterly, rebalance portfolios and assess progress toward goals; annually, comprehensive financial review and strategy adjustment. With this structured yet flexible plan, the Johnsons created a clear path toward their financial vision while building in the necessary adaptation mechanisms to handle life's inevitable changes. Getting started. Your next steps to create your own personalized investment plan. 1. Schedule 2 to 3 hours of uninterrupted time specifically for developing your financial vision and assessing your current situation. 2. Create a first draft of your plan focusing on clarity rather than perfection. 3. Identify the one strategy that would most significantly impact your situation if implemented consistently. 4. Design a simple system to ensure that strategy happens automatically. 5. Schedule your first monthly review session to assess progress and refine your plan. 6. Share your plan with a trusted accountability partner for feedback and support. Remember that a good plan you actually implement is infinitely better than a perfect plan that remains theoretical. Start where you are, use what you have, and do what you can. Consistency over time produces remarkable results. In the next chapter, we'll explore portfolio rebalancing and optimization, essential techniques for maintaining your investment strategy through changing market conditions. Chapter 22: Portfolio rebalancing and optimization. Maintaining the balance of power. Once you've established your investment portfolio based on your personalized plan, the work isn't done. Markets move, different assets perform at different rates, and your carefully designed allocation will naturally drift over time. Portfolio rebalancing is the disciplined process of returning your investments to their target allocations, while optimization involves making strategic adjustments to improve performance or reduce risk. In this chapter, we'll explore how to maintain and enhance your investment portfolio for maximum long-term results. The importance of rebalancing over time. Asset classes that perform well become a larger percentage of your portfolio, while underperforming assets shrink in relative terms. Without intervention, this drift can significantly alter your portfolio's risk and return characteristics. For example, consider a simple portfolio with a target allocation of 60% stocks and 40% bonds, after a strong bull market in stocks. The allocation might drift to 75% stocks and 25% bonds. This new allocation has significantly higher risk than the original target when the inevitable market correction occurs. The portfolio will experience larger losses than intended. Rebalancing provides several key benefits. 1. Risk control maintains your intended risk exposure by preventing overconcentration in any asset class. 2. Disciplined contrarianism forces you to buy assets that have underperformed, potentially at better valuations, and sell those that have outperformed. 3. Emotion management removes emotional decision-making by following a predetermined process. 4. Performance smoothing reduces portfolio volatility and can potentially improve risk-adjusted returns. Regular rebalancing is one of the few areas in investing where doing what feels uncomfortable, selling winners and buying losers, often leads to better long-term outcomes. Rebalancing methods. Choosing your approach. There are several methods for determining when and how to rebalance your portfolio. Calendar rebalancing. Adjusting allocations on a predetermined schedule, monthly, quarterly, annually. Advantages. Simple, systematic, requires minimal monitoring. Disadvantages. May lead to unnecessary transactions if allocations haven't drifted significantly. Percentage of portfolio rebalancing. Rebalancing when allocations drift beyond predetermined thresholds. For example, 5% from targets. Advantages. Reduces unnecessary transactions, responds to significant market movements. Disadvantages. Requires more regular monitoring. Can be subjective. Tactical rebalancing, adjusting allocations based on market conditions, valuations, or economic indicators. Advantages. Potentially higher returns. Adaptation to changing environments. Disadvantages. More complex, requires greater expertise. Introduces timing risk. Most investors benefit from combining approaches, perhaps using percentage thresholds with a maximum time limit. Rebalance when allocations drift by 5% or at least annually, whichever comes first. The mechanics of rebalancing. The process of rebalancing involves several key steps. 1. Review current allocations. Determine your portfolio's current asset allocation percentages across all accounts. 2. Compare to targets. Identify the deviation between current and target allocations for each asset class. 3. Calculate required adjustments. Determine the specific transactions needed to return to target allocations. 4. Consider tax implications. Evaluate potential tax consequences of selling appreciated assets. 5. Execute transactions. Implement the necessary buys and sells, preferably in tax-advantaged accounts when possible. 6. Document the process. Record the rebalancing transactions and updated allocations for future reference. For example, if your target allocation is 60% stocks/40% bonds, but market movements have shifted this to 68% stocks/32% bonds, you would either sell stocks and buy bonds or direct new contributions entirely to bonds until your target allocation is restored. Tax-efficient rebalancing strategies. Rebalancing in taxable accounts can trigger capital gains taxes. These strategies can help minimize the tax impact. 1. Use tax-advantaged accounts. Conduct as much rebalancing as possible within retirement accounts where transactions don't trigger immediate taxes. 2. Direct new contributions. Allocate new investments to underweighted asset classes rather than selling overweighted ones. 3. Utilize tax loss harvesting. Strategically sell investments at a loss to offset gains from rebalancing transactions. 4. Consider asset location. Hold tax-inefficient investments in tax-advantaged accounts and tax-efficient investments in taxable accounts. 5. Use specific identification. When selling, specify the particular shares with the highest cost basis to minimize gains. 6. Time rebalancing strategically. Consider rebalancing in years when your income is lower or when you have capital losses to offset gains. 7. Charitable giving. Donate highly appreciated assets to charity rather than selling them for rebalancing purposes. The goal is to maintain your target allocation while minimizing the tax drag on your portfolio's performance. Portfolio optimization. Beyond basic rebalancing, while rebalancing returns your portfolio to its original design, optimization involves improving that design over time. Consider these optimization strategies: risk factor analysis, examining your portfolio's exposure to specific risk factors, market risk, size risk, value risk, momentum, etc. Adjusting to ensure diversification across multiple risk factors, not just asset classes, potentially improving risk-adjusted returns by balancing factor exposures. Correlation optimization. Analyzing how different components of your portfolio move in relation to each other, adding assets with low or negative correlations to existing holdings, reducing overall portfolio volatility without necessarily sacrificing returns. Cost reduction. Regularly reviewing expense ratios and transaction costs, consolidating positions to reduce complexity and fees, utilizing lower-cost alternatives with similar characteristics. Tax efficiency improvement. Analyzing the tax cost of various investments, strategically placing tax-inefficient investments in tax-advantaged accounts, utilizing tax-managed funds or ETFs in taxable accounts. Liquidity management. Ensuring appropriate balance between liquid and illiquid investments, creating a liquidity ladder for different time horizon needs, maintaining emergency reserves without sacrificing long-term growth. These optimization techniques go beyond simple buy and hold investing to potentially enhance returns and reduce risk over time. The role of technology in rebalancing and optimization. Modern portfolio management has been transformed by technology. Portfolio management software automatically calculates current allocations across multiple accounts, identifies specific rebalancing needs, tracks performance against benchmarks and goals, often available through brokerages or as standalone applications. Robo-advisors, automated services that handle rebalancing and basic optimization, typically use algorithms to maintain allocations and harvest tax losses, usually charge lower fees than human advisors, best for relatively straightforward investment approaches. Advanced analytics tools, sophisticated software for factor analysis, correlation modeling, and portfolio optimization, previously available only to institutional investors but increasingly accessible to individuals, can identify non-obvious risks and opportunities within portfolios. Tax optimization software, specialized tools for tax loss harvesting and tax-efficient investing, can systematically identify opportunities to reduce tax impact, often integrated with broader portfolio management platforms. These technological tools can significantly reduce the time and expertise required for effective portfolio management while potentially improving results. Dynamic asset allocation. Adapting to market conditions beyond mechanical rebalancing, some investors adopt dynamic allocation approaches that adjust based on market conditions. Valuation-based adjustments, gradually reducing exposure to asset classes with stretched valuations, increasing allocation to undervalued assets, using metrics like CAPE. Cyclically adjusted price-to-earnings ratio, price-to-book, or dividend yield to inform decisions. Economic regime positioning, adjusting allocations based on the current economic environment. Expansion, peak, contraction, trough. Overweighting assets that historically perform well in the current regime, reducing exposure to vulnerable assets during transitions. Trend following, increasing allocations to assets in established uptrends, reducing exposure to assets in downtrends, using moving averages or other technical indicators to identify trends. Volatility management, reducing equity exposure during periods of high market volatility, increasing exposure when volatility is low, using the VIX volatility index, or other volatility measures as signals. These approaches require more active management and introduce timing risk, but when implemented systematically rather than emotionally, they may improve long-term risk-adjusted returns for some investors. When and how to change your core strategy. While regular rebalancing maintains your strategy and minor optimizations enhance it, sometimes fundamental changes to your approach are warranted. Appropriate reasons for strategic changes. 1. Major life transitions, marriage, divorce, children, career changes, or retirement may necessitate strategy shifts. 2. Significant goal revisions, substantial changes to your financial objectives or timeline. 3. Persistent underperformance, strategy fails to meet reasonable benchmarks over multiple market cycles, not just short-term. 4. Structural market changes, fundamental shifts in how markets function, for example, changes in correlation patterns between asset classes. 5. Significant tax law changes, new tax legislation that fundamentally alters the attractiveness of certain strategies. Inappropriate reasons for strategic changes. 1. Recent performance, abandoning a strategy because of short-term underperformance. 2. Media influence, changing approach based on financial news, predictions, or hot investment ideas. 3. Peer comparison, altering strategy because others appear to be doing better. 4. Emotional reactions, making changes due to fear, greed, or other emotional triggers. When legitimate reasons for strategic change arise, implement changes methodically. 1. Clearly document why the change is necessary. 2. Establish specific criteria for the new strategy's success. 3. Make changes gradually to minimize market timing risk. 4. Be mindful of tax implications when repositioning. 5. Update your investment policy statement to reflect the new approach. Case study. The evolution of a portfolio. Let's examine how one investor's portfolio evolved over 15 years through rebalancing, optimization, and strategic adjustments. Initial portfolio, age 35. 70% U.S. Stock Index Fund, 20% International Stock Index Fund, 10% Bond Index Fund. Quarterly rebalancing when allocations drifted by 5%. First optimization, age 38. Added Small Cap Value Fund for factor diversification. Implemented tax loss harvesting in taxable accounts. New allocation, 55% U.S. Large Cap, 15% U.S. Small Value, 20% international, 10% bonds. Strategic adjustment, age 42. Added real estate allocation after detailed research, shifted some international from developed to emerging markets. New allocation, 50% U.S., split between large and small, 20% international, split between developed and emerging, 10% rights, 20% bonds. Life change adjustment, age 45, after unexpected inheritance. Added alternative investments, increased bond allocation slightly as wealth grew. New allocation, 45% U.S. stocks, 15% international, 10% rights, 5% alternatives, 25% bonds. Pre-retirement positioning, age 50. Began gradual shift toward more income-producing assets, added dividend-focused allocation, increased high-quality bonds for stability. New allocation, 20% U.S. growth, 20% dividend stocks, 15% international, 10% rights, 5% alternatives, 30% bonds. Throughout these changes, regular rebalancing maintained the intended risk level, while thoughtful adjustments adapted the strategy to changing goals, increased wealth, and evolving market conditions. Building your rebalancing and optimization plan to implement effective portfolio management. 1. Establish clear allocation targets. Document your intended allocation percentages for each asset class and subclass. 2. Define rebalancing parameters. Decide whether you'll use calendar-based, percentage-based, or combined triggers. 3. Create a rebalancing worksheet. Develop a simple spreadsheet or use software to calculate current allocations and required adjustments. 4. Implement tax-efficient practices. Determine which accounts to rebalance first and how to minimize tax impact. 5. Schedule regular optimization reviews. Set aside time annually to consider potential improvements to your strategy. 6. Document your process. Keep records of all rebalancing activities and the reasoning behind optimization changes. 7. Automate where possible. Use technology to simplify monitoring and implementation. With a systematic approach to portfolio maintenance, you can capture the benefits of rebalancing while continuing to improve your investment approach over time. In the next chapter, we'll discuss strategies for protecting your wealth during market downturns, an inevitable part of every investor's journey. Chapter 23. Protecting your wealth during market downturns. Weathering financial storms. Market downturns are an inevitable part of investing. Whether they come as sharp crashes or prolonged bear markets, these periods test both our financial preparations and psychological resilience. In this chapter, we'll explore strategies for protecting your wealth and potentially even benefiting from these challenging phases of the market cycle. Understanding different types of downturns. Not all market declines are created equal. Understanding the different types helps you respond appropriately. Corrections, 10 to 20% declines, relatively common, occurring roughly once per year on average, usually brief. Lasting weeks to a few months, often healthy resets that prevent larger bubbles, typically don't coincide with economic recessions. Bear markets, 20% plus declines, less frequent. Occurring roughly every 3 to 5 years, last months to years, average around 14 months. Often but not always associated with economic recessions, may involve fundamental repricing of assets. Crashes, sudden, severe declines. Rapid drops of 20% plus over days or weeks, usually triggered by unexpected events or sudden panic, often followed by high volatility, may or may not develop into longer bear markets. Secular bears. Extended periods of poor returns. Multi-year or even decade-long periods of flat or negative returns may include multiple cyclical bulls and bears within the longer trend, usually involve significant valuation compression. Typically end with extreme pessimism and very attractive valuations. Each type of downturn requires different protective strategies. And recognizing which you're facing helps determine the appropriate response. Preparation. Before the storm, the most effective protection happens before downturns begin. Appropriate asset allocation, ensuring your portfolio's stock/bond mix matches your risk tolerance and time horizon, having enough conservative assets to avoid forced selling during declines. Diversifying across multiple asset classes and subclasses, including uncorrelated or negatively correlated assets. Liquidity planning, maintaining an emergency fund of 3 to 12 months of expenses. Creating a cash buffer for near-term expenses and opportunities, establishing lines of credit before they're needed, ensuring you won't need to sell equities during recovery phases. Stress testing. Calculating how your portfolio would perform in various downturn scenarios, determining your sleep at night factor, how much decline you can tolerate emotionally, identifying vulnerable aspects of your financial situation beyond investments, evaluating income stability and contingency plans. Mental preparation, studying historical market declines to build perspective, creating decision rules in advance for various scenarios, developing a bear market action plan when emotions aren't running high, building a support network of like-minded investors. These preparatory steps significantly increase your ability to maintain course during market turbulence and may even allow you to capitalize on opportunities that arise. Defensive allocation strategies. Several allocation approaches can reduce portfolio vulnerability to severe drawdowns. The permanent portfolio, equal allocation to stocks, long-term bonds, gold, and cash, designed to perform reasonably well in all economic environments. Historically lower volatility than traditional stock/bond portfolios, requires significant discipline to maintain. Through all market phases. Risk parity, allocating by risk contribution rather than dollar amounts, typically involves leveraging lower risk assets, bonds, and reducing higher risk assets, stocks. Aims for balanced risk exposure across multiple economic scenarios, can reduce drawdowns during equity bear markets. Defensive value, focusing on high-quality companies with strong balance sheets, stable earnings, and reasonable valuations, emphasizing sectors traditionally less sensitive to economic cycles, consumer staples, utilities, healthcare. Including dividend aristocrats with long histories of maintaining dividends during downturns, often outperforms during bear markets while still participating in bull markets. Trend following, reducing exposure to assets in established downtrends, using moving averages or other technical indicators to identify trend changes, can reduce maximum drawdowns by sidestepping prolonged declines. Requires discipline to follow signals without emotional override. Option hedging, using put options or collars to protect against significant declines, creating asymmetric risk/reward profiles for specific scenarios, effectively purchasing portfolio insurance at a cost, most appropriate for protecting concentrated positions or during periods of specific concern. These strategies represent different trade-offs between protection and potential return. The most appropriate approach depends on your goals, time horizon, and psychological comfort. Tactical adjustments during downturns. Once a downturn is underway, several tactical moves can help protect wealth. Rebalancing into strength, selling assets that have held up well to purchase those that have declined significantly. Maintaining discipline about target allocations even when it feels uncomfortable. Potentially accelerating regular rebalancing schedule during high volatility, being particularly attentive to tax loss harvesting opportunities. Raising selective cash, increasing cash positions strategically rather than panic selling everything, selling highest valued, most vulnerable assets first, creating reserves for potential opportunities later in the downturn, considering scaling out gradually rather than making all or nothing decisions. Defensive rotation, shifting equity exposure toward more defensive sectors and factors, increasing quality bias across the portfolio, reducing cyclical exposure if economic recession seems likely, favoring companies with pricing power during inflationary periods. Income enhancement, focusing on sustainable income streams during price volatility, potentially increasing allocation to high-quality dividend payers. Considering strategic use of fixed income or preferred securities, exploring closed-end funds trading at discounts to net asset value. Shortening duration, reducing interest rate risk in bond portfolios if rates are rising. Shifting toward shorter-term fixed income securities, considering floating rate instruments during inflationary periods, being cautious with long-duration assets. During monetary tightening, these adjustments should be made deliberately and systematically rather than reactively. The goal is measured adaptation to changing conditions, not wholesale abandonment of your core strategy. Opportunity creation in bear markets. Beyond defense, bear markets create exceptional opportunities for long-term wealth building. Strategic buying plans, creating a shopping list of high-quality assets to purchase at specific price levels, implementing dollar cost averaging on a more aggressive schedule, allocating a specific opportunity fund to deploy during significant declines, using limit orders to automatically purchase assets if they hit target prices. Roth conversions, converting traditional IRA assets to Roth when values are depressed, paying taxes on lower values and allowing future recovery to happen tax-free, particularly powerful for young investors with long time horizons, requiring careful analysis of current and expected future tax rates. Tax loss harvesting, systematically realizing losses to offset gains elsewhere, banking tax losses for future years while maintaining market exposure, upgrading portfolio quality while capturing tax benefits, potentially adding alpha through tax management. Portfolio upgrade opportunities, replacing good investments with great ones at attractive valuations, increasing quality across the portfolio during distressed pricing, accessing fund managers or private investments that were previously closed, building positions in forever holdings at favorable long-term entry points. Business and real estate acquisition, exploring business purchase opportunities as valuations decline, investigating distressed real estate markets for long-term holdings, deploying capital into cash-flowing assets when competition decreases, negotiating favorable terms and seller financing in buyers' markets. Bear markets often create the most significant wealth-building opportunities of an investor's lifetime for those with the preparation, capital, and emotional fortitude to act counter to prevailing sentiment. Psychological strategies for market declines. The greatest threat to most investors during downturns isn't market performance but their own emotional reactions. Information management, reducing consumption of financial media during volatile periods, focusing on long-term data rather than daily movements, consulting historical context to maintain perspective, reading the works of seasoned investors who have navigated multiple cycles. Decision frameworks, creating pre-committed rules for actions during declines, utilizing checklists to ensure rational decision-making, implementing cooling-off periods before making significant changes, requiring written justification for any major portfolio adjustments. Support systems, consulting with trusted advisors who know your plan and psychology, connecting with like-minded investors for perspective and encouragement, discussing concerns with someone who can provide objective feedback, potentially limiting discussions with those prone to panic or performance chasing. Focus shifting, concentrating on the income generated by your portfolio rather than price fluctuations, reviewing progress toward long-term goals instead of short-term performance, attention to portfolio values in terms of units or shares owned rather than dollars, engaging in non-financial activities to maintain life balance during stressful periods. Opportunity mindset, training yourself to become excited rather than fearful during declines, viewing market drops as sales on assets you want to own. Long-term, keeping a journal of thoughts during downturns to reference during future episodes, studying how exceptional investors behaved during historical bear markets. These psychological strategies often make the difference between those who are devastated by bear markets and those who emerge stronger on the other side. Case study: navigating the 2008-2009 financial crisis. Let's examine how one investor successfully navigated one of the most severe downturns in modern financial history. Richard's pre-crisis portfolio, early 2007, 65% U.S. and international stocks, 25% bonds, 10% real estate and alternatives, net worth, $850,000 age. 42 warning signs and early actions, late 2007. Noticed deteriorating housing market and financial sector stress, reduced equity allocation to 55% by selling most financial sector exposure, increased quality of remaining equity holdings. Established 6-month emergency fund separate from investment accounts, created a bear market action plan with specific trigger points during the crisis. 2008-2009, maintained regular contributions to retirement accounts throughout the decline, rebalanced quarterly, buying more equities as they fell, implemented tax loss harvesting. Banking over $30,000 in tax losses, converted $50,000 from traditional IRA to Roth at depressed valuations, purchased a foreclosed rental property in early 2009, added to highest conviction stock positions at major market lows post-crisis results. 2010. Portfolio recovered faster than broader market due to systematic buying during decline. Tax losses continued providing benefits for several years. Roth conversion assets appreciated tax-free. During recovery, rental property provided both appreciation and income. Most importantly, stayed invested for the subsequent bull market. Net worth by end of 2010, $980,000, despite the worst financial crisis since the Great Depression. Richard's success came not from predicting the crash, but from preparation, systematic decision-making, and maintaining an opportunity mindset during the crisis. Specialized protection for retirees. Retirees face unique challenges during market downturns since they're often withdrawing from portfolios rather than adding to them. Specialized strategies include bucket strategy, maintaining 1 to 2 years of expenses in cash, 3 to 7 years of expenses in conservative fixed income, longer-term growth assets for years 8 plus, replenishing near-term buckets. Systematically in favorable conditions, dynamic withdrawal adjustments, reducing discretionary spending during significant market declines, creating tiered spending plans with needs, wants, and wishes categories, using guideline-reduced withdrawal rates during bear markets, potentially returning to higher withdrawals after market recovery. Income floor creation, establishing guaranteed income sources to cover essential expenses, considering options like Social Security optimization, pensions, and annuities, creating a separate income portfolio, distinct from growth assets, ensuring basic needs are met regardless of market conditions. Reverse mortgages as backup, establishing a home equity conversion mortgage, HECM, line of credit, using it strategically to avoid selling assets during market downturns, allowing growth assets time to recover before resuming withdrawals, particularly useful for retirees with significant home equity. These approaches help retirees avoid the devastating impact of sequence of returns risk, the danger of large market declines early in retirement when portfolio withdrawals magnify the negative impact. Building your downturn protection plan. To create your personalized protection strategy. 1. Assess your vulnerability. Calculate your current risk exposure across all assets. Identify income sources that could be affected by economic contractions. Evaluate your personal emotional reactions to previous market declines. Determine your portfolio's liquidity under stress conditions. 2. Design your protection architecture. Select the defensive allocation approaches most aligned with your goals and psychology. Establish specific trigger points for potential tactical adjustments. Create your opportunity list and funding plan for when values become attractive. Develop your psychological support system before it's needed. 3. Document your downturn action plan. Write specific, if-then, instructions for various market scenarios. Include both defensive actions and opportunity-seeking actions. Establish timeframes and review triggers. Have this reviewed by a trusted advisor or financially sophisticated friend. 4. Implement preparatory steps now. Adjust current allocations if they exceed your true risk tolerance. Establish emergency reserves appropriate to your situation. Test and refine your rebalancing system. Educate yourself about historical market cycles and investor behavior. Remember that market downturns, while emotionally challenging, are a normal and necessary part of the investment cycle. Those who prepare for them rather than fear them often emerge with both their wealth and their confidence intact. In the next chapter, we'll explore estate planning and wealth preservation strategies to ensure that the financial freedom you build benefits not only yourself but those you care about most. Chapter 24, Estate Planning and Wealth Preservation. Protecting your legacy. Building wealth is only part of the journey. Preserving it and ensuring it benefits those you care about requires thoughtful estate planning. Whether your net worth is measured in thousands or millions, proper planning ensures your assets are protected, your wishes are honored, and your legacy extends beyond your lifetime. In this chapter, we'll explore the essential elements of estate planning and wealth preservation, helping you create a comprehensive strategy that aligns with your values and goals. Foundation documents. The essential for every adult, regardless of wealth level, needs 4 fundamental estate planning documents. 1. Will, directs the distribution of probate assets, names guardians for minor children, appoints an executor to administer your estate, provides instructions for specific bequests. 2. Durable power of attorney for finances, authorizes someone to handle your financial affairs if you're incapacitated, allows bill payment, investment management, and financial decisions, can be immediate or springing, activated only upon incapacity, prevents the need for court-appointed conservatorship. 3. Advance Healthcare Directive, documents your wishes regarding medical treatment, typically includes a living will and healthcare power of attorney, guides healthcare decisions if you cannot communicate, relieves loved ones from making difficult decisions without guidance. 4. HIPAA authorization, allows designated individuals to access your medical information, facilitates communication with healthcare providers, essential for those helping manage your healthcare. Particularly important for unmarried partners, these foundational documents ensure your basic wishes are followed and allow your loved ones to help you when needed. Without them, courts may make decisions that don't align with your preferences, and your family may face unnecessary challenges during already difficult times. Beyond the basics, trust strategies. For many individuals, trusts offer significant advantages beyond what basic wills provide. Revocable living trust avoids probate process, saving time, money, and maintaining privacy, continues functioning during incapacity, unlike a will. Can be changed or revoked during your lifetime, provides centralized asset management, does not provide asset protection or tax benefits. Irrevocable trusts for specific purposes, asset protection from creditors and lawsuits, estate tax reduction through gifting strategies, special needs planning for disabled beneficiaries, spendthrift provisions for financially irresponsible heirs, control from the grave through specific distribution provisions, specialized trust structures, qualified personal residence trust. QPRT, removes home value from estate, grantor retained annuity trust, GRAT, transfers appreciation while retaining income, charitable remainder trust, CRT, provides income while benefiting charity, irrevocable life insurance trust, ILIT, keeps insurance proceeds outside taxable estate, dynasty trust, extends wealth protection across multiple generations. The appropriate trust strategy depends on your specific goals, family situation, and the tax laws applicable to your estate size. Tax-efficient wealth transfer. For larger estates, tax efficiency becomes increasingly important. Lifetime gifting strategies, annual exclusion gifts, $15.00 per recipient per year as of 2021, direct payment of medical and educational expenses, unlimited amounts. Strategic use of lifetime estate and gift tax exemption, valuation discount techniques for business interests, charitable giving strategies with dual benefits basis. Step-up planning. Understanding the tax advantages of assets inherited versus gifted, strategic retention of appreciated assets until death, potential use of step-up in community property states, weighing estate tax versus capital gains tax considerations, business succession planning, family limited partnerships and LLCs for controlled transfers, buy-sell agreements funded with life insurance, valuation strategies for closely held businesses, gradual transition of management and ownership, equalizing inheritances among operating and non-operating heirs, life insurance strategies, creating instant liquidity for estate taxes and expenses, wealth replacement when assets go to charity, equalizing inheritances among heirs, leveraging annual gifts through premium payments, potentially removing proceeds from taxable estate through proper structuring. The tax landscape for estates changes frequently with legislative action, making regular review with qualified professionals essential for optimal planning. Asset protection strategies. Preserving wealth requires protecting it from potential threats. Liability insurance, maintaining appropriate liability limits on home and auto policies, adding umbrella liability coverage, typically $1 to $5 million or more. Professional liability insurance for business owners or professionals, directors and officers, coverage for those serving on boards, business entity structures, using appropriate entities, LLCs. Corporations. For business activities, maintaining proper corporate formalities to ensure separation, creating holding companies for valuable assets, implementing multiple entity strategies for different risk profiles. Asset segregation, keeping high-risk assets separate from safe assets, utilizing tenancy by the entirety in states where available, understanding exempt assets under state law. Appropriate titling of assets between spouses. Advanced protection strategies, domestic asset protection trusts in select states, foreign asset protection trusts for higher level protection, equity stripping techniques for real estate, retirement account protection under federal and state law. The level of asset protection needed depends on your professional risk, business activities, and overall wealth level. The goal is creating appropriate protection without undue complexity or cost. Legacy planning. Beyond money. True legacy planning extends beyond financial assets to values, knowledge, and impact. Values and wisdom transfer. Creating an ethical will or legacy letter to share life lessons, recording family stories and history for future generations, documenting the values that guided your life and financial decisions, sharing the why behind your estate distribution decisions. Family education, financial literacy training for heirs, structured introduction to family wealth management, creation of family constitutions or mission statements, family meetings to discuss values, goals, and responsibilities. Philanthropic legacy, establishing family foundations or donor-advised funds, involving children and grandchildren in giving decisions, creating specific charitable vehicles aligned with values, perpetual giving structures that continue beyond your lifetime. Experience creation, funding specific experiences or educational opportunities, creating family traditions and gathering places, establishing family banks for entrepreneurial ventures, supporting passion projects and personal development. This dimension of estate planning often creates the most meaningful and lasting impact, preventing wealth from becoming a burden rather than a blessing for future generations. Digital asset planning. Increasingly important in our digital age is planning for online accounts and digital assets, digital inventory, comprehensive list of online accounts, subscriptions, and assets, password management system accessible to fiduciaries, documentation of digital currency holdings and access methods, catalog of digital photos, videos, and other sentimental digital items. Access authorization, specific legal language in wills and trusts authorizing digital access, compliance with revised Uniform Fiduciary Access to Digital Assets Act, use of online tools provided by platforms like Facebook's Legacy Contact, letter of instruction regarding handling of digital presence. Digital asset valuation, identifying digital assets with financial value, providing instructions for cryptocurrency management. Addressing intellectual property in digital form, planning for business-related digital assets and accounts, social media and email, specific instructions for each platform. Preservation, memorialization, deletion. Guidelines for post-death messaging or announcements, preservation of important communications, management of online identities after death without proper digital asset planning. Valuable or sentimental digital assets may be lost, and fiduciaries may face significant challenges accessing necessary accounts. Special situations in estate planning. Certain circumstances require specialized planning approaches. Blended families, balancing obligations to current spouse and children from previous marriages, utilizing QTIPs and marital trusts to provide for spouse while preserving assets for children. Addressing potential conflicts proactively through clear documentation, considering life insurance for wealth replacement strategies. International considerations, planning for assets in multiple countries, addressing potential dual citizenship issues, navigating treaties and foreign inheritance laws, considering specialized structures for international assets. Business owner transitions. Developing comprehensive succession plans, addressing liquidation versus continuation scenarios, equalization strategies for active versus non-active heirs, key person insurance and buy-sell. Funding special needs planning, creating specialized trusts that don't disrupt government benefits, selecting appropriate trustees with knowledge of special needs, long-term care planning and support coordination. Letter of intent providing detailed guidance for caregivers' pets as family members, pet trusts to ensure continued care, identifying suitable caregivers and providing funding. Detailed care instructions and preferences, potential sanctuary arrangements for exotic or long-lived animals. These situations highlight the importance of customized planning that addresses your specific family dynamics and concerns. Selecting and working with professional advisors. Effective estate planning typically requires professional guidance. Team composition, estate planning attorney for legal documentation, financial advisor for investment and cash flow planning, accountant for tax implications and planning, insurance professional for appropriate coverage, trust officer if corporate trustee is appropriate. Selection criteria, specialized expertise in relevant areas, experience with estates of similar complexity. Communication style that matches your preferences, clear fee structures and transparency, collaborative approach with other advisors. Maximizing the relationship, preparing thoroughly for meetings. Asking clarifying questions until you understand recommendations, being honest about family dynamics and concerns. Updating advisors when circumstances change, reviewing plans regularly. Typically every 3 to 5 years, the right professional team provides not just technical expertise but peace of mind that your affairs are in order. Case study. A comprehensive estate plan. Let's examine how one family implemented a comprehensive estate planning approach. The Wilsons situation. Married couple in their 60s. Combined net worth of $5 million, 2 adult children from their marriage, 1 adult child from husband's previous marriage, small family business worth approximately $2 million, primary residence and vacation home, investment portfolio including retirement accounts. Their estate planning approach. Foundation documents. Comprehensive wills with contingent trusts for any future grandchildren, durable powers of attorney with immediate effectiveness, detailed healthcare directives reflecting personal values, HIPAA. Authorizations for all immediate family members. Trust strategy. Revocable living trust as primary vehicle, bypass trust provisions to utilize both estate tax exemptions, QTIP trust for husband's assets to provide for wife while ensuring assets ultimately pass to his children, spendthrift provisions for one child with financial management challenges. Business succession. Buy-sell agreement with key employee, life insurance funding for purchase upon death, detailed transition plan with training provisions, equalization provisions for non-involved children, tax planning, annual gifting program to children and grandchildren, strategic Roth conversions during lower income years, charitable remainder trust for highly appreciated assets, basis step-up planning for investment assets, asset protection, $5 million umbrella liability policy, LLC structure for rental properties, professional liability coverage for business, strategic asset titling between spouses, legacy components, recorded video messages sharing family history and values, detailed letters of instruction for personal items, family vacation fund established in trust, donor advised fund with children as successor advisors, digital assets, complete inventory of online accounts, password management system with fiduciary access, specific instructions for social media accounts, legacy contact designations where available. This comprehensive approach addressed not just the distribution of the Wilsons' assets but their protection, tax efficiency, and the communication of values to future generations. Implementing your estate plan. To create and implement your own estate plan. 1. Assessment and goal setting. Inventory all assets and liabilities. Identify key individuals, beneficiaries, fiduciaries, guardians. Clarify primary goals and concerns. Determine appropriate level of planning based on complexity. 2. Professional consultation. Select appropriate professional team. Discuss goals, concerns, and family dynamics. Review and understand recommendations. Make informed decisions based on advice and personal preferences. 3. Document creation and execution. Work with attorney to draft necessary documents. Review documents thoroughly before signing. Execute documents with appropriate witnesses and notarization. Store originals securely with copies to fiduciaries. 4. Asset alignment. Retitle assets as necessary to align with plan. Update beneficiary designations on insurance and retirement accounts. Fund trusts appropriately. Verify proper implementation with professional guidance. 5. Communication and education. Inform fiduciaries of their roles and responsibilities. Discuss relevant aspects of plan with affected family members. Create, in case of emergency, file with key information. Consider family meeting for broader discussion if appropriate. 6. Regular review and updates. Calendar regular reviews, at least every 3 to 5 years. Update after major life events, births, deaths, marriages, divorces. Revisit after significant tax law changes. Refresh the plan as assets grow or circumstances evolve. Remember that estate planning is not a one-time event but an ongoing process that evolves as your life, laws, and goals change over time. The peace of mind dividend. Perhaps the greatest benefit of comprehensive estate planning is the peace of mind it provides. Knowing that you've thoughtfully arranged for the care of your loved ones, the efficient transfer of your assets, the minimization of taxes and expenses, the protection of your legacy, the expression of your values and wishes. This peace of mind allows you to focus on living fully in the present, confident that you've provided properly for the future. It's a final gift not only to your loved ones but to yourself. In our concluding chapter, we'll bring together all aspects of this financial freedom journey, from psychology to practical implementation, to help you create a life of true wealth in all its dimensions. Chapter 25: The Integrated Life of Financial Freedom Beyond Money, True Wealth and Fulfillment. Throughout this guide, we've explored numerous strategies for building financial wealth, from investment psychology to business creation, from tax optimization to estate planning. But as we conclude our journey together, it's essential to step back and consider the ultimate purpose of financial freedom. True wealth extends far beyond account balances and asset valuations. It encompasses health, relationships, purpose, and personal growth, dimensions that money can facilitate but never replace. In this final chapter, we'll explore how to integrate financial success with a truly wealthy life in all its dimensions. The 5 dimensions of true wealth. Financial resources represent just one of 5 crucial dimensions of a truly wealthy life. Financial capital, the monetary resources that provide options and security, includes investments, businesses, real estate, and cash, properly managed. It creates time, freedom, and opportunity, the primary focus of traditional financial planning. Human capital, your health, energy, skills, knowledge, and abilities, directly impacts your capacity to enjoy and utilize financial resources, often depreciates without conscious investment and maintenance, the foundation upon which all other forms of wealth depend. Social capital, the quality and depth of your relationships, family bonds, friendships, professional networks, and community connections, sources of support, meaning, and opportunity, often inversely correlated with financial focus without conscious balance. Purpose capital, your sense of meaning, contribution, and legacy, connection to something larger than yourself, alignment between daily activities and core values, the context that gives financial achievement its significance. Time capital, your most finite and precious resource, determines how you experience and use all other forms of capital. The ultimate measure of wealth is discretionary control over your time, ironically, often sacrificed in pursuit of financial capital. True financial freedom requires optimizing across all 5 dimensions rather than maximizing financial capital at the expense of the others. The Wealth Integration Matrix. To help visualize the integration of these dimensions, consider this matrix. Dimension assessment questions: investment strategies, protection strategies, financial. What is your net worth? Income sources, asset allocation, business building, passive income, insurance, legal structures, emergency funds. Human, how is your health? Skills, knowledge, ongoing education, health practices, personal growth, medical care, stress management, balance. Social quality of key relationships, network depth, time for family, genuine connections, giving boundaries, reciprocity, value-aligned associations. Purpose. Do your activities reflect your values? Meaningful work, contribution, legacy creation. Values clarification, intentional living, regular reflection. Time, how much discretionary time do you have? Automation, delegation, simplification. Time boundaries, prioritization. No. Practice using this matrix helps identify both strengths and gaps in your wealth integration strategy. The goal is balanced optimization rather than maximization in any single dimension. Financial wealth as a tool, not a destination. Reframing financial wealth as a tool rather than a destination transforms how you approach money decisions. From accumulation to allocation, shifting focus from "how much can I acquire" to "how should I deploy resources?" Recognizing diminishing returns of financial capital beyond certain thresholds, strategic sufficiency rather than endless pursuit, intentional balance between saving, spending, and giving. From comparison to contribution, moving from "how do I compare to others" to "how can I contribute uniquely?" Finding your personal financial enough, rather than chasing relative status, measuring success by impact and alignment rather than acquisition, developing your unique definition of financial success. From scarcity to stewardship, transitioning from fear-based hoarding to purposeful management, seeing yourself as a steward of resources rather than merely an owner, balancing preservation with purposeful deployment, creating a legacy of both financial and non-financial wealth. From isolation to integration, breaking down artificial barriers between financial life and real life. Ensuring financial decisions support rather than undermine other wealth dimensions, recognizing how financial choices reflect and shape core values, creating collaborative rather than competitive wealth strategies. This reframing doesn't diminish the importance of sound financial management, it elevates it by connecting financial decisions to a larger life context. The psychology of enough. Perhaps the most challenging aspect of financial freedom is developing a personal definition of enough. The hedonic treadmill problem, our tendency to adapt to improved financial circumstances, the shifting goalposts phenomenon, I'll be happy when I have X. Y. Increased consumption rarely leads to increased happiness. Psychological studies on the relationship between money and well-being. Practical approaches to finding your enough. Experimentation with different consumption and saving levels. Values clarification exercises to identify true priorities. Creating concrete freedom vision scenarios. Regular gratitude practices to appreciate current abundance. The 3 stages of financial enough. 1. Survival enough, meeting basic needs and security. 2. Freedom enough, creating genuine lifestyle options. 3. Impact enough, deploying resources for maximum meaning and contribution. Warning signs of never enough syndrome. Persistent dissatisfaction despite achieving previous goals. Comparison-based financial decisions, sacrificing health or relationships for financial gain, inability to enjoy current wealth while pursuing more. Discovering your personal enough doesn't mean abandoning ambition or growth, it means pursuing them from a foundation of sufficiency rather than perceived lack. Time freedom, the ultimate currency of all resources, time is the only truly irreplaceable one. Financial freedom ultimately creates time freedom. Time allocation audit, tracking how you currently spend the 168 hours in each week, identifying activities that drain versus energize you, calculating your true hourly rate, including all work-related time, determining your discretionary time percentage, buying time strategically, using financial resources to reclaim time through delegation, calculating the ROI of time saving services and tools, identifying high-value time investments versus low-value time expenditures, creating systems that allow freedom from repetitive tasks. Time management for the financially free, transitioning from external to internal scheduling structures, developing productivity approaches that work without external accountability, creating purpose and structure without traditional employment, balancing freedom with meaningful commitment. The time-money trade-off calculation, determining your personal indifference point for time versus money, when to trade money for time and vice versa, recognizing when additional money provides diminishing time value. The critical shifts in this calculation as net worth increases as you progress toward financial freedom. Regularly reassessing this most precious resource ensures you're truly getting what you want from your wealth-building journey. Relationships and money, the social dimension. Financial freedom affects and is affected by our relationships in profound ways. Family wealth dynamics, creating shared financial vision with partners and spouses, navigating different money personalities and histories, teaching children healthy money attitudes and skills. Managing extended family expectations and boundaries. Friendship in a financial freedom context, maintaining connections as financial situations diverge, handling social pressure for lifestyle inflation, supporting others' journeys without creating dependency, finding peers who share your financial philosophy. Community and belonging, using financial resources to strengthen community ties. Creating or joining intentional communities around shared values, the role of giving and volunteering in social connection, avoiding isolation as traditional work relationships change. The relationship investment portfolio, diversifying relationship types for resilience and richness, regular relationship rebalancing to maintain important connections, strategic investment in high potential relationships, creating relationship structures that survive life transitions. Financial freedom should enhance rather than diminish your social capital, something that requires conscious attention as your financial situation evolves. Purpose and contribution. The why of wealth without purpose, financial freedom can become a hollow achievement. Consider these dimensions of purpose-driven wealth: finding your unique contribution, the intersection of talents, passions, and market needs, moving from success to significance in later wealth stages, creating versus consuming as a path to fulfillment, building a legacy that transcends financial assets, meaningful work beyond financial need, redefining work when money is no longer the primary motivator, creating versus taking existing opportunities, the importance of challenge and growth regardless of net worth. Maintaining productive engagement throughout life stages, strategic philanthropy, moving beyond checkbook charity to impact-focused giving, aligning philanthropy with personal values and strengths. Direct versus indirect approaches to creating change, building giving strategies with the same care as investment strategies, teaching and mentoring, sharing financial wisdom and experience with others, creating leverage through developing others' capabilities, the reciprocal benefits of mentoring relationships, structured versus informal knowledge transmission. Purpose capital often appreciates precisely when financial capital reaches diminishing returns in terms of life satisfaction, making it an essential component of true wealth. The financially free lifestyle design process. Creating a life of integrated wealth requires intentional design. Consider this process. 1. Vision creation. Detailed visualization of your ideal life across all 5 wealth dimensions. Specific scenarios for 1, 5, and 10 years in the future. Identification of non-negotiable elements versus preferences. Reality testing these visions with trusted others. 2. Gap analysis. Honest assessment of current reality in each dimension. Identification of primary constraints and opportunities. Required resources for moving from current to desired state. Sequencing necessary changes for maximum leverage. 3. Experiment design. Small-scale tests of major lifestyle elements before full commitment. Time-bounded trials of different approaches. Gathering data about what actually creates satisfaction. Iterative refinement based on real-world experience. 4. System building. Creating infrastructure that supports your ideal lifestyle. Automating routine decisions to preserve decision energy. Building accountability mechanisms for maintaining balance. Developing metrics that track progress across all dimensions. 5. Community creation. Finding or building communities that share your values. Creating structures for mutual support and growth. Developing relationships that strengthen your vision. Building collaborative ventures that enhance impact. 6. Regular reassessment. Scheduled reviews of satisfaction across all dimensions. Adaptation to changing circumstances and preferences. Celebration of progress and acknowledgement of challenges. Refinement of vision based on evolving understanding. This design process applies the same strategic thinking to lifestyle creation that you've applied to wealth building, ensuring that financial freedom translates into true life satisfaction. Case study. The evolution of a financially free life. Let's examine how one individual navigated the journey to integrated wealth. Michael's journey. Stage 1. Conventional success, ages 25 to 35. Built successful technology career with progressively higher income, focused almost exclusively on financial capital accumulation, neglected health, worked long hours. Minimal social life, achieved financial success but experienced burnout and relationship challenges. Stage 2. Crisis and reassessment, age 36. Health crisis, forced confrontation with lifestyle imbalances, realized financial success wasn't translating to life satisfaction, began systematic reassessment of values and priorities, created initial vision of integrated wealth across all dimensions. Stage 3. Strategic redesign, ages 37 to 40, negotiated reduced work schedule to reclaim time, invested in health through improved nutrition, exercise, and stress management, built passive income streams to reduce dependence on active income, reconnected with neglected relationships and community. Stage 4, progressive freedom, ages 41 to 45. Achieved basic financial independence through combined active and passive income, transitioned to consulting role with greater autonomy, began mentoring younger professionals, developed philanthropic strategy aligned with personal experience and values. Stage 5, integrated freedom, ages 46 to 50. Complete financial independence with multiple income streams, created purpose-driven venture combining skills and passions, built vibrant community of like-minded individuals, maintained balance across all 5 wealth dimensions, focused on legacy and impact while enjoying present abundance. Michael's evolution demonstrates how financial freedom can transition from a narrowly financial goal to a platform for a richly rewarding and purposeful life, but only through conscious integration of all wealth dimensions. Common pitfalls in the financial freedom journey. Several predictable challenges arise as people progress toward and achieve financial freedom. Identity disruption, loss of identity tied to traditional career or business role, uncertainty about who you are without financial striving, the need to build new identity components beyond achievement, strategies for identity evolution rather than replacement. Purpose vacuum, the now what question once financial goals are achieved, feeling adrift without clear financial objectives, the need for non-financial growth. Frontiers, developing purpose through exploration and experimentation. Relationship evolution, changing dynamics with those still in conventional paths, finding peers who understand your new reality, navigating family expectations about wealth, building authentic connections beyond financial status. Stewardship anxiety, fear of losing or mismanaging accumulated wealth, decision paralysis from too many options, balancing preservation with enjoyment and impact, finding the right advisors for your unique situation. Meaning pursuit, the sometimes surprising challenge of creating meaning without external structures, balancing structured versus unstructured time, finding the right level of challenge and growth, creating personal metrics beyond financial measurement. Awareness of these potential pitfalls allows you to navigate them proactively rather than being blindsided when they emerge. The financially free mindset. Cultivating specific mental approaches helps maximize the benefits of financial freedom. Abundance thinking, seeing opportunities rather than scarcity, viewing wealth as renewable and flowable rather than static, recognizing the multiplier effect of shared resources, finding collaborative rather than competitive approaches. Long-term perspective, considering multi-generational impacts of decisions, valuing sustainable satisfaction over momentary pleasure, building capacity versus consuming capacity, creating regenerative rather than extractive wealth. Internal validation, developing personal measures of success, releasing dependence on external approval or recognition, finding satisfaction in alignment with values, celebrating progress on your unique journey. Creative engagement, approaching life as a creator rather than a consumer, finding opportunities to build and contribute, maintaining curiosity and continuous learning, viewing challenges as design problems to solve present enjoyment, balancing future planning with current appreciation, practicing conscious enjoyment of existing abundance, finding satisfaction in the journey, not just the destination, creating celebration rituals for progress and achievement. These mindset elements transform financial freedom from a theoretical condition to a lived experience of genuine wealth. Your next steps, beginning the integration. As we conclude this guide, consider these specific next steps to begin integrating financial freedom with true life wealth. 1. Create your 5-dimensional wealth assessment. Rate your current situation in each wealth dimension, 1 to 10. Identify one key strength and one key gap in each. Determine which dimension would create the most leverage if improved. Set one specific goal for each dimension in the next 90 days too. Design your ideal week. Create a detailed vision of how you would spend a typical week if financially free. Compare to your current weekly reality to identify key gaps. Implement one element of your ideal week immediately. Develop a plan to progressively align current and ideal schedules. 3. Conduct your purpose exploration. List activities that create flow and engagement for you. Identify problems you feel uniquely positioned to address. Consider legacy elements you want to create or contribute. Design one purpose experiment to test a potential direction. 4. Update your financial freedom plan. Review your financial strategies through this integrated lens. Adjust timelines based on quality of life considerations. Identify ways to build non-financial wealth alongside financial growth. Create metrics that track progress across all dimensions. 5. Build your freedom community. Identify individuals who share your vision of integrated wealth. Create regular connection points with like-minded people. Share your journey with trusted others. For accountability, consider forming or joining a mastermind group focused on holistic success. These steps begin the process of ensuring that your financial journey leads not just to monetary wealth but to a genuinely rich and meaningful life. A final word: the freedom to choose. At its essence, financial freedom provides one priceless gift: choice. The freedom to choose how you spend your time, where you direct your energy, what problems you solve, and whom you spend your life with. This freedom comes with both opportunity and responsibility. The opportunity to create a life of meaning, purpose, and contribution. And the responsibility to use your resources wisely for your own well-being and the benefit of others. As you continue your journey toward and beyond financial freedom, remember that the ultimate measure of success is not found in spreadsheets or account statements. It's found in the quality of your days, the depth of your relationships, the meaning in your work, and the legacy you create. May your path to financial freedom lead to true wealth in all its dimensions. Thank you for allowing me to accompany you on this journey.